Okay. Good morning, ladies and gentlemen. Welcome. Hello, please come in. And welcome to the second year of the CEE Sustainable Finance Summit here in the beautiful premises of the Mandarin Oriental Hotel. And my name is Julian Toth. I'm the CEO of the International Sustainable Finance Center. This is...
Hi, I'm Linda Zailina. I'm the CEO of ISFC, or the International Sustainable Finance Center,
which is the main organizer and organization behind this summit, in which through the next 5 days and through panel discussions and fireside chats and roundtable discussions, we will explore different sides and different topics under sustainable finance. And we will go through policy and regulations, to energy, banking, but also to sustainability in business and all the way to innovation. So there's a lot, and really a lot packed in this agenda we have planned for the next 5 days.
Thank you. I think one of the reasons why we actually created the summit was, well, guess what? When you work on sustainable finance, sometimes you feel a bit lonely. And I had recently a very interesting Zoom call with President Obama, who said that one of the biggest life lessons one should take away is that you should build your own community. So every time somebody asks you, but why? That makes no sense. Why do you run a non-profit? Why do you run a 5-day summit? Isn't that exhausting? So that you actually have somebody to go to and ask and tell them, listen, somebody asked me again, why do we do what we do? And to be honest, this event is one of the reasons why we do this. We want to bring together people who agree. We actually want to engage with people who disagree, because guess what? We don't want to be in an echo chamber. Also, it's a very interesting discussion because there's so many things to unpack. We do need a sustainability transition. We need to rethink our business models, economic models, also how finance works. And for that, guess what? We need almost everybody either on board or engaged. So we really hope that this event will act as inspiration, that you will learn something, that you will meet some interesting people. And if there's one task for today, for those here in person, try and meet somebody you haven't met before. Because I'm sure that some of you recognize each other, but do try and ask, why are you here? What do you work on? And maybe you'll find somebody very interesting. Because we think that there's so much potential in this room. So please enjoy the discussions. And I will hand the mic over to my colleague just to wrap up and introduce our fantastic keynote speakers and the first panel.
And also to mention 2 more things. So I completely agree with what Mr. Obama said about the community, and it's really important for you to, and I think that's why you're here as well, to come and to meet people working on similar topics and maybe sharing similar challenges. But let's not forget about the people online as well. So we do have people watching online where they also should be part of the community, and probably and hopefully will also work closer and meet more people from the circles working on these topics. And you mentioned that 5-day event can be exhausting, and it is a lot of effort to put this together, from the agenda all the way to implementation and actually organizing everything, speakers and the panels. So it's really important to mention that this actually would not be possible without the support from our partners. And there's a lot of partners, and I would like to actually thank them as well. I do have a list. Without this list, that would be very difficult, and I tried to remember all of them. But just to mention some of them, 1 second. So the summit actually genuinely wouldn't be possible and without the support from all these partners, and that's from Erste Group and Česká spořitelňa, who have been supporting us very closely, and also Chess Group, the European Investment Bank, Mazars, KPMG, CTP, Citibank, Raiffeisen Bank, ING Bank, SAP, British Embassy in Prague, Allen & Overy, EBRD, Deloitte, Heavy Finance, RSJ Investments, CRIF, Magyar Bank Holding, Visegrad Fund, and the US Embassy. And there's a lot of partners. These partners supported us, the summit, financially, but also with their advice and with their speakers and with their know-how, and we are very, very grateful for the support. And maybe without any further ado, so we can kick off this long and hopefully inspirational summit, I think we can move on to the next block, and already with the first keynote speaker by Marek Havrda, Deputy Minister of the European affairs, please.
Good morning, ladies and gentlemen. It's my great pleasure and great honor to address the 2023 CEE Sustainable Finance Summit. I'm really glad that I've been invited and become a part of this community, emerging community, because more than 10 years ago, I started my first job in the European Commission working on sustainability. And I'm really glad to see how the things are evolving. Let me start by thanking the International Sustainable Finance Center for organizing the summit here in Prague. And let me express a special thanks to Linda, who initiated and managed the project from the very beginning, creating a platform for an open and stimulating discussions and sustainable finance in practice. It is obvious that sustainability is and will be among the main factors influencing transformation of the industry and the economy as a whole. In the EU political context, sustainable finance is understood as finance supporting economic prosperity by reducing environmental pressures and taking into account social and governance aspects. As we see also from the program of today's summit, there are many aspects to be considered regarding sustainable finance. In the regulation area, a significant amount of legislation has been prepared in recent years. Taxonomy, sustainable reporting, due diligence, standards for green bonds, just to name a few. Last semester, the Czech presidency made an important progress on these and related files, including the approval of Corporate Social Responsibility Directive and reaching a general approach. This means the agreement among the member states on the due diligence directive, which is very close to my heart, I have to admit. We reached agreement with the EP on the climate parts of the Fit for 55 package and as well on CBAM. We also negotiated with the EP the agreement on European Green Bond Standard, which was finalized by our Swedish friends just a few months ago on the last day of February. The objective of the new finance framework is to bring more transparency and coherence to the system and thus encourage private sector to allocate resources efficiently towards sustainable economic activities. In addition, the regulatory framework aims at creating a better link between profitability and sustainability, helping tackle the short-termism and encouraging long-term perspective in our decision-making. Sustainable regulations are not about bans or outlawing some practices or activities, but rather about motivation. In an effort to find an economically optimal way to maintain a healthy level of investment in Europe in line with our sustainability goals. When defining implementing modalities, it is crucial to avoid greenwashing while striking a good balance when reaching the instrumental quality of information so it allows to make decisions with the minimum possible administrative burden to the businesses. Let me turn to the geopolitical situation, which radically changed last year. Russia's aggression against Ukraine and Russia's energy war against Europe has made it clear that we must eliminate our dependence on fossil fuels from Russia. And this was among the chief priorities of the Czech presidency last semester. Transition to a net zero economy has thus become not only environmental, but utmost important geopolitical and security objective. In order to be successful, we need to secure resilient supply chains for the green transition. However, today the EU is highly dependent on imports of critical raw materials. Therefore, developing strategic partnerships with reliable partners has become a key priority for the EU. Ambitious and agile EU trade policy lies at the center of securing resilient supply chains. Last year, thanks to the Council conclusions approved under the Czech presidency, the EU cemented more granular and tailor-made approach to sustainability criteria in the FTAs, free trade agreements. Besides the FTAs, another major challenge is to implement effectively the EU autonomous sustainability legislation, be it CBAM or deforestation regulation. Today, the EU green industry is also impacted by the steps in the US and China. The Czech Republic therefore welcomes the recent proposals on legislation regarding the Critical Raw Materials Act and the Net Zero Industry Act, which shall help create a more favorable regulatory environment in Europe for net zero technologies and boosting competitiveness of European industry. However, regulatory action is clearly not enough. for the resilient supply chains, decarbonization of the EU industry, as well for development of the EU industry, for the development of the green industry in Europe, it is the private sector which plays a crucial role, it's a seminal role of the banking sector and the finance sector overall. Sustainability shall not be seen as a one-way or even a formal requirement, but we shall look for an appropriate mix of public and private actions towards resilient supply chains, competitive industry in Europe, while reducing both the negative environmental impact and our geopolitical vulnerability. I believe that the summit will provide new perspectives, inspiration, and insights that will help us move forward towards the shared goals. I wish you a very productive discussion this week. Thank you.
Thank you very much, Deputy Minister Havda. I think that was a very good opening salvo setting the scene. So if I can pass now to our second speaker. So we will have 3 very short keynote speeches. So if I can now ask Mr. Philip Abbey to join me on the stage. And he's the CEO of RepRisk, a Switzerland-based company. So please, the floor is yours.
Thank you very much, Linda. I work for a technology company, so I was given this high-tech device. Let's see whether it works to change the slides. But before I start, I want to mention that I studied climatology in the 90s of the last century. And when I finished my studies, there was no job for me as a climatologist outside of academia. So I had to go into consultancy. And this is very, very different today. So it's amazing what has happened for the last 30 years. It's also amazing that after seeing these waves of interest in ESG, which, as you know, was not called ESG for the last 30 years, there has not always been basically something backed up with actions. And I really believe, if you think, for example, of the focus on climate, there was a peak already more than 10 years ago in 2011 with this Stern report, if you remember this one. Then there was basically in 2015, if I'm not mistaken, there was a Paris Agreement, but nothing really happened on the ground, if I may say so. If you think, for example, of the German car industry, I'm not against the German car industry, I love them, but there was no real impact in terms of the way they build the cars. They were more fuel efficient, yes, but at the same time they gained so much weight, I mean the cars, that basically there was very little benefit of all these efficiencies. But now I think for the last 2 years, things are really, really changing. At the same time, I think when you go back to the coronavirus pandemic and you see how ESG became even more prominent, especially the S in ESG, and then basically that it's still so important despite the war in Europe and the inflation, economic difficulties. It's amazing, but at the same time, since 2022, I have the impression there's a little bit of feeling sometimes that ESG gets a bad name. So why is that? Because there are some promises, there are some pledges, and it's really unclear what the impact is of ESG. I very strongly believe in ESG in the sense that there should be a positive impact on planet and on society. So I'm not talking about the political aspect. If there's a backlash, as it's called, against ESG in America and the US, this doesn't worry me because it means there's an impact. There were no political backlash if there were no impact, right? So that's a good thing. I'm happy about these discussions in these democracies about the ESG impact, but I'm worried that there's not enough impact as it should be. So I think for me as a believer in ESG, I was thinking, what are the things that should be done to accelerate that further? And I know there are in the audience, the people from government, from the European Union, but also standard setters like the GRI. And I was thinking of 3 things I think we should reconsider. I'm not against these things, I just say we should reconsider in terms of the focus we have on them, and 3 other things I think we should have a stronger focus on. So these are the things I think we should reconsider. I start with the middle one. Also, just to be clear, I'm a climatologist. I'm not a climate change denier. What I really mean by this is we should reconsider the approach we have taken over the last couple of years with respect to carbon, and in particular for investors. Because you have this, what some people call this science-based targets, and they basically say, okay, for us to make sure that the temperature is not rising on average above this 1.5 degrees, we should have less emissions, we should transition to zero, and then you can break that down. For example, if you're a so-called universal owner in investing pretty much all the companies on earth, at least the listed ones like the Norwegian government pension fund, that you can calculate them basically, so how much emissions are still allowed, so to speak, over the next couple of years for an industry or individual company. This makes a lot of sense. And it's called the science-based targets, but then we do something that is completely unscientific. Because when I studied climatology, the first thing I learned is to think of the climate as a climate system. So if you have a climate system, and you basically break down the carbon emissions for your portfolio companies in your investment portfolio, and then basically you encourage the companies to lower their carbon footprint. What does it mean? It means basically that the companies, and an example, I'm from Switzerland, an example is Holcim, companies sell part of the business, high emission parts of the business, like what Holcim did, selling the Indian business to the Adani Group. Is that an improvement? Yeah, it's an improvement for Holcim, I hope. But overall, if you think of the climate system, there's same amount of emissions in the system. So this focus of the carbon footprint in terms of a portfolio doesn't make sense. It makes sense for individual company because they can lower their carbon footprint in a real meaningful way, but it doesn't make sense at all to have ETFs and measures and metrics, etc., at the investment portfolio level if you don't think of the whole system. Because you push basically the dirty assets either to dirty companies. There have been discussions lately among the coal mining companies where they shall merge part of the coal business, actually the coal business, and then basically have a dirty coal company in New York. And there will be more than enough investors that love dirty coal companies as long as they're profitable. So you push these assets to the dirty company, so to speak, dirty just in terms of CO2 emissions, to be clear, or you put that into private markets that are somehow below the radar, or you force companies to do pledges that they cannot uphold. And a good example is BP. And I fully understand that BP reassesses the strategy and the CO2 targets, but it's just very interesting to see how the share price went up 10% when they said basically that they want to reduce carbon targets. So I think we should be realistic, and I think if investors want to improve things and if regulators want to improve things, we should go for subsidies. I mean, look at the Biden administration. We should go for a carbon price, or we should go for regulation. We could, for example, say no more coal mines in the European Union or in the UK. I don't make a comment about the UK because I just learned that the UK embassy sponsors the events. But these are policy choices, right? So I think we should spend more energy on thinking about how can we get the right subsidies, how can we invest in technology companies, how can we have the right regulation, and not delegate basically this task of transitioning to a low-carbon economy to the portfolio managers that then basically are like sitting in a bathtub. Imagine two portfolio managers sitting in a bathtub, and the water is a carpet. The tap with the carpet, the water is flowing into the bathtub. It goes up, and then basically the investors say, "Oh, this is my portfolio," and they take buckets and try to put it into the portfolio of the other guy, right? So this doesn't work. So that's one thing I feel very, very passionate about, that if we talk of science-based targets, we think of the mechanism to really lower the carbon in the system. The second thing, company reporting. I was very, very honest to just meet the chair of GRI. I'm not against company reporting. in fact, because one of our clients just asked us, well, didn't ask, demanded that we do a sustainability report for the first time in 17 years. We do now the sustainability report. So we have the sustainability committee, we have the diversity inclusion committee, we have great stuff to tell in terms of cloud computing, which is carbon neutral thanks to really great technology. We put everything into this sustainability report. And then, of course, the first thing we do is we share it internally. It's great employer branding, right? All the great stuff we do. We collected it, put it into a report. But what really shocked me was when last week our chief commercial officer came to me and said, "Hey, Philip, we should publish that report because it's such great marketing." It shocked me because it was basically critical of company reporting and disclosures. I was saying what we need is due diligence. We don't need so much disclosure necessarily by companies, because if you think of corruption and human rights issues and cutting down forests, you don't disclose that for Christ's sake. So we need due diligence, not disclosure. And then our chief commercial officer that works with me for more than 10 years wants to publish our sustainability report. But I understand, it's great marketing, but the fact is we haven't done any action in addition. We just collected everything we did already. Of course, I understand if the baseline, everything, but what I'm saying is it's a huge administrative burden. I mean, for us, it was not a big deal. We just hired someone to do that, etc. As I said, big benefits, employer branding. But are there better ways to get results that really affect the bottom line? And one of that, for example, would be due diligence. The third thing I think we should reconsider is this idea that there's one number that basically determines whether a company is a good or a bad company. This ESG ratings. I'm not against ESG ratings. We talk about it on the panel, so I don't want to go into that. But I believe this ESG rating, despite of this aggregate confusion, it's unclear what it means, very much stems from the fact that ESG ratings are very convenient to use. Basically, if you're an investment manager, I mean, you just can continue with the same methodology, right? You just say, okay, 600 European companies, now go to a provider, tell me what 300 actually are ESG okay, and then you take the 300, do everything the same, and in the end, maybe you even end up with the same portfolio companies because there's some overruling policies that you can do. You just can charge basically 50 basis points more. So instead of aggregate confusion, I think we need clear purpose. So what do regulators, legislators want to achieve? And then think how you can achieve it. And then maybe company reporting or ESG ratings are not the answers. I mean, an easy example is diversity. And in Europe, it's different to the US. Here, diversity can be, in terms of metrics, for example, measured in terms of gender, depends on the legislation. And here you need company reporting, right? But if this is your goal, then basically make a law that you say there's a certain number of, for example, females at the management committee level, at the board committee level, etc. That's easy to do. If it's about biodiversity, well, that's a tricky one because there's not a simple number and a simple single number like for carbon, right? But you could, for example, say as a European Union, okay, we want to protect wetlands or whatever. You know, there are a lot of methodologies developed by NGOs like WWF to do that, high conservation value areas, etc. But the first thing we need is ESG. Otherwise, it really goes down the drain. Is to be very clear about the purpose of every data point, of every metric, but of every legislation as well. And here, the European Union came up with something absolutely great, the double materiality. In simple terms, what the Americans like to say, you can talk of risk. Is it about financial risk, a certain thing you want to achieve, or is it about impact, and in particular about adverse impact? Related to that, and I'm super excited now in the European Union and the UK, there's now talk about regulating some of the ESG data providers and what the UK calls rating agencies whenever they come up with a score. And when we follow the example of the Japanese, and again follow the proposal of the IOSCO, then basically transparency on the methodology is the #1 thing, because only if you have transparency, you see that things get changed all the time, and this doesn't make sense anymore, right? We need transparency. So that's the other thing that I really urge you to consider as an investor when you buy data, but also as a regulator. And the last one goes back actually when Linda and me met in 2020. We always talk of ESG, but usually we just mean E. Actually, we just mean climate. And I think there's no fair transition to this low-carbon economy without considering the people, the S. And again, it was for pure inconvenience that the S got neglected, because there's no single number. I mean, how do you measure discrimination? How do you measure fair labor conditions? You could measure job creation, but there was no focus on the S. But we need the S in addition to the E, the same way as within the E, not only climate, but also biodiversity, because if you don't have conservation, it looks very bad on this Earth in 30 years as well. And you can only do this E and S if you have proper governance. So these are the 6 things I would love you to consider and reconsider. Thank you very much.
Thank you very much, Philip. That was a fantastic deep dive into what's right and what's wrong, actually, with the current ESG landscape, and what could be the potential solutions. So thank you for that, and thank you for bringing the S in ESG. We will have a whole session about that in the afternoon. So now I would like to introduce, my privilege is to introduce Mr. Elko van der Enden, the CEO of GRI, Global Reporting Initiative, which is the world's largest reporting framework used by over, I think, 50 or more thousand companies globally. So thank you very much for joining us today, and please, the floor is yours.
Well, thank you for having me here. And Philippe touched so many topics that I could go on for 3 days in a row in addressing them. Especially the last item, that there is so much attention for the E and not so much for the S and the G. And that has a reason, of course, especially in capital markets. Because everyone understands carbon, that you can reduce that by putting a filter in a factory. I mean, you can imagine. And that's not only that, you can measure it quantitatively and qualitatively. And what's even more fun, you can trade it. It's monetizable. And when it's monetizable, it usually gets a lot of attention. But I'm not there to discuss this. So I've made some scribbles, and I have my chief of staff that will stick me to my 10 minutes, I hope. But sustainability and sustainable finance are important. And why are they important? And why do they get so much attention? Because you cannot run a profitable business in a dysfunctional society. And whether we like it or not, we need profitable businesses in order to pay for the transition. But there is, of course, more. It must be done in such a way that society is not harmed, because the objective, the purpose of what we all do, is making this a happier, healthier planet for all in full inclusion. That is why we do this. Unfortunately, although we are here in Europe, we do not live on an island. Some people, and in some countries, there are those that have different ideas. And I would like to discuss some of these ideas with you now. I just came from a 2-week roadshow through the United States of America. And I want to introduce you to a concept called, and you can find it on their website, freedom to invest. freedomtoinvest.com. And what is this initiative by investors about? So last week we were in Boston at Ceres, basically the organization that founded GRI. GRI is originally a US organization, founded in 1997. So what is this freedom of invest all about? Currently, in the United States, in some states, legislation has been introduced that tries to achieve exactly the opposite that currently is being implemented in Europe thanks to the great activities of our friends of EFRAG. That is, reporting on double materiality sustainability. So we see in some states, Florida, Texas, Ohio, Missouri, etc., 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 legislation that basically prohibits investments into organizations and funds that are dealing with ESG or sustainability topics. Can you imagine? That is restricting your freedom to invest as bank, financial institution, pension funds, sovereign wealth funds, etc., etc., etc. So I got this question from a journalist from Bloomberg, what my ideas were about this, and then being in the US and being sucked into this poisonous political debate, and looking also at my background, how can I answer in a polite way without trying to be too offensive and try to just bring across the logic of why we do it, not only out of altruism and doing good, but also the business logic behind it. And it's not that difficult. My career, I used to be a head of tax, treasury, risk management, and CFO before taking on this job. And what I learned as risk manager is that it's not about achieving to obtain the lowest insurance premiums you have to pay, but that it's about mitigating risks. Mitigating risks. And the legislation we see currently in some of the US states is basically about pushing boardrooms, about forsaking their fiduciary duty towards their investors and society. What do I mean with that? Let me give you 3 examples. You're in retail, we have global warming, so you need more cooling equipment to keep your products fresh. If you do not take global warming into account and climate change into account in your energy procurement policy, then you will face a big issue with your investors, because as we said, with the invasions in Russia, as the first speaker said, we face an energy crisis that must be mitigated. Secondly, if you're a platform organization, and now we go to another one, and you do not take workplace safety, diversity, the right to organize, equal pay into account, you will be faced and you will be confronted with a workforce that will be pretty, I can't find another word, pissed off with you, and start to organize strikes and in the disruptive mode that will absolutely hit your bottom line. And if you're in construction, and if you do not have your anti-bribery policy in order and monitor and control whether or not this policy is properly executed, as happened quite recently with a Dutch multinational company, and you obtained the railroad contract in Saudi Arabia by bribing yourself into the deal, and that comes into the open, you face criminal litigations, you will not receive any contracts in any other countries anymore, you lose your license to operate. So what is this all about? The first example of the retailer is the E. The second example of the platform organization that we have seen in many countries basically effectively happening, also in Europe, is about the S. And the third one, the last one, anti-bribery, that is about the G, E, S, and G. So how can certain states in the United States come up with legislation that try to discourage boardrooms and management to mitigate these risks? Because not taking care of these risks as a boardroom is malpractice and a financial offense by itself. I, as investor, would never lay in $1 or €1 in an organization that on purpose is not mitigating these risks. And I think we should be very careful that we find the right tone in discussions with whatever administration will come up in the United States, that we are and keep our freedom to invest, and that we enable boardrooms to fulfill their fiduciary duty, not only on behalf of investors, but also on behalf of our planet and our people. Thank you very much.
Thank you very much. I think that was a real tour de force about the US, which is the world's largest economy and still has major influence on everything that happens globally. So now I would like to introduce Mr. Martin Spolz from the European Commission, and it will be followed by our very first panel, which will be moderated by Nadia Humphreys from Bloomberg. And we are very, very lucky to have actually quite a lot of the new EU Sustainable Platform members today with us. So I think this is going to be a super interesting discussion between the platform members and between also practitioners, both from government, with Katarzyna Schwarz joining us from Poland, and with another practitioner here from the local market, Mr. Lubomir Vyshtavel from Goldman Sachs Asset Management. So thank you very much, and I'll give the word now to Martin and then to Nadia and everybody else. Thank you.
Trust.
Brilliant, thank you. Does this work all right? Perfect. Thank you all so much. Really excited to start to pivot away from maybe some US context and across to some European context. And if I will, by way of introduction, maybe open the floor for Martin to share a few words in terms of the EU Sustainable Finance Agenda, what's happening currently, maybe some view on what's happening in the kind of future line of sight. If you wouldn't mind, Martin, just sharing a couple of your thoughts with us.
Thank you very much, Nadia. Good morning to you all. First of all, compliments to Linda for having organized such a great event. I have to say that I have attended several events on sustainable finance in the region, but this is really one of the very best events, and I hope that this will stay like that. I must say that 5 years ago, when we started to draft the first action plan on sustainable finance, it was in 2018, I never dreamed that in my own town there would be an event, a big event, for 5 days on sustainable finance. So I see that now, Linda, you don't have to be lonely. I think that you are surrounded by a number of great people. Today I have not come to preach the members of the platform, or those of you who I know. I have come here to try to help the debate, because opening the conversation on this policy is very important and very difficult in this region. So I will try in my speech, short speech and then discussion, to articulate the opportunities that this agenda offers. This is not only about regulatory burdens. Obviously, this agenda does cause burdens, but it is in the first place about opportunities. I discussed with Martin L. before the start of the event that we always need to make an effort to translate why we are doing things, not only from the EU mantra perspective, but what it is good for you, what it is good for the financial sector and the businesses, and I hope that the debate will go in that direction. Now, 5 years ago, we have established 2 overarching objectives for our policy. First, to reorient capital flows towards sustainable investment. We have a huge investment gap, and public money will never be sufficient. And second, we wanted to make sure that the financial sector itself, but now also corporates, have to be resilient to withstand the risks that we are observing from climate change and environmental degradation. Now, translating this EU mantra into your ears, what does it mean for you? Well, for the financial sector, in the first place, a new set of great opportunities for financing. And not only for financing what is green today, but what is becoming greener and ultimately will become green. And this is a massive space that the financing and financial sector can occupy. And I think that those of you who are working in the financial sector and would like to continue in a sustainable way, you do need to notice this. Second, for those who are not in the financial sector but who are in the corporate business, if you want to attract capital for, again, becoming sustainable, and not necessarily only tomorrow, but for becoming better and for improving your environmental performance, being interested in this agenda is absolutely essential. So you will need to understand the key concepts, how the financial sector operates and uses, and how the conversation between the financial sector and businesses goes on. Now, it's very simple. Our agenda has been based on 3 main pillars. The first pillar was to create clarity which economic projects, which economic activities are ultimately aligned with our targets, with our European Green Deal targets, climate objectives, and environmental objectives. And this is why we started to work on taxonomy. I mean, this is a kind of techno word, but it essentially means a classification system that brings clarity what is ultimately good enough to be aligned with the environmental objectives. This is a project that we have not started on our own. This is a project that the financial sector asked us to develop, and this is what we have done. So 5 years later, we have developed the climate taxonomy. The second pillar of our policy is transparency and disclosures. And yes, indeed, we do need better transparency. We do need to understand better the environmental performance of the companies so that the financial sector can understand where to invest and how. And this is where we have regulated to impose requirements not only on the financial sector, but also on the corporates. This is the second pillar. And the third pillar, it's very basic. It's about tools and instruments. And tools and instruments that are voluntary, that are not obligatory, but we are putting at disposal to the community of the corporates and the financial sector. Those of them who would like to make an impact, they are free to use them. So here we are talking about climate benchmarks, the European Green Bond Standards, etc., etc. Now, where are we? On taxonomy, I mentioned that we have already developed the first set of climate taxonomy, which is a set of activities that substantially contribute to climate change mitigation and climate change adaptation. And it's quite an impressive coverage of this climate taxonomy. It covers 2/3 of emissions. So we are certainly not talking about the green niche. We are talking about key economic sectors, such as building, transport, energy, where the potential to reduce carbon emissions is very significant. Now we are finalizing the taxonomy also for the other 4 environmental objectives. We have circular economy, we have prevention and control of pollution, we have water protection and marine resources, and biodiversity. And the Commission, in 4 weeks' time, will adopt the new taxonomy on these other 4 environmental objectives. So those of you who are interested, please watch that space, because it will only expand the usage of taxonomy. When it comes to the second pillar and the reporting standards, we have, as I mentioned, already regulated the financial sector transparency, but now we are moving to the next stage, which is bringing clarity into the standards that the corporates that are subject to so-called Corporate Sustainability Reporting Directive, that they have to report. Now, we have tried to reduce the burdens of these standards to the extent possible, and in coming weeks, approximately 3-4 weeks, the Commission will launch a consultation on the set of standards based on the work that EFRAG has done. We have done this work, again, in the first place to bring transparency and improve the conversation between the financial sector and the corporates. But we have done a lot of work that is supposed to be enabling stakeholders to use this framework. So the disclosures and the regulatory requirements are a very important part of the framework, but this is certainly not enough. We do encourage stakeholders, and especially the financial sector and corporates, to have a conversation on how the transition towards meeting these objectives will evolve. And this is something that cannot be achieved only through regulation and legislation. So here we are now, I mean, if you ask me what are the current priorities in the Commission, we are looking not only on how to finance green, on what is already green today or what will become green tomorrow, but how to become greener and how to improve the environmental performance or social performance indicators over time. So this term transition finance has been really brought to the attention of many. And those of you who are interested, the Commission will provide a piece that will hopefully be a useful guide to everyone how the existing framework can help this transition finance. And the second big priority that is currently very high on our agenda is the so-called usability or simplification, or I would translate it in simple words, make it work on the ground. The success of this agenda will depend on how, first, stakeholders can comply with the regulatory requirements, but what they can take from the tools and instruments that we have put forward and how they will make impact with them. And we have detected that there are some bugs in the system, either in the framework that we are operating, also in the way how the stakeholders are operating. And we call it usability aspects. So we are trying to clean the homework as much as possible. I mean, stakeholders are raising concerns and challenges with the reporting requirements and with complying with some of the new rules, and it's legitimate that they are raising these concerns, and the Commission is now really paying its utmost attention to address them. So this usability work has really attracted a lot of attention on our side. We have also articulated where the different pieces of our regulatory puzzle can interact better, and we will disclose a piece on this in mid-June. My final point is that it was mentioned that there are some problems with ESG ratings. Yes, we have seen that there are indeed some problems with ESG ratings, especially transparency. There will be a dedicated panel on that. The European Commission decided to put forward a legislative proposal. This will be the last legislative proposal on sustainable finance under the mandate of this European Commission, and we will do that in 4 weeks' time. On the 13th of June, the Commission will adopt a proposal that will not harmonize how ESG ratings should be assigned, but it will introduce a minimum degree of transparency and clarity that ESG rating providers have to comply with. I think that now I have really come to the end. I promised you that I will try to convince you why you should watch this space and why you should be encouraged to follow this discussion, especially on transition finance. I have to say that there is nowhere more, there's nowhere in the European Union where the transition finance, I think, can be so relevant than in the CEE region. And the purpose of this agenda is to shift the narrative from those of you who are green, you are great, and if you are not, then shame on you, into a narrative that everyone can improve. Everyone can improve. And the purpose of this agenda is to put forward a set of tools and instruments that would allow everyone, irrespective of the starting point, irrespective of the economic sector, to make an improvement. And this is exactly where the conversation between the financial sector, corporates, and other stakeholders matter so much. So I look forward to the discussion. Thank you.
Brilliant. Thank you, Martin. A huge amount of food for thought in that opener. Thank you. Before I kind of steal a few questions myself on topics that Martin has brought up with our other panelists, I do want to draw your attention to the fact that we will have some open Q&A. So Slido is open. The hashtag, you can almost see at the bottom, is hashtag CEE Summit 2023, behind Katarzyna's head there. There we go. So please do log on and ask questions. I will do my very best at the end to try and bridge some of the important topics that I know Martin had raised. Katarzyna, if I can turn to you actually first. So Martin talked about 3 key objectives. So one was reorienting capital to sustainable outcomes. The other is looking at transparency, and the third is risk management. And I'm just curious for your role and what you observe in Poland specifically. How is that turning from kind of an ambition into practice? Could you share a little bit of that with us?
Well, absolutely. Thank you for that question. But first of all, before I jump into answering it, thank you very much to the entire ISFC team for having me here and for making this wonderful event happen. I'm really happy to be here. I'm actually quite convinced. People always ask, what's the next big thing in sustainable finance? Is it transparency? Is it ratings? I'm actually quite convinced it's CEE. So, and this is the approach we're taking in Poland. For us, sustainable finance is not a compliance exercise. We obviously have enormous financing needs to make our climate transition happen. At the Ministry of Finance, together with our advisors, we calculated that by 2050, it's gonna take around 2 trillion euros to finance a transition just in the 4 key sectors. This amounts to almost 9% of GDP. Of course, the incremental investment is between 1% and 2%, which is close to what other OECD countries will have to invest, but it is still an enormous amount of investment, and the public investor will not be able to take the bill by itself. That is why last year, we launched work on a roadmap for the development of sustainable finance in Poland. The idea is to coordinate, bring together all the wonderful things that are already happening in the Polish market, and ensure that in 5 years, we as a country, as the largest capital market in the CEE indeed, are able to offer efficient financial instruments, mechanisms to translate our savings and capital into investment into sustainability transition, that we have a vibrant ecosystem of services that is capable of supporting that. I'm talking sustainability audit, I'm talking green bond certification, I'm talking professional advice that, for example, can work together with high-emitting companies that still form a large part of our economy, to take them through that transition, to explain to them that actually they are the addressee, the object of that entire exercise, as it is a no-brainer to put more money into something that is already green. It is no-brainer to invest more into Apple's or Alphabet's debt, and then be happy about the great credentials about the portfolio, right? But the trick is to invest in those companies that are very high emitting today and have credible transition strategies with very clear and transparent key milestones. That is the objective number one. The objective number two is we take our responsibility as the biggest capital market in this part of Europe very seriously. We want to ensure that whatever we do as part of our roadmap and as part of our plan in the next couple of years can also serve the entire region. That our stock exchange is open to listings of equity, of sustainable debt, that we have indices and ratings that can help attract capital from the region, but also from global investors. We want to ensure that local governments or smaller corporates will no longer have to call London or Amsterdam to get their sustainable bonds rating, but they will be able to call someone in our region and deal with it locally. We are supported by the Polish Sustainable Finance Platform, which brings together capital market practitioners, representatives of the entire capital market community, as well as NGOs such as the UN Global Compact Network, and of course other ministries and the regulator. For we truly believe that only the cooperation between all those actors will help us achieve that goal. Nonetheless, having said that, and just to briefly relate to Martin's wonderful presentation, I think in a way we are very lucky to be in the EU at this time, as you know, as much as we complain sometimes about this tsunami of regulations that is flowing from Brussels towards us. It actually helps with transparency. It helps with bringing all the standards to one common denominator. So when you talk to people, they really see that as an advantage at the end.
Thank you, Katarzyna. That's a lot. So I heard a couple of things from you. One I will pick up on a little later, which is transition, and maybe come to Martin on that point too. But before I do, Agnieszka, so Katarzyna mentioned the word tsunami of regulation. And I just wanted to kind of maybe dig a little into kind of on the floor. What is it like? What are you observing? So Martin mentioned it's taken the Commission and their technical working groups kind of 5 years to get to some degree of maturity of the taxonomy, although I would argue we're as yet still got more and more to continue to do. That is a brand new reporting requirement on a lot of European companies. And I was just curious, what have you observed at the moment in terms of the take-up and use of these tools?
Thank you, Nadia. Thank you for the question. So you can clearly see my throat is dry because Nadia is making me to reply to Martin in front of all the people, and I just joined the platform, so I'm going to complain as the first one. That's not fair. What doesn't work from the perspective of companies. So maybe I will start from thank you to International Sustainable Finance Center and to Linda Zailina for invitation and having this possibility to discuss in front of others what things could be improved. But I have followed the recommendation from Martin, and I've been participating or listening to debates what companies see as a first priority. And clearly, as Nadia said, this is reporting, which is a little bit a surprise. But I think this is the approach that they want to be ready, and this is the biggest challenge they see, to be ready with reporting on sustainable finance regulations. And for me, it's a little bit a sequence problem. Yeah? So I strongly believe that given the level of detail in SFDR, but also non-financial regulations, it calls for implementing ESG processes to companies' operations. Without this integration of ESG processes, reporting will be very high level. Yeah? So the reporting is a moment to see whether we have it. Yes, otherwise we don't have anything to report as companies. But also it is a checkpoint to see whether entities are purpose-driven, as it was said before, and whether those ambitious are within a strategy. Yeah? So the sequence should be from strategy to processes and then to reporting. The question is whether the companies used time in a good way. Also, another risk potential is that companies might interpret regulations lower than expected due to problems with accuracy and consistent of data for different matrix. This is still a challenge. Yeah? So I think this, as you say, regulatory overload pushes us to things that might not be a right way to prioritizing by companies, but also seeing this problem with interpretation. And maybe one more thing to strongly emphasize that the data is available. The issue is that we still there are swaths of data which issuers need to add to the current disclosure. And this is not just about small companies, SMEs. Still, public large companies don't disclose what we need as financial institutions. So this, again, this sequence of reporting and across the regulatory framework is also a bit of a challenge for companies. And maybe, as we discussed it before, if you don't do right sequence, then you don't see how many operational resources companies need and financial power to fuel these efforts. Yeah? We still see very small, in many companies, too small teams that covers those issues. So I think other than regulatory overload, interpretation problem, maybe sometimes misalignment between many regulations that are part of sustainable finance framework. That is something to help, and I know European Commission is addressing, but still, yeah, the time passed and we said we don't have so much time.
Brilliant, Agnes. I see Martin diligently taking notes, so he's obviously going to be the next one I turn to here. It's true that the taxonomy is a very new way of reporting, and people need to adjust to that. And in the eye of something that could be perceived to be quite complex and very new, is there the risk that this becomes what you don't want, the compliance tick box exercise. And so Martin, maybe to address some of Agnieszka's points around usability, is the Commission aware? And if so, what are you doing about them?
Is certainly aware, and we have received a number of claims from stakeholders that either the criteria that we have put in the taxonomy are not entirely clear, and we have already provided some clarifications for the most important cases, but also when the stakeholders are supposed to now report against taxonomy. I mentioned that the only requirement from the regulatory point of view is disclosure. Corporates have to disclose the proportion of their taxonomy-aligned revenues and taxonomy-aligned capital expenditures and operational expenditures, and the financial sector participants have to disclose to what extent their financial products that they are selling are aligned with taxonomy. And there are many practical issues that arise, and we have already provided a number of clarifications, but this process is ongoing. I mean, we have to respond to the requests, on an ongoing basis. So there are issues. Agnieszka, you mentioned also the sequencing. I have to admit that the fact that we have started first with the regulation and transparency of the financial sector, and only now follow up with the transparency by the corporates is not optimal, because the financial sector has to obviously report against the data that they will gather from corporates. They have some information on their own, like banks are getting from their clients, but it is not optimal. So we have tried to address these kind of first introductory difficulties and challenges through, again, guidances. Now, you also mentioned that there are some misalignments of the different pieces. I will not name all the regulatory pieces that we have put in place, but there are some misalignments. And now we have clarified that as long as you are complying with one of the pieces, then it means that you can also comply with another one. So we are, again, providing some concepts of safe harbors, etc. It's very technical, but we are doing it. On the usability, our previous group that we had, a group of experts, I must say, and many of you actually some of you in this room are on the group or were on the group, have helped us to identify the key challenges that stakeholders are facing, especially when it comes to taxonomy and also the overall framework. Now we have a new group. Agnieszka and Nadia and Shona are there on the group, and Linda, by the way, as well. And the main purpose of this group, the main task of this group is to not only identify the challenges, but also identify the solutions. So it's an evolving process. And the only thing that I can say today is that the Commission really listens a lot. We take it very seriously. And the mantra that I have presented to you, make it work on the ground, is really now a very serious agenda.
Brilliant, thank you, Martin. So maybe, if I may, Agnieszka, to come back to you. So Martin mentioned this thing called the platform, newly appointed. Could you just explain kind of what the remit and the structure of the platform is for people?
Thank you. Thank you very much for this question. Yeah, I feel very privileged to be part of the platform and in the new mandate. So the platform 2.0 operates in a structure that has 35 members and 14 observers, and we discuss through plenary. But what is very important is that most of the technical work, recommendations, report, opinions are prepared within subgroups that are dedicated to major tasks. And right now we have 3 major subgroups, 3 major tasks. Martin mentioned one of them, which is usability. This new platform operates under very different contexts. So we are seeing markets, companies have started to apply taxonomy. So we will have more data on how useful is this tool and whether there are some rooms to how is it implemented, and whether there are some ways to improve usability of this tool, as well as the whole framework for sustainable finance as a wider set of instruments and tools. The first task, when we think about usability, will also look at data availability, data quality. As I said, large companies will have a challenge, but they should meet the challenge. For the smaller companies, there is a need to find some fixed, consolidated system to collect the data. There is also a second subgroup that will look at taxonomy criteria, how they are being implemented, whether there are some misinterpretation or there's not enough clarity, so maybe there is a need for potential revision. And the last subgroup, which will look at the flow of capital and will monitor the flow of capital into sustainable finance. So that would be 3 streams that European Commission is looking at platform on advising on those 3 major points.
Brilliant, thank you very much. A big remit on a slightly smaller platform this time around. So, and maybe if I can, to Lubomir, to turn to you, because really what we're trying to do here is offer a framework that points to what does good look like. So until the existence, I would argue, of the EU agenda, being sustainable meant that I am, relative to my peer group, slightly outperforming them on a set of E, S, or G metrics. And that wasn't good enough to hit net zero. So the taxonomy has come in, and the taxonomy is now pointing to what, for certain sectors, is environmental sustainability. What does that look like, and how do I need to perform, and companies need to report under that. One of the things that I found really interesting when I was doing my prep work for this panel is actually a few signals. So Martin talks about a framework that importantly is looking at demand. So it believes that demand exists for sustainable outcomes in order for the entire framework to be successful. And I just wanted to maybe share with you a few data points that Goldman's research I recently read had in it that I think kind of ticks the box that Martin was talking about, to be fair. So we have, for those unfamiliar, products called Article 8 products, and they pursue environmental or social characteristics. And we have those Article 9 products that have objectives that are environmentally or socially focused at their heart. What we've observed through some of the research from Goldman Sachs is that these Article 9 products that have taxonomy-aligned investee companies, the taxonomy alignment of those companies is about 450% overweight relative to the benchmark. And for the Article 8, it's about 100% overweight. That means that even within these sustainable products, investors are demanding taxonomy alignment. They see the reward from that. And I'm just interested, Lubomir, in terms of your approach to investment and sustainable investment, how different has this reg agenda made your day-to-day?
Thank you. Thank you very much. Thank you for to the organizers for having me on this panel. It's an honor to be here. It's the right question in a way on how the region is contributing to this, or how we a little bit on the backyard of Europe, how we are evolving in this sense. And initially, the approach was quite cynical, or the responses from the general public were quite cynical about true belief in ESG and sustainable investing as such. However, that discussion, I think, is changing enormously. I think that it's becoming not a question of why to do that, but how, and how to participate and how to contribute. From the clients that we, the AUM that we manage, we have quite a considerable amount of time dedicated now to questions around sustainability, about how we screen for ESG, how we make sure that the parameters are met, or how we do our work, and what sources of data we use, whether we look for third-party providers for the data, or whether we look for internal research. And yeah, it's a lot of discussion about how these things are combined. And I think it's clear that the wave of interest in sustainable investing and in making the change and participating on that, either for the objective of avoiding the risks or for the objective of actually participating and getting extra returns for doing the right thing at the same time is the objective.
Yeah, that's really interesting. One other metric I observed is that, and this is as of Q1 this year, the Article 9 ETF products, 70% of them saw inflows. And they're quite sticky in that only 19% saw any degree of outflow. And when you compare that, for example, to Article 8, we saw that 53% were drawing inflows, but 32% were drawing outflows. So is this your observation? When you have conversations with clients, are they quite particular about wanting, you know, the true Article 9, the environmental or social objective of their investment? Is that something you are seeing?
We are indeed observing that there's a lot, that the flows into financial products or investment funds on the market are indeed discriminating a lot between those that are just not integrating ESG factors at all, which are actually on active asset management, seeing some outflows given the environment. But we see inflows relatively steady into Article 8 or Article 9 products, even in markets which in general would see outflows. So we see that it is stable. And yes, we see, let's say, more interest in Article 9 defined products. But Article 8 is also, depending on the particular niche or need of the investor, is also making the trick, if I can call it that way. It's also meeting the hurdle of actually going in the right direction, because I think we do all realize that the world is not made of only sustainable investments. And if we have all started to take our money out from those that we do not define sustainable, no matter how we look at that, then a lot of projects that are, a lot of companies that are needed to actually fulfill our current needs that we have, that will not be financed, that will not be possible. So there is a clear need not to make it just a transition like a flip of our fingers. It's not going to happen like that. We all, in this room, I'm sure, should realize that this is a transition, and so I call it a transition as well. It's something that's going to happen over time, and I think that's really important to facilitate that the transition and to be part of that. Clearly, there are investors that would focus to be there already now, and that's the right thing to do. Why not? But there are also others that are understanding that there are bigger impact might be also with products that actually are looking at not only at those companies that are already meeting the criteria, but companies that have the potential and have committed to make the transition. And there is a big role of the financial industry in active engagement, be it banks on the financing or asset managers in talking to the companies, and through that engagement really enable the change.
And I think, oh look, Martin's always cueing me with his little notes there, so I'm definitely going to jump to you next. And I think, look, there is, in my opinion, a misunderstood criticism of the taxonomy that it only rewards companies that are like the deepest green. And therefore, what we're seeing is this big demand for these Article 9 products. Can they therefore, as I've said, 450% overweight to taxonomy-aligned investments? My understanding of that is lots of people are quoting kind of revenue or turnover figures at me. And actually, capital expenditure is a really interesting tool in the taxonomy. I wondered if you might be able to touch on that point, but also just more generally in the transition. Is it okay for an Article 9 product to have transitioning investee companies, for example?
Thank you, Nadia. First of all, we have clarified that Article 9 products do not have to have only taxonomy-aligned investments recently, which I hope, reassured markets. So we have provided flexibility to the markets. Now, taxonomy is still a very central piece of our agenda. And those who argue that taxonomy is very tight and is very ambitious, they are right. But does it mean that it can be used only by a small niche of the markets? That's very wrong. And I will give you 2 examples how you can use taxonomy even if you do not necessarily meet the environmental performance criteria today. The first one is if you are currently operating a company that doesn't generate a single crown or euro from the revenues that would be of taxonomy stemming from taxonomy aligned activities, you can still have a capital expenditure, an investment that over the next 5 to 10 years will ultimately allow you to reach the environmental performance that you need, and you can still claim it as capital expenditure taxonomy aligned, which I think is a very big opportunity for anyone. And again, I would like to highlight, especially in this region, in the CEE region, basically any company that doesn't generate a single euro or crown in terms of revenues can invest in projects, and then the compliance with the criteria, especially do not significant harm, can be achieved only at the end of this period. This is a massive opportunity. So, you know, again, if I give you an example, a cement company that is producing cement can invest in a new technology, can issue even a green bond that will be then taxonomy aligned, and then this investment can be deemed as taxonomy for the reporting purposes. The second opportunity how you can use taxonomy, even if you don't meet the criteria today, you can have a transition plan. And again, we are not forcing anyone now, I mean, everyone to have a transition plan, but those companies who would like to communicate to their financial community how they are going to transition, they can disclose how they intend to improve their environmental performance over time. So to give you an example, this cement company can say today, I have no taxonomy aligned revenues or no taxonomy aligned CapEx or OpEx, but in 5 years' time, it will increase to 5%, which is already an important information. Or another example, today I am not meeting the non-significant harm criteria, i.e. I am causing significant harm to the environment, but in 5 years' time or 10 years' time, I will cease, I will stop causing significant harm, and I will get out of the red zone, which is currently defined by the taxonomy. So again, the taxonomy is not penalizing anyone. It should be in the first place as a tool, as a useful tool. And again, the Commission is currently working on providing useful, practical tips. And let me emphasize useful, practical tips that are voluntary, that ultimately stakeholders can grab if they see the opportunity. There will be no further regulation that will tell people you have to invest in these assets, you have to divest from those assets, you have to engage in these companies, you have to engage in these activities. That would be a Sovietic planning, and you know, I'm speaking in Prague, being Czech. So I hope that this clarifies.
Brilliant, thank you, Martin. And I think this is probably one of the most important messages on this panel. And Lubomir, if I may just very quickly turn to you, because in Goldman's sustainability report, you talk a little around an NL bond that was launched that's sustainably linked, that looks at future taxonomy-based outcomes. So to Martin's point, the taxonomy is a tool, but there's still a range of creativity that an investor can have with that tool. And I wondered if you could just maybe touch very lightly on kind of the practical aspects of the tools that are now available to you.
Well, I haven't participated on this issuance, but I do know that there's a lot of innovation within our firm, but also in market in general, around sustainable instruments and financing. And I think it is exactly what we actually need at this moment is to look at this as a tremendous opportunity to really mobilize the resources, be it financial or human or other capital resources that we have available to enable that change, and to see or help our clients see and help them how to achieve the transformation, how to work on that transition. So it's exactly our role, how we are fitting into bridging and cooperating with our clients on finding the solutions. Goldman Sachs is committed to $750 billion of sustainable investing over 10 years, 3 years ago. I think in this report that you mentioned, it's already mentioned there that 3 years on the road we have already reached 55% of that target. So it seems like there is a lot of acceleration in this mode, and this target will probably be exceeded. So it fulfills me with personal hope that the resources and the energy is put in the right context, and this innovation will help investors, will help the companies to find the resources that are needed to enable this.
Thank you. And maybe I'm going to open up to Slido in just a couple of minutes if you do have any questions you want to add. But Katarzyna, if I can come to you with my last question at the moment. A lot of what we've talked about on the panel, I think, hinges on education and the importance of people knowing and understanding the tools available to them, how to execute them, to Agnieszka's point on actual corporate reporting, but then from an investment perspective. I wondered if maybe we could touch a little on the important role of education as you see it as well.
Well, absolutely, you know, and sometimes when people mention education, they consider it something secondary, something that will only bring results in the long term, so maybe something we shouldn't be focusing on that much at the moment. And it was such a positive surprise to me. You know, a couple of weeks ago, we organized this Polish Capital Market Development Days in London. We had an opportunity, thanks to the European Bank of Reconstruction and Development, to discuss with largest asset managers and investment banks, global investment banks, what's the idea to make Poland this regional sustainable finance hub. And the first question, after the data question, was, okay, so what are you doing about education? What are you doing about skills? What we see is a huge skills gap, and it has a very practical dimension. It's not only about creating this awareness amongst the public, but it's also about global financial institutions having experts on the ground, being able to select genuinely sustainable projects, credibly sell in green or sustainable financial instruments and explain what they are about, and report about any potential greenwashing instances. So we absolutely need to get this right. That is why the most recent decision of the Polish Sustainable Finance Platform was to launch an education and skills working group, which will focus on measuring the market, so seeing what's available, what is the gap in terms of equipping people with skills to be able to serve financial institutions, to serve as chief sustainability officers at corporates, to be able to provide this very professional advice and service. We're going to look at what are the standards amongst these available trainings and postgraduate studies, because we know that whilst some of them are really top-notch and really good, some of them not necessarily stick to those standards, simply because there is so high demand and not enough professional supplies. So we're working with universities, but also with the corporate sectors to get that right. So I think this education is an absolutely fundamental thing within the sort of sustainable finance development roadmap, and it's not something that will become important in 5, 10, 50 years' time. It's important now.
Very, very true. Thank you. And good message. I'm going to open up Slido. Apologies, Martin. There's a lot in here on.
I will make another note.
Yeah. Are you ready? I'm going to start with one thread that is coming through. So a lot of what we focused on, specifically with the taxonomy, is about environmental sustainability. But obviously, these SFDR products consider both the environment and the social aspects. So what tools, if any, are available to measure social performance? Are there any plans within the Commission to develop social tools?
Look, when it comes to the tools and instruments, there were two that the Commission developed. The first one is climate benchmarks, and I see Elena, who was the author of the architecture of the work, which is focusing on climate. And then we have the European Green Bond Standard, which is focusing on the environmental, on the letter E. The Commission has not produced, and again, we have not harmonized the the benchmark, so we have not harmonized the European Green Bond Standard. We have introduced minimum degree of requirements that have to be met. So again, this is not a full harmonization, this is a kind of framework within which the instruments can be sold. Now, when it comes to letter S, the Commission has not produced any piece of legislation or that would introduce a tool or instrument on S. We are currently working on exploring options, I would put it carefully, whether we would need to do something on the ESG benchmarks. We have carried out a study that has come to the conclusion that there is a space to do something, but the Commission has not yet decided on what we will do about the ESG benchmarks. But here I would like to make one important point, and I hope that Lubomir will like it, is that we don't believe that we necessarily have to regulate everything. I just mentioned that this agenda is supposed to be an enabling agenda. Indeed, there is a very important part which is regulation that provides the transparency, integrity, and clarity, which is taxonomy. But then there is a space that the financial sector should occupy, and I would say even a bigger space. They should play with the tools and the transparency that we are putting forward. But we are not telling you how fast or what exactly. This is now in your remit. And I personally do not believe that we have to regulate every single standard or every single label, like the sustainability linked bonds by NL that was mentioned, or that we would have to, regulate and harmonize everything that moves. This is a playing field for the sector. The financial sector is very well known, for good innovative engineering. And we do not want to kill innovation. So here, you have a lot of space to make impact. And what we are going to focus now in the next 1.5 years until the end of the mandate of this Commission is first the usability that I mentioned, transition finance, and bringing impact. I do believe that we need to start talking about how we switch the conversation from why and what into now how fast, and bringing the impact on the market. But that's in the hands of the financial sector and the corporates. Have a conversation how this transition will evolve, and that will not be coming from my office.
Thank you, Martin. Another question, if I may, to you. So you'd mentioned that your only kind of, or your final piece of legislation for this commission is going to be ESG ratings and scores. There's a question in here in terms of some supplementary Q&As and guidance for the market on taxonomy and SFDR. Is there still that within the plans for the commission?
Yes, in 4 weeks' time, and I was just working until 1:30 precisely to finalize a document that we will publish in mid-June that will bring clarity into the questions that stakeholders have asked about not only taxonomy and the SFDR, but also the interactions of these pieces. And I mentioned the concepts of safe harbors, also the use of estimates and how these pieces can interact in harmony at the end of the day. Just to give you an example, if you have a climate benchmark that is recognized by the EU law, then you are automatically recognized under the SFDR, under the concept of sustainable investment. Or if you have, and this is something that is still being prepared, if you have taxonomy-aligned investments, then there is accordingly appropriate treatment under the SFDR, so that there is not a double burden imposed on the industry because there is some misalignments of the definition and concepts that, again, unfortunately arose due to the negotiations.
Brilliant, thank you, Martin. One question, I'm going to open this to the whole panel, so let me know which one of you want to take it. So for SFDR in particular, and I think this maybe touches on the point Martin raised, so half the market are saying, tell me exactly what I need to do, Martin, prescriptively, and I will do exactly what you tell me to. And the other half is, give us a bit of breathing room and some creativity and some space to operate. This question, I think, is coming from the place of, I'd like to know exactly what to do. So given that SFDR is a tool for disclosure, predominantly to the retail market, and maybe Lubomir, I'll open with you, is there the concern that those receiving that disclosure understand what they're receiving? Its complexity and content, is that being well received? And I know you deal mainly with institutional investors, but do they understand the content you are now disclosing to them?
Yeah, well, I think that the taxonomy as such, or any creation of a vocabulary that is kind of defined and helps people understand what is being spoken, a kind of dictionary in explanatory form, is good in a sense that it helps people to understand what is the common ground. However, and that's my personal belief, is that there needs to be a space for interpretation. There needs to be a space for a judgment. These are not hard-coded things. I mean, it was rightly mentioned on the E, everything can be easily measured, perhaps. Not everything, but a lot of these things can be easily measured and can be put on tables. On S and G, there's lots of efforts to try to translate these inputs into numerical forms and try to work with them to create the ESG ratings that have been mentioned here. And the transparency around how those ratings are designed, I think it is something that investors are rightly questioning or asking, what does it mean? And if from one provider we have a rating of this, and from another provider there is a different rating, how do they compare? So there is something that we will need to get used to in working with these inputs. But any financial analyst, any credit officer is creating a vision in analyzing a company and a project on his own belief in how he believes the company is presenting to him. The analyst needs to create his own plan for the company or his visualization of how the company is going to create a business plan. It needs to, the analyst needs to figure out whether he believes or doesn't believe what the company is presenting to him. So I think that work on the analyst side to actually dig into the data and work with it will not be eliminated. And I think it's something that will be needed, and I think that is good. It's good because I think we should not be striving for the world where we are all thinking alike, that we have all the same. That's what is making us the diversity that we are trying to reach. It should be diversity of the opinions. Also, there will be competing business plans. So if this company is wanting to achieve this, how come the other company is trying to achieve the same and they are competing against each other? So I think the space for the interpretation will need to be preserved.
Yeah, thank you. I don't know if moderators are allowed to voice their opinion, but I certainly agree with you. In terms of the freedom, that anecdote I always give is going into a health food store and choosing cereal bars. And you and I may have very different opinions about what health is. I might want organic ingredients. You might want keto, low carb, who knows? But the product range is available to us for our own individual definition of health. And I think that freedom's really important. Katarzyna, I might just ask a question to you, actually. So we've talked a lot about the taxonomy as it's applicable to the private sector. Public sector use of the taxonomy, is that something that's being considered? I know it's not mandated, but...
Well, it's certainly ahead of us. Mm-hmm. It's certainly ahead of us, not at the moment not being considered by public sectors in Europe, but I think we will absolutely need to get there. I mean, public sector needs to be needs to serve as the good example, not merely a follower.
Perfect, thank you. I'm very conscious of time, and apologies, people. There's a lot of lovely questions here, but maybe if I will, I might jump to some concluding statements. And the concluding statement I'm really interested in the group making is, our title is, Can Europe Lead on Sustainable Finance, and Will Its Policies Deliver? And Jessica, I'm gonna start with you and then maybe move round to Martin. We might know what we think his answer will be there. And Jessica, if I could ask you that.
I strongly believe that it will deliver, although there is a room for many voluntary actions as well, as Martin said. Not everything has to be regulated, and there is room for interpretation. But I guess the big question is how the play is being structured. What are the rules for what comes first, what comes second? So I especially like the question about the disclosure for retail investors, right? The thing is that sometimes we think that this is my personal view, but then we would like someone else to take responsibility for that, and that's what happened with financial sector before, right? retail investors want something, but then they are afraid what they want, and after some time they come back and said, we were not aware that this is what we want, yeah? So this is something to put to the discussion more, so we will not end up in the places that we have been before, right? So this is what we are taking responsibility, but as a financial institutions, but where the line is. Is it a hard line or, yeah? So this is, I think this is up to for another panel to discuss. Thank you.
Katarzyna, will Europe deliver?
Well, I kind of think we already are, aren't we? We are already a leader in sustainable finance in so many dimensions, in the volumes of sustainable instruments being issued, on the complexity but also comprehensibility of the regulatory framework around it. So I think we're certainly on a good path. Obviously, there are certain challenges here mentioned by both Agnieszka and Lubomir, like the complexity of the regulation certainly adds to cost. There is a lot of uncertainty at the moment, which there always is with European regulation, and as we will definitely see in a couple of years, it will sort of sort itself out with the help of policymakers and the entire sector. But I think a strength that comes out of it is credibility. Because we have all those regulations, because we are very transparent and strict about what the standards are, we can credibly say that if you as an investor, either institutional or private, are buying a sustainable financial instrument in the EU, it is genuinely delivering on that promise of financing more climate-friendly projects. Two things happened recently, which I think are very good, but certainly the institutions involved don't see it that way. First of all, we saw a big decrease in the number of sustainability or ESG listed funds. Great. It was a result of higher standards, so issuers had to actually reconsider whether the funds are genuinely sustainable or are they in name only. The other thing is there was a Polish company which issued sustainability-linked bonds, and unfortunately they did not deliver on one of their climate KPIs, so their cost of capital was increased. Again, not great for this company, but in general, great. The system is working, the framework is working, so we as investors can be certain that when we buy sustainability-linked bonds in Poland and the issuer does not deliver on its climate objectives, there will be consequences. So I think we're on a great path to being the leader. We already are.
Lubomir, do you agree?
Well, I'm just wondering whether that actually is a question that we should be asking ourselves, because I think it, in a way, we see sustainable regulation all around the world, and because these things are not trying to resolve issue in a one particular geographic area, they're actually trying to resolve a global issue. So I think that it's good to have a leadership here and there and to come with ideas, and it doesn't matter actually where they come from, as long as they are adapted for the greater of the whole world. And I think that's from my perspective, or what I have seen is that the regulation is really coming from places all around the world, and it's enormous wave. And I think that sometimes some people think that it's only Europe actually trying to bring or impose the regulation on itself. And I think it's just a wrong optics because it's happening everywhere.
Certainly is. It's over 30 taxonomies in development internationally. Many of them are taking the EU as the kind of beginning boilerplate. So Martin, your opinion, will your policies deliver?
I spoke a lot. I will focus on the end because I agree that it's the end that matters, not whether we are leading or comparing ourselves with the UK. Well, I will tell you, I hope so, but I will tell you what the responsibility of the policymaker is and what the responsibility of the market is, because that will very much depend on the answer what we are going to do and what you are going to do. On what we are going to do is that I think that now it's the right time to stop legislating and regulating and rather focusing on, as I said, make it work on the ground and be there to support your implementation and clarify and be also open to hearing the challenges that you are facing and being able to resolve them. And I'm not telling you because I would like to be nice or this is in my political notes. This is really a genuine effort of the Commission. So those of you who are interested in the practicalities and the details, how this agenda can work, please reach out to me. This is what I am going to do for the next 15 months in my job. Now, there is another angle that Lubomir, you mentioned, which is the international. EU will not deliver on its own. We are obviously working with our international partners. We have already heard, I mean, what the other standard setters are doing. We need to work with the others and try to converge where we can. On the double materiality, we will not compromise. We will push our EU agenda very strongly, but there are ways where we can converge. Now, my second, and this is my final conclusion, is the impact that you will bring will be decisive here. So whether the policies will deliver, I cannot answer that. The answer is in your hands.
Excellent concluding point. Thank you, Martin. Thank you, all my panelists. Julian, Linda, am I handing over to you? Julian, go for it.
Did it work? Hello, good, working. Thank you so much, Nadia, for the masterful moderation here, and thank you all the speakers for joining the discussion. Really insightful and inspirational, as we hoped for. Now, we will take a short break. We are running a little bit on a delay here, but let's take maybe 20-minute coffee break, enjoy some coffee and refreshments in the hall, and then we will meet here in, let's say, 10 minutes, maybe after 11 for the second part of today, which will focus on ESG ratings and ESG data. So we'll see you soon. Thank you.
Thank you very much, Linda, for this kind introduction and for the invitation. And first of all, I need to apologize because I'm going to sit down immediately. I'm recovering from a rather painful back surgery, and so I better don't risk it. Thank you for your understanding. It's a great pleasure to be back to Prague and to talk about sustainable finance. But before I do that, let me say a few words about myself and why I'm so moved by this situation. I became for the first time European Affairs Minister of my country in 1994, having just begun to digest German unification and the overcoming of the division of Europe. And at that time, we negotiated, or began to negotiate, the preparation of the Central European countries for membership in the European Union. I would never have imagined that by the year 2023, we would sit at such a high level, but also future-oriented, innovation-oriented conference here in Prague, bringing together people from all over Central Europe and beyond. So congratulations on that enormous achievement here. And at the same time, I was remembered when I took that cabinet job for the first time in 1994, that I was asked what European integration means for me. And I said European integration is the tool of the European Union member states how to organize their survival in the globalization process. Now, globalization is not so much popular anymore because we are more afraid of fragmentation in this world. But first of all, we see, and this is why the sentence is still true, the shift of the balance of powers in this world is enormous. And at that time, I think I have the figures rather correctly, the member states of the European Economic Community at that time produced something like 37% of the world's GDP. This is down to 13% now. So we have to make sure that we don't miss our interest in the world. And this is why it's crystal clear that in 2023, it's even more true than in 1953 when Jean Monnet said, let's be honest, our countries have become too small for this world. We need to do it together. Now, I'm delighted to be here today and kick off the discussion on sustainability in finance, and that's pretty much in the DNA of EIB. EIB has been the EU's climate bank already for a long time, not only because we are one of the world's largest climate financiers, but also we are the pioneers in green bond issuances. And that is quite remarkable because in 2007, when my colleagues from the bank invented green bonds, and I think some of the inventors will be present here during this conference, Ayla Krevi in particular. She's the mother of green bonds and sustainability bonds. When she and her colleagues came to the market with this project of sustainability bonds or green bonds, whatever I would call them, that was considered totally lunatic idea. Can't work. You're going to hit the wrong targets. And nowadays, you know what kind of volume we are talking about. So we have been associated with this issue for decades. This winter, the European Union has weathered a historic energy crisis. And let's not fool ourselves, we have been lucky because the weather conditions were not as critical as they could have been, with much more even adverse effects on for the energy supply of our people and our companies. The European Union is putting an end to a massive dependency on Russian fossil fuels, and we are doing it all without derailing the Green Deal. This is very important because I was present yesterday in my capacity as member of the committee of the Prix Charlemagne, the most prestigious award that is being offered once a year to a political leader or a country. And yesterday in Aachen, it was awarded to President Zelensky and the Ukrainian people. it is really quite remarkable that we have managed not to get the energetic transformation and the green transformation derailed during the process of dealing with the Ukraine crisis. And I even go one thing beyond it, one step beyond it, and maybe you think, what does this have to do with this conference? But if we say we are living in this world, then I'm not only talking about industrialized countries and the relationship with the United States of America and Japan and China, Korea and others. We're talking also about the countries of the so-called Global South. The countries of the so-called Global South, they have the suspicion that the more we deal with Ukraine and getting our act together in the European Union, the less we'll take care of the needs of the developing world. The facts and figures speak a different language. We have managed to be outgoing and active in the developing world at the same time when we address the climate crisis and the agenda transformation. And this is important because if we want to have the countries of the so-called third world also going with us with the next decision in the General Assembly of the United Nations when it comes to Ukraine, for instance, then we better take care of them and put them into a context and not allow ourselves a dreaming, for instance, of green hydrogen, about green hydrogen, meaning that we bring the production for high advanced electricity production capacity to Africa and Latin America with the geothermal installations with much more solar energy, in particular with wind farms, floating wind farms. And then we are capable of the electrolysis production for the production of green hydrogen. Then we put the green hydrogen on pipes or boats, bring it to Europe, and the further industrial production takes place in Europe. This is not the way the world will work in the next decades, and the next century. And the president of the African Union, Macky Sall, whom I know quite well because we cooperated particularly with him, the president of Senegal, when we found, or we helped a company finding the first real successful vaccine, BioNTech/Pfizer. Pfizer is the marketer of the whole thing, not the owner of the intellectual property. And this is something that we must be able to perform also in the future vis-à-vis the countries of the South, because Macky Sall asked me, you know, when you use our green hydrogen, instead of allowing us to tap our natural gas sources, because that is not green enough, then you do the same thing you have done 200 years ago. You're just exploiting, this time, the production possibilities of green hydrogen in Africa and the industrial production, and the benefit goes to the citizens in America and Europe and elsewhere. So what's in it for us? So please, ladies and gentlemen, when we address these wonderful issues of sustainable finance that you have put on the agenda, think global, because otherwise we are going to miss our opportunities and responsibilities in this world. So we turned the energy crisis into a green energy sprint. The member states of the European Union are adopting new targets and measures to accelerate energy efficiency investment, deployment of renewables, and the expansion of our power networks. Our most recent climate investment research at EIB showed that more and more firms are engaging in climate action. Over the last year, the share of European firms investing in climate has increased by 10%, reaching 53% on average. And the increase has been particularly pronounced in Central and Eastern Europe. What we have achieved over the last year, triggered by the Russian war in Ukraine and following the European Commission's Repower EU plan, has been unprecedented. And we'll see more to come, that's for sure. We at the European Investment Bank have stepped up our ambition and activities and stand ready to provide extraordinary support to the European Commission's Repower EU plan. The EIB Group has always adopted first measures to address the growing gap in green infrastructure. In October last year, we committed an additional 30 billion euros to accelerate investment in clean energies, and this comes on top of what we would lend to the sector every year anyway. Last year alone, we have invested a record 19 billion euro in clean energies worldwide. 19 billion. And I'm happy to say that our support to the energy sector in the Czech Republic has reached nearly 1 billion euro. Majority of this financing is in support of the reinforcement and refurbishment of the Czech electricity network, even though there are promising signals when it comes to the decarbonization of our economies. It's not enough. The evidence about the climate crisis becomes more alarming by the day, and the decisions we make, investments we support in all parts of Europe and the world support the transition to a carbon-free, energy-independent future. In other words, these have to be sustainable investments. We need to prioritize green energy, clean transport, energy efficiency while reducing carbon emissions and strengthening Europe's resilience and ability to fight future crises. Investment in climate action is not only a necessity in the fight against climate change, but it's also a great business opportunity. And I cannot emphasize this enough, because if you look around this world and see where has Europe arrived at after the last 4 or 5 decades of global competition, when at the beginning we had been ahead of the others in most areas. Nowadays, it's in particular green technologies where the Europeans still have an edge. And I emphasize still, we better speed up in order not to lose that edge as well. The net zero economy will grow exponentially over the coming decade. By 2030, it will have reached 600 billion euro annually, according to the International Energy Agency. And this is an enormous chance for the EU. We need to grab it. So instead of dwelling on doomsday scenarios from morning to night, we should rather adopt somewhat more of a can-do approach. Yes, we can solve that if we systematically link climate, innovation, and development. This is also a very timely chance also for the Central Eastern European countries, where the sustainable green and digital transition may trigger yet another level of motion. So we at the EIB have the tools to make such investments happen. We provide loans and financing instruments and offer many billions of euros each year in patient long-term financing that makes risky projects more palatable for private investors. By the way, if these were not risky things, then there would not be the need or justification for the intervention of a public institution like a bank that is owned by 27 member states of the European Union. We must address market failures, not areas where Erste or Deutsche or whoever can do the job alone. Speaking about the Czech market, we have recently invested for the second time into Invent Capital, the clean tech fund investing across the region to support even more digital success stories. We are launching a new fund of funds to boost digital and AI investments in the country via our subsidiary, the European Investment Fund, and in close collaboration with the Czech Ministry of Trade and Industry. And I think our colleagues from EIF will be here this week as well. In the past, our finance products led to major breakthroughs. I've already mentioned BioNTech for the vaccines. We financed 40% of Europe's offshore wind capacity, and we are supporting the first European battery gigafactories. So, ladies and gentlemen, we need a new green pan-European investment initiative, and that needs to include, and now the pessimist in me comes up, better regulation, global partnerships, and targeted financial support. And again, please, let's adopt a can-do approach. Yes, we can master that. The European Union's Commission's Green Deal industrial plan is the first step in this direction. Most importantly, the financial pillar of such an initiative must be sustainable, sufficiently diverse, offering both long-term patient financing to massively roll out financing of green energy, as well as support for SMEs, innovative SMEs in particular, and mid-caps through venture capital in private equity to incentivize companies to develop and scale up new cutting-edge clean tech technologies in Europe. Yes, we are, in some countries of the European Union, quite good in helping startups, but we are pretty bad at helping scale-ups. Because when these companies turn out to be successful with their small new developments, then all of a sudden they are becoming interesting for non-European superpowers, and then they're gone. We need to help these companies to scale up in Europe and stay here. The EIB is committed to enabling the EU to lead the next wave of breakthrough innovation. Our goal is to drive new technologies that solve the challenges of our time and help Europe's innovators to become global technology leaders. So let me conclude, ladies and gentlemen, by saying that sustainable investments remain crucial for growth, and they're also key enablers to making the green transition possible. You can count on EIB's support to make this happen. Thank you for your attention, and as you have a very interesting week ahead of you and the lineup of speakers is impressive, I wish you all fruitful discussions. Thank you very much for your patience with me.
Thank you very much, Mr. President. Thank you very much for the inspirational and very positive, forward-looking remarks as well. And now we'll move to the second keynote of this block. Mr. Gabriel Marosi, the Chief Sustainability Officer of Erste Group. The floor is yours, please.
Julian, thank you very much, and thank you very much for the invitation as well. I am very much pleased and honored to be here today, and this is my very personal excitement that we have these discussions for a couple of reasons. But before I would just go into that, let me also thank to the organizers, Linda, Julian. You are doing a great job. We can see already on these couple of first discussions that the event is addressing the right issues in the right spirit. So I wish that it is continuing then in the remaining days as well. Now, still let me come back for a moment for my personal excitement, why I'm so happy that we have these discussions here. And I was also very much listening what Linda said at the introduction. It is very important to know that we are not alone. And in this sense, we as bankers, we are very kind of proficient, to speak about liquidity, capital allocation, profitability, margins here and margins there. But these discussions which started now and today is a remarkable day as again, in that sense, discussing sustainable finance, and sustainability is about the future. So sustainability finance is financing the future. Is really something which is giving a further mandate to the banking, I do believe, also in the future. And just that you also see that, these discussions are not led only in these kind of salons and rooms. I'm just coming last week, we were in Croatia within the commercial real estate community of Erste Group, 150 bankers were discussing where we need to arrive in 2025, 2030, 2035. We already have had the picture on our portfolio, which are the assets which are currently fitting to the future standards, and which are those assets which are not fitting eventually, which are already foreseeable, can be treated in intensive care because they might become strangled assets. And the questions, what I received is how we can do it. And the answer is here today in this room. We can do it because we are not alone in this game. And I will come to that, but let's move also to the topic of the discussion about ESG data and the ESG ratings. I need to say, I think that I prepared some slides. The green is the boom, or okay, good. So before I would show you some of my thoughts, also I wanted to lay down the ground that I do believe that sustainability is a systemic shift. It's a behavioral change in the economy, it's a behavioral change, necessary change in the society. But to make this change, we need simple currencies, because we know that the currency, and not just the monetary value, but currency is something which is moving ahead the things. So we need to have such a currencies which are simple, which are also low cost at transactions, and which are also sufficiently common currencies, right? I do believe that we have seen this discussion in the morning panel already, which is addressing this issue. But the theme of currencies, I would like to somehow promote further in this presentation. I also would like to pay a tribute to Mr. Spolz and the DG for the financial stability and the financial markets, because you are doing a great job. Because to be honest, when the Commission announced in 2018 and then 19 the Green Deal, previously the Sustainable Finance Action Plan, it was very hard to foresee how this can be, brought into motion. What we will see in 2 years' time, 3 years' time, and how the market will be able to digest all of these changes. And what we see today, that out of the 10 points of the Sustainable Finance Action Plan, many of the things are now getting very concrete and already an implementation, concrete shape and implementation phase. We discussed the EU taxonomy, we also touched SFDR. We are just heading, to the last preparations on the CSRD, and we have big projects on that, how to implement all the requirements connected to this reporting obligation. And I very much hope and wish that also we will see the CSDD, the due diligence directive, coming to light as well, because all of this is helping us to, put up the gears and make the train move. But we also should see that all of these regulations, all of this legislation is relying heavily on the ESG-related data. So the capability of the market to generate this data, to originate this data, to report on the data, and also to integrate the data into the processes will be a decisive success factor where we are going to arrive in the next 2 years or the next 5 years. And just, to bring you a little bit of the light, we see already that the asset managers are now in the final stage of disclosure of the principal adverse impact assessment. So we will have very interesting data coming in. The companies are actually this year already disclosing their taxonomy alignment, and just by any coincidence, a couple of weeks ago, ÖMV, very prominent company in this region, disclosed their sustainability report. And I need to here complement again what has been said. There you will find their 0.1% ratio of the turnover alignment. But you will find there 9.5% ratio of the capex. So the future, investments, and the future investments, I do believe, will translate into the future turnover as well. So we see that the market is moving, and of course the banks are not exception out of that. The banks already disclosed the first round of taxonomy reports for the 2022 year. We are now looking very carefully and started to collect the data for this year taxonomy disclosure. But of course, we are also disclosing in a couple of weeks. I do believe we will see it from the majority of the banks, the Pillar 3 disclosures, providing a huge set of already valuable data, be it on the side of the portfolio structures which are aligned to the future environmental objectives, be it on the side of the EPC labels of our collaterals, which is mostly real estate, and also partially already the exposures toward the high emission sectors. And next year, additional information is going to come. So all the market participants, be it asset managers, be it companies, be it the financial institutions, are now moving with their reports. And I would just like to encourage you that you are taking very careful look into these appearing figures, because this is showing then the impact. Now, let me come then to the field of my expertise. As a banker, of course, I like to speak about banking. So what are the challenges with what the banks are facing? And of course, we have each quarter, the presentation of the results. So we have, the pressure from our investors. But beside of that, the second most important party for us are the regulators. And I need to say that ECB is putting quite high attention and scrutiny on the banking sector, how the banking sector is implementing the climate and environmental risks, risk management. And on that front, I just looked at as well into the report what I just forget to share with you my thoughts also in writing. So the currencies we have seen, the action plan we have seen, and now let me come to the challenges of the banks. Coming back still for one thought on the regulatory front, we have seen last year in November, ECB disclosed the first round of observations from the thematic reviews on the climate and environmental related risks. And I need to say that the conclusion coming out that 55% of the banks are already progressing relatively well on the implementation of these standards, and approximately 10% of the banks are trying to ignore the reality. Now, this 10%, if I understood right, the report already received additional capital requirements. So I do believe that the banking sector is moving ahead very strongly. In the first phase, we implemented questionnaires to our customers, especially to the large corporate customers, to start the data collection, and also to have a basis for our forward-looking assessment, what is ahead of the banks concerning the climate impacts and the impacts through the economy. And you can see that challenge is not just to collect the data, but to translate the data in a horizon of the next 5, 10, and in the stress test, even 30 years horizon. So we have a very big demand and also a very big reliance on the data and the data quality which is coming in. Now, we should not forget that the data is not coming just by coincidence. The data is coming from our customers. And therefore, it's very important to understand what are the customers for the banks in the Central and Eastern European region. And we need to see that we are part of the supply chains. Largely, these economies are part of the supply chains of the large international companies. Therefore, it's not surprising that most of the balance sheets of the banks are loaded with SME exposures, but also on the other side with real estate related exposures, especially housing loans. Now, you might ask, good, then what is the common with all the regulatory framework, all the legislation which is coming, which is addressing the large companies, typically having 500 and more employees, and having a relatively high turnover threshold? SMEs are not meeting that. Households are not meeting that. So the challenge of the banks in this region is collect data from economic players who are primarily not necessarily subject of the obligations. Point number one. Point number two, these economic players typically also do not have not just the motivation, but also the means to build up awareness, build up knowledge, and to produce this level and this quality of data what we need. So coming to the banks of this region, I do believe that in the coming years we still will need to invest a lot to awareness raising of our customers and creating mostly a kind of, as I mentioned, these single currencies, what the broader society can accept, can understand, and can translate. Now, in this sense, I would like to point out two currencies what I do believe will be decisive in the future. First is definitely the greenhouse gas emissions. The greenhouse gas emissions are resulting to the climate change, and therefore they are the primary target for us to manage and to reduce them. And we should ask as well, do we have standards which are clear and intuitive enough in the greenhouse gas emissions, what a typical SME can implement without substantial consultancy cost? Do we provide sufficient support for the SMEs for this very simple and elementary measure like the greenhouse gas emissions? And I need to say that coming back from our surveys and the interaction with SME customers, we see here a big gap. So this is what I do believe, that one of the essential points what we'll need to close to move the CEE region into the direction of reducing emissions effectively and having a societal support. Now, I do believe also that it can be done. It can be done through digitalization. This is into what we are investing as well. And I do believe that the digitalization can bring this topic also close to the households, that they do understand what are the emissions behind their housing, behind their mobility, and behind their daily being as such. Let me also very briefly just mention a couple of very good examples, what I so much appreciate because they helped us very much to implement all these measures leading us in the trajectory of toward net zero emissions in Erste Group. Firstly, I need to say that I appreciate very much the PCAF initiative, Partnership for Carbon Accounting Financials. This is a great and a revolutionary thing what 14 banks, Dutch banks did in 2015, starting to develop an open source standard. They gave it available to everybody. And I need to say that the methodology is very simple and intuitive. You can implement it without substantial investment costs. It provides you a certain level of accuracy. And mostly the methodology comes also with emission factor database. So you have everything in place to plug in based on your portfolio structure, the calculations, and receive, the calculation results. Of course, you can invest more, you can collect exact data, and you can plug in also the exact company data. I do believe that, this model shows that the sector, the financial sector, is investing into building up the new concept. And we were happy to join to that. I also need to mention the second, my favorite, CDP, the Carbon Disclosure Project. In our endeavor in Erste Group, when we implemented a whole set of, the inventory of our emissions, and some of my colleagues are sitting here who were coping with this issue, we were just, facing many times uncertainties. How to interpret the methodology, but mostly, do we fit into a kind of market consensus, a market standard? And CDP is, although it's quite demanding, to fill out all the questionnaires, but it provides, again, something very valuable. It provides you the possibility of a detailed benchmarking. Benchmarking yourself, benchmarking the market, and see also where the whole industry is developing. So I do believe that in the future, in the coming discussions, we will have here also people from CDP initiative. So I do believe that this is something what is going to be taken forward. And then let me just, in the remaining 0 minutes, come to very few thoughts on the ESG ratings, because this is also a topic dedicated to the ESG ratings. And I need to say, I am a believer of the ESG ratings. We are, as bankers, we are making daily decisions based on ratings. Erste Group, as such, in this region is allocating yearly 40 billion euros new money. All of these decisions are taken based on ratings. We cannot do sustainability-related decisions without ESG ratings. Now, the second part, also why I do believe in the ESG ratings, is that we have seen that these rating agencies have a very enhanced data collection capabilities. And I, again, do believe that this will be necessary for the transition to build up sound and reliable and available databases. Now, let me also just quote a couple of points where the ESG ratings are still, have what to do. So firstly, what we see is that the ESG rating universe has at this moment a very small overlap with the CEE region. What we have seen is that this is approximately 5 and definitely not then 10%. This is not enough. We need much more focus on the CEE region. And of course, this is connected, to the availability of the information. But I do believe that there is a way. Secondly, we have also seen that this kind of unsolicited approach, what the ESG rating agencies are following today, leads to a very high volatility of the rating assessments. I do believe that that is something into, again, we need to invest. And the third part, where we also do see that, the very different approaches of the ESG rating agencies are resulting into a very different assessment. Typically, in Erste Group, we are applying 3 or more ESG ratings together to have a kind of holistic and comprehensive assessment. But those who works with ratings, scorecards, etc., knows that the more information you are combining together, the more noise you are getting into the system and you are losing the accuracy. So, combination of the ESG ratings is not a solution, not a long-term solution. So I am very much, very much confident that most of you are facing very similar issues, so I will not go into that. Let me just then close my thoughts that I do believe that the ESG data is a challenge, but also an opportunity. And the opportunity, as I mentioned, this is coming mostly through the establishing currencies which are understood by the economic player, by the society, and that can bring us, forward with a much bigger confidence and with a much bigger impact as well. So thank you very much for the patience, and thank you very much again for the organization providing us this chance.
Thank you so much. Thank you very much, Gabriel, for really solutions-oriented and forward-looking contribution as well. Thank you once again to Mr. President Hoyer. And now, thank you for opening the topic of the next discussion too. So now we are moving to the panel discussion of the second block, and I will very kindly welcome the speakers and the moderator to the stage. So maybe if we can start with the moderator, Lucy, if you can please join us here. So that Lucy Fitzgeorge Parker from the Responsible Investor. And then I think we can continue from this side. So Elena Filipova from London Stock Exchange, and we have Julien Mazzucarty, senior economist from ESMA, Philippe AB from Reprisk, please, and Kateřina Bohuslava from the CEZ Group, please welcome to the stage, and also Hakan Lucius from the EIB, please come to the stage, and I will Lucy introduce you even in more detail. So thank you very much.
Well, thank you very much for the introduction, Julian, and thank you for inviting me to this conference. It's great to be here. As it says on the board, my name is Lucy Fitzgeorge Parker. I'm the editor at Responsible Investor. We're a London-based publication. We're one of the oldest publications in the sustainable finance, and we're the main international media partner for this conference, which I was very keen to be part of because before I moved to covering sustainable finance, I covered CEE for 12 years. It's a region that I know well, and very pleased to see how much has been happening in sustainability here in the past couple of years. But on to the discussion for today. ESG ratings. Well, we have already heard quite a bit about ESG ratings from several people. We've heard that there is quite a lot of criticism of ESG ratings. We've had a relatively rare vote of support for ESG ratings from Gabrielle just now, which is great, but still, obviously, some suggestions on how they could be improved. Before we get started on discussion, I'll just ask everyone on the panel to introduce themselves very briefly. Hakan, would you like to start?
Well, thank you, Lucy. I'm Hakan Ducios. I'm head of corporate responsibility at the European Investment Bank, and thank you very much for the organizers for this great opportunity.
Yeah. Good morning. My name is Kateřina Bohuslava, and I'm Chief Sustainability Officer at CEZ Group, and we're happy to sponsor this event.
Good morning, Philippe AB. I'm the CEO of Reprisk, ESG data provider.
Mm-hmm. Good morning, I'm Julian, I'm a senior economist at ESMA. This is not a household name, so ESMA is the pan-European regulator of financial markets, and we closely collaborate with the European Commission and national competent authorities also.
Hi everyone, Elena Filipova. I am the Global Head of ESG Solutions at LSEC. And under that family, we have Refinitiv, FTSE Russell, Beyond Ratings, to name a few. And we are ESG data, analytics, and index provider house. And congratulations to the organizers for an excellent summit.
Great. Well, we have a very good range of perspectives here to discuss ESG ratings. Now, as I say, there has been a lot of criticism. The criticism has ranged from, I think perhaps what we'd all agree are some valid concerns about maybe transparency, conflict of interest, I know has been something ESMA has been concerned about in the past, correlation, even to, we had some talk about the US anti-ESG movement this morning, and ESG ratings are apparently woke, according to the US politicians. But what we haven't actually heard yet is a perspective from a corporate. I mean, obviously, Katerina, you're on the other end. We're mostly talking about this, about how people use ESG ratings, but you're on the other end of the spectrum, as it were, in that you are the ones who have to provide, or you get rated, and you have to provide the information for ESG ratings. Now, I know that CES has done very well on the sustainability reporting, has won awards for that. How does it look from your perspective? What are the sort of pluses and minuses of the process for you?
Well, actually, I could sum it up in one word, and that's frustration. But let me perhaps give you a little bit of context, because sustainability reporting at CES rests on 4 legs. Imagine a desk with 4 legs, and the first one clearly is legislation. We are compliant with legislation. But then there are also reporting standards, and although they're not mandatory, we are reporting according to them because we believe that they're standards for a reason and they provide clarity. And then, of course, because we're a publicly traded company, we do get rated by ESG agencies. And it started by unsolicited ratings. So there are agencies that we don't even know rate us because we don't communicate with every single agency there is. And then the 4th leg actually is competition, our peers in the market. And why is that important? Because some ESG ratings are not objective in the sense that they rate your performance. They also have a relative element when they compare you with your peers. And that would be fine if we were comparing comparable things. But you do have geographical differences that physically constrain what you can do, and that's true for energy sector in particular. You also have different legislative landscapes. If something is mandatory in Western countries, it's much easier for our competitors to achieve, where when I'm dealing with it in the Czech Republic and I'm talking to my suppliers, for example, all I can say is pretty please. So that makes it more difficult. And the fact that we don't understand methodologies, that they're conflicting, that ESG rating agencies measure different things, that the methodology changes over time, that if you do want to get white glove service, sometimes you have to pay. Now, let me be clear, I'm not saying that we pay to get better rating. That is not possible, that is not the case. But with getting better service, with understanding the map better, it's much easier to achieve your goal. So, and then I mentioned competition. If our goal, or CES Group's goal, is to be among the top 20 best rated companies, and I look at my competitors and I see one company in the 80th percentile with one agency, and in the 20th percentile with another agency, how does that make sense? So we're very data-oriented. We believe in data because we believe that data-based, evidence-based decisions are best, but the data must be good. The quality of the data should not be compromised, and we should be able to understand that. And I think that's not the case. And then there is a second aspect, and that's communication, because a lot of information gets lost in translation. And I mean that literally, translating from Czech to English, which has been tough. But then also in communicating the right things. We need to make sure that our reports are AI readable. We need to make sure that English speakers, both native and non-native, find the information, that we use the right keywords, and that we include things that in this region at this age are taken for granted. For example, we did not declare that we don't employ children. And that we're against child labor because it was something like, why would you declare that? That's a given. But you have to, because ESG ratings are global, and we need to think globally, and I think it's been said, we need to compare ourselves to a large set of our competitors and make sure that we communicate everything, because not providing information is also information.
Okay, great. Well, Philip, as a ratings provider, there's quite a lot of things that have been brought up in terms of some of the issues with the sector. Maybe, well, I'll let you decide where you want to start with addressing some of them. Whether it's transparency, whether it's the question of sort of different jurisdictions. What are you hearing sort of the key issues with ratings, and do they match what Katarina has been expressing?
So let me start with the key issues, and then maybe we talk also about risk, how we deal with that. But Gabriel, so you said you use EM because there's no other way that you basically can deliver in terms of allocation, etc. It's the only way you can basically deliver the products or the portfolio construction, etc. And this goes back to this convenience argument in a way, and I really would like to challenge practitioners and say, why do you use something that have really very serious issues? And I made it very personal, Gabriel, I'm sorry, but what are the issues that I see as the most severe ones? And I think I see 4 of them. Let me see if I can remember 4 things. The first of all is the argument that there's a diversity of opinion, right? Like a sell-side research, you know, is that fairly valued, this company or not? This argument, in my view, is not valid at all, because if you look at the most downloaded scientific paper, this aggregate confusion paper that looks actually in the mechanism how these ratings are done, then you see the 3 elements that determine the outcome. First of all, what measurement points do you look at, how to measure them. For example, do you look at employee safety, and then basically you take then the number of fatalities, or you take the number of incidents related to safety. And then the third element, how you aggregate that. And this leads to these deviations. And the problem is there's so many little decisions on the weights, on the data that are available. Even so, there are a lot of experts taking these decisions. At the end of the day, it's pretty random what comes out of that. So this non-correlation of these ESG ratings is not because there's a diversity of opinion, no, because it's so many random little decisions that have to be taken. And just to be very clear, these are experts that take these decisions, but if you aggregate everything, then you have this aggregate confusion. And this is, when I did my PhD a long time ago, I had to do something which you call in science error propagation. You have to understand why you get a certain result. So the first thing that some people say, that you have a diversity of opinion reflected in ratings, that's not true, because these non-correlations are pretty random phenomena. And I know that things are improving, but that's basically the situation, still valid if you read this aggregate confusion paper. The second thing, I should not talk about other companies, but I do it nevertheless because I'm missionary and I want to get that out. If you look at the consultation paper in the UK about whether they want to regulate ESG rating agencies, they say something very, very important. They say this market, as much providers there actually are out, is dominated by one player. And that's especially true for Europe. It's a bit less true for America, where fortunately we have FTSE Russell and S&P in addition. But it's true for Europe. So it's basically one provider. And this one provider basically then, based on that, their ETFs, indices, etc. And then basically in the retail market, people basically buy a sustainability ETF fund. And then this one provider tells the people, sorry guys, this is not about improving the situation for people on planet. These ETFs based on our ESG ratings are all about that these companies manage their own financial exposure well. So it has nothing to do with what most people believe. So second fact is it's one dominant player. And if you then, third fact, if you then read the article of Bloomberg that I think is the best article ever written on ESG ratings called ESG Mirage. I urge you to read that. Then actually you see that when a company improves in the ESG rating, it's not necessarily, and in this case not at all, because the company has done everything great. Maybe they forgot actually to say they don't employ children. No, it's because methodology changed. Mm-hmm. Seriously, this is ESG Mirage. It's a Bloomberg article. I have no clue why Bloomberg wrote that article because I really ran against two big players in the US market. But read this paper, this article, this journalistic work, the ESG Mirage. And then the fourth one, another fact we know is it's not only methodology changes, but it's also backfilling of data. There's only one provider of the ESG rating agencies that has been so transparent because they worked so much with the academia that this is actually known. Otherwise, if you ask any of the ESG rating providers apart from us, we give the data to you, have you changed, have you backfilled data? They won't give you this information, but there's one provider that historically has provided this data to many academics, so you see all this time series, and you see there's an incredible amount of backfilling going on. And that's even one of the better providers. So these four things make me really wonder, is this convenience argument, is it a good argument? Or should we actually take a step back and say, you know what, sustainability is too big a thing. Let's focus on something smaller, for example, just on carbon or on diversity, this clear purpose. So I think to use ESG ratings right is a big, big challenge everyone should be aware of, including the supervisors.
Okay, great. Well, I forgot to, just before we go on, I forgot to mention earlier, I'm sure you all know that if you'd like to ask any questions, we have Slido, and you'll see the hashtag to use up there on the board, hashtag CEE Summit 2023. And also I was all going to mention if you're not aware of it, I think the paper Philip was mentioning, aggregate confusion, is the MIT study from 2019, I think, or a bit earlier.
Well, 2019 was the first time published, but now actually it got officially peer-reviewed published this year.
Right, and that showed that the correlation between ESG ratings is 0.61 versus, I think, 0.99 or something for credit ratings. But obviously, as Philip has been explaining, clearly there are some very good reasons for that. But maybe moving on to Elena, again, there's a lot going on here. What part of the debate do you think is sort of most relevant looking ahead? Sort of given where we've come from with the ESG ratings, sort of how is this? How do we go forward from here?
Thank you, Lucian. Of course, a lot of great topics already touched on. I think it's important maybe to reflect on the evolution in the space and what are some of the key drivers and themes. And maybe I'll start with the good news and then move into the bad news and then talk about what that means for the future. The good news is that we've seen a lot more adoption and usage of ESG scores and ratings, and I'll make that distinction and maybe elaborate in a minute why. Happening across regions in capital markets. Gabriel spoke about it, but that's not a unique phenomena. That is the direction of travel that we see across all regions. ESG ratings are used to shift capital, and that's putting a lot of pressure on companies and corporates of all sizes and geographies to continue receiving access to capital. They need to be transparent and provide information to then inform one of the new emerging criteria when making making investment decisions. So adoption is a key trend and it's a key driver, and we need to make sure that the credibility and trust in that data set is built forward rather than deteriorated. And there's been a talk about trust erosion in ESG data and scores. So I think that that's one of the reasons why it's important to rethink what ESG ratings are and what they're not, and be very transparent and clear when communicating with consumers. The second theme is around transparency. We've spoken about transparency already a few times today, and I bet you this will continue to be a central topic in all panels in the course of this summit this week. From a data provider perspective, we've also seen more and more data providers opening up their processes and opening up their models to inform users and guide them in terms of what they can expect to see and what they can expect not to see when consuming the information. What are the design principles? If the data's been quant analyzed, meaning it's a score that is based on an algorithm, and an algorithm can be replicated and customized to meet the needs of users. That's something from our perspective we see very powerful and very essential in the context of capital markets. It's that customization to connect it with what those companies actually bring to their consumers, to connect it to their DNA. And to do that, it has to be customizable. So the context around transparency and the scores. But on the other hand, you have ESG ratings, which in the process, there is subjectivity. There is an opinion built into the process of aggregation. And what that means is that it's hard to replicate, or I would argue it's impossible to replicate. And the expectations need to be set accordingly. Adjusting, customizing is not possible. Also, regulation is requiring financial professionals to put controls in place to ensure accuracy of the data, including scores and ratings. And there is a very interesting dialogue happening in financial markets in Europe right now of how do we do that as practitioners? How do we build those controls in place to take responsibility from the data providers and be confident that we're using accurate data? It's problematic, and I think that what is possible and what is not possible varies depending on the type of assessment that is being used in the investment process. The third component is around complexity, and we've spoken about the complexity in the context of sustainability as a whole, and we're really trying to quantify and measure the world's problems and aggregate them in one number. That's a humongous task. But when I talk about complexity, I actually talk about data complexity. Sustainable data, ESG data, is a big data challenge where we are trying to map physical assets and the world to the actual sustainability risks at those assets, aggregate that data at an investable asset level, whether that's a corporate or a real estate asset or an infrastructure asset. And then there is another layer of aggregation to a portfolio, a fund, an index, or an investment portfolio. There is a lot of massive big data challenges along the way. And new data sets are emerging constantly. And because it's an infancy, the industry we are in is in infancy stage, we have to make sure that we are planning for the fact that there will be a lot of new data sets being created, and they will be uncovering very material and significant risks and impacts that we need to measure and quantify and incorporate into those assessments. So managing volatility and not changing methodologies, I don't think is on the cards in the near future. It will be with us, and we have to plan for it wisely in the context of capital markets. And I'll just throw the fourth idea very quickly, which is about sorry, it slipped my mind, but I'm sure it's going to come in the course of the presentation. This was the bad news. See, I'm very positive. I only focus on the good news.
Well, I know that you did. I don't know what you're going to say for the bad news, but you did mention the sort of the distinction between scores and ratings for ESG, and I just thought it might be interesting to hear a bit about that, because certainly I have heard people suggest that perhaps one of the problems with ESG ratings is that in the early days, in order to give them credibility, the providers chose the term ratings, but of course that has then attracted comparison with credit ratings, and obviously these are quite different things. And so I think scores is a direction that people are moving in more now. Is that sort of where you're going with that, or?
In a way, I mean, I think there will be always a room for both types of assessments in capital markets, similar to how financial analysis is conducted. You do have analyst opinions on financial performance, and you do have quant models. So I think that there is definitely room for both in the future. But it's about understanding what you get. It's about transparency and communication. And I do believe that, again, making the analogy with the financial analysis, we're trying to potentially create too big of an aggregation. And what we see happening in the marketplace is a move away to actually the building blocks of that aggregation, more a scorecard type view that allows users to select the building blocks that align with their requirements, whether it's regulatory requirements, customer needs to create a new product, and take those building blocks to then incorporate them. There, the ambiguity and the correlation challenges we spoke about are a lot less present.
Hakan, so what are your thoughts on, again, sort of where we are with ESG ratings now and where we need to get to?
Well, thank you for the question, Lucy. In fact, ESG ratings are a necessity, right? Let's be very clear about this. We have set ourselves the goal of the European Green Deal. We want to get there. No management without measurement. You have to have those measures. So that's not for no reason that they're being used, but it's also a very complex challenge, and that's why it's not for no reason that there is so much criticism about it, about things that can be done better. And when I was asked this question, I thought, what would be the two things I would like to see? Because as the European Investment Bank, we are being rated. We don't really use them that much because we do our own sustainability due diligence. We have the luxury of being able to do that. But we are being rated since the very, very early days. And we engage and we talk and we find out and we see the strengths and, well, the not so strong parts. There are two things which came to my mind. Well, basically, the first one was about the clarity of measurement. And the second one is about the transparency of the methodology. So the first one would be really clarity of measurement about what is being measured. And the second one about the transparency of the methodology, the how. Because that's exactly what we see. We are being rated very well, fine, but we say, and what does that mean? Are you actually aggregating our E, S, and G scores, right, into one, which is very, let's say, courageous task to do, because it basically gives a weight to everyone, and it almost begs the question, if you up your S, you can lower your E, or the other way around, and I don't really think that feels right. It shouldn't be that way. So what is it that's being measured? If it's about materiality, then is it the financial materiality? But if so, what is it then, right? And some say, yeah, it's single materiality, it's financial materiality. But then tell me how much. And that's, of course, very hard to do. Others say it's double materiality. Okay, so what's my impact materiality? Clarity of measurement. What exactly are we measuring? And if different rating agencies have different results, that might well be because they're looking at different things and they are putting different values and weights. So please be clear about it, and suddenly we will all feel much better, and we will be able to use the data much better. And the second one, and that is about the how, the transparency of methodology, because to be clear on the measurement, you have to say how you arrived there. And all too often, we see, oh, methodology has changed. We just had that example. So how did it change? Tell us. We don't really always get that information. We would love to see maybe a public consultation before the methodology is changed. There are elements of that, but it's not standard practice. Be open about it. Be transparent on the methodology so that the user can actually understand what comes out of it. I think this is easy to do and would bring a huge benefit. Be transparent about the methodology. Be transparent about the timing. You know, how often are you updating the data? Shouldn't be difficult to do. And suddenly there would be a bigger value added. So I see really these two things, the clarity of measurement, transparency of methodology, would bring us way forward. And I'm very, very positive about the future because not only are we going to need it, we are going to have more data. And our colleagues from the European Commission are doing a fantastic job, in my humble view, by bringing us the European standards of sustainability reporting. Because with that coming in place, you suddenly will start having the data to do your own analysis. A bit like you could do your own financial analysis, now you can do your own sustainability analysis and look at your environmental, your sustainability, or your governance effects and do your own analysis. So I think we are moving forward. Data is becoming more available. I heard that. That's really positive. And suddenly, I think we will have more data, more quality, more transparency, and more understanding of what exactly have we measured, right? More clarity on measurement. So we will have more data, and we will manage it better. And that's why I think ESG data and ratings, time for a rethink. I would say it's not time for a rethink, but it's time for a leap forward. And I hope we're going to see that. Thank you.
Well, Julian, last but very much not least, given that you maybe, you possibly have more influence over the direction that this is all going in than anyone else here. So ESMA has undertaken a consultation on ESG ratings that closed last year. And I think initially it was about 2 years ago that ESMA asked for additional powers to regulate ESG data and ratings. Could you maybe just start by telling us sort of why you did that in the first place, and then some of the takeaways from the consultation?
Sure. First of all, let me thank the organizers for setting up this smoothly running event and for inviting me here. So indeed, we had this open letter to the European Commission a couple of years ago that called for legislative action in the space of ESG ratings. Now, what was the rationale behind this? I think this has already been mentioned several times. I mean, we've seen a lot of growth in the sustainable finance space. ESG investing has really taken hold. And as part of that, ESG ratings are becoming increasingly prevalent. Basically, asset managers, investors more broadly, are using ESG ratings and integrating these in their investment process. And of course, that means, you know, at some point, some of the issues that have been raised with ESG ratings, including here on inconsistency, transparency, then become increasingly problematic. So what ESMA was doing was precisely to set out what, in our view, were some of the key components, basically, of what a regulatory framework for ESG ratings should look like. So there were 3 main building blocks to this proposal. The first one is to introduce basically a common legal framework, so common definition to understand what is an ESG rating. So just for example, you know, should it be the case that a regulation would apply only to ratings? Should it be ratings and scores? What are the limits? What should be in scope exactly? This needs to be, of course, precisely defined and discussed. We're of the view that a broad spectrum would be preferable in order to ensure that minimum standards and requirements apply to the market at large. Second building block, the setting up a registration and supervisory regime. We think there are good reasons why this should take place at EU level, and I'll touch on this on a second. That was also one of the outcomes of the fact-finding exercise we did last year. Now, ESMA is, in our view, relatively well-placed to take that responsibility because we have experience in the supervision of credit rating agencies, even though, as you mentioned, these are different products. But some of the, for example, organizational requirements that would apply to the rating providers are in some way comparable to what exists in the context of credit rating agencies. Third building block, the product-specific requirements. So what ESMA is keen on is not to achieve full consistency of the ratings, but to improve the comparability of the ratings. This is, in our view, one way to empower investors and specifically retail investors, which learn a lot and have a lot to gain from ESG ratings. That's, the ESG ratings are a very useful way to collect and crunch a lot of data and make it available in a very easy way for less sophisticated investors. So, making sure that these investors are very well informed and in a position to compare the ratings is, in our view, paramount. Now, following this call for evidence, we conducted this sort of fact-finding exercise. If you want to regulate a market, you have to understand a little bit what the market looks like concretely. And there are maybe 4 main points. I don't want to take too long. I'll go very briefly over the 4 points. First of all, we found that there were around 60 rating providers currently active in the market. Now, again, this is just an estimate. It's based on responses from rating providers themselves, as well as users and rated entities, keeping in mind that what you call an ESG rating may be very subjective. Even the rating providers themselves disagreed on whether their products were ESG ratings or not. Second main finding, a lot of the rating providers are actually small EU SMEs. There are a few very large non-EU groups that tend to concentrate a lot of the market. I think Philip referred to that. But there's also quite a broad diversity of rating providers, even though they're concentrated in a few jurisdictions within the European Union. Now, interestingly, users tend to subscribe to several providers at once. So why do they do this? What we found out was that users basically enjoy the fact of receiving different opinions. Some point to inconsistencies. I think it's also well established in the literature. Surprisingly, investors also told us, at least a number of them told us, that they valued that diversity because it gave them different point of views depending on what you intend to measure. Obviously, that goes back to the point of being very clear about what you measure and providing very clear definition and transparent methodologies. And indeed, quite a bit of a concentration within a few large market players, but users of the ratings were hoping to increase coverage by using more than one provider and getting specialist views on a few specific topics. Last point, some of the shortcomings that were highlighted in the course of this, what we call for evidence, where lack of coverage, this has been mentioned, insufficient data granularity. Now, I think this has improved a little bit in the past 12 months, at least from my perspective. This is something we're keen on watching, and obviously, given the legislative pipelines, we can only expect this to further improve in the future. And finally, lack of transparency. I think that's a fundamental point. I can refer to that. That keeps coming back over and over. Transparency about data, choice of metrics, assumptions, methodologies.
So what next? I think we heard from Martin Schwartz earlier that the results of the consultation, or that the next steps are going to be unveiled on the 13th of June. I don't know if is there anything you can tell us about what we can expect then? Obviously, I'm not expecting you to jump the gun, but is there anything you can tell us about, at least about the process that basically the next steps in this process?
So I'm not in the shoes of the European Commission, so there's only so much I can say about the upcoming regime itself. Now, from ESMA's side, what this entails, of course, is developing the so-called technical standards that ESG rating providers that intend to provide ratings in the future will need to adhere to in order to be officially recognized by ESMA. So these are some registration requirements, authorization, and so ESMA's main focus over the next months and possibly years is going to really harsh out the exact details of what it is that rating providers need to demonstrate in order to be authorized in the European Union.
So, Philip, going back to the on the subject of the consultation. Now, I know that in the consultation, everyone who one of the questions was, would you support intervention by the EU in the ESG ratings and data space? And if so, would you prefer it to be actual legislation or voluntary? And I think RepRisk said they would prefer a voluntary basis, as is happening at the moment in Japan. Can you tell us why you think that's important?
Well, I'm a big fan of the European Union, but I'm a bit afraid it ends up like the taxonomy and SFDR, that it's very prescriptive, right? And I think there's so much advancement in technology. A lot of the approaches that ESG rating providers have taken in the past, that they're really of the past. So this is my fear, right? And I really hope, if you look at IOSCO and the Code of Conduct for Japan, the key thing is conflict of interest and transparency, right? And related to that, what is actually the purpose? So I think I really hope that the regulator and supervisor enforces this transparency. And I must say, this doesn't happen voluntarily, because we went radically transparent in September 2021, and not one single provider followed us. We have so-called Jupyter notebooks. You can actually go to our website and check everything out, how it works. We also now are completely transparent about the machine learning transformers we use. And you have to enforce this transparency. That's my learning. I thought when we are the first, we put the others under pressure, but of course, obviously we don't. Maybe we're economically not important enough. So there must be the supervisor and regulator stepping in to enforce this transparency. And I just want to mention one more thing from a regulatory and supervisory and practitioner point of view. One thing that must also stop, apart from being non-transparent and not clear what the purpose is this backtesting. Many investors do backtesting with data points that are constantly changed, methodologically or backfilled. You cannot do a backtesting of ESG ratings. You can't. It's complete, sorry the word, rubbish. So please stop doing that, because we learned now that there's backfilling, there's changed methodology, changing purpose. Some ratings went from a sustainability, whatever that means, to a sustainability risk. Again, what does that mean? So you can't do that. That's another point we haven't mentioned yet.
Okay, well, we've mentioned a couple of times perhaps some of the issues of combining E, S, and G into one rating, and that's something that's also been mentioned in a couple of questions here. And I know there has been one of the things that was being talked about in terms of the consultation and potential regulation was actually mandatory disaggregation of the three, so it wouldn't be able to provide a single ESG rating. Elena, do you think there is any virtue would there be any virtue in that approach?
Probably not. I would be on the side of there is a lot of very valid use cases for an aggregated ESG view, provided that there is enough transparency and clarity as to what it actually delivers. We also need to acknowledge that the industry is at different phases of maturity. There are some markets in the bloc that are very advanced, and from our experience, they don't work with pre-coined ESG scores. They use raw data and they build their own view on sustainability. There are other markets in the context of the bloc, and especially in the context of this conference, that are just starting the journey now. They need the starting point. They need guidance. They need to know, great, there are hundreds of data points. There are lots of complex issues. We are financial professionals. How do we make sense out of the data? So they need those starting points. It's the first step on the journey. How quickly then practitioners move beyond that first step into building their own view on the world, it varies from practitioner to practitioner. So I think in the foreseeable future, there is definitely not only very valid uses, but a necessity to enable the industry to move in the direction that legislation is pushing the industry to go to. Whether it's going to look different in 5 years,
it probably yes. Probably it will look quite different. And again, from our experience, we see the movement towards more give me the components, give me the climate assessment and the ambition on the transition plans, give me the social risk profile of the company based on its supply chain and operations. So I believe this is the direction of travel, but until we make ESG scores obsolete, we're going to have to make them work for the industry.
Katarina, you were saying that you're welcoming some of the regulation on corporate reporting. What about regulation on ESG ratings and data? Do you think that that would be helpful, and what sort of things would be most helpful from a corporate perspective?
I think it would be helpful. I never thought I would lean in the direction of more regulation. But if you look at the state of the art as it is now, it's basically, Anna said, it's a new market, right? And it's a very dynamic, and competition between rating agencies and it is business, believe me, is there. And the competition actually drives positive changes. We see new, more like data analysts providing clearer description of how they work with data. Some investors don't use just ratings, they also look at the key KPIs. So the market forces are working, but I'm not sure if they're working fast enough, if we have enough time to wait for the market mature. And if there is legislation or regulation that just levels the playing field, and I don't think it needs to be robust or overly prescriptive, but you know, let's require good governance from ESG rating agencies. Make your methodology crystal clear, make it public. I understand there might be some proprietary algorithms or some internal mechanisms, but make sure that we know how you work with the data and what the process is. Make sure we know how old the data is, because with some agencies it can go back to 2 years. It does not reflect what the company does now. Whenever there is change in methodology, make sure that you recalculate the scores backwards so that when we look at historical trends and I go down in the rating, we can have situation when my company improves, but the rating goes down because methodology is stricter than 5 years ago. And I'm not against being stricter, that's perfectly fine, but if you look at the trends, they need to be comparable. And also make your business model absolutely clear. Who pays you? And if you provide services, what does that mean to whom? And I think that that kind of framework would be really helpful and would help to increase transparency, because let's be honest, ESG ratings, they do have costs for us. It's access to capital and it's reputational risks. You know, the real impact on business is there. So some kind of framework I would definitely welcome it.
Fantastic. Well, we have a question actually for Philip from Martin, saying, how can supervisors enforce transparency of ESG rating providers if they currently have no powers to do so at the EU level?
If they don't have the power to do so. And I, as a Swiss, shall tell you how to do that. I have no clue. So what is the question to me? I don't know how the European Union works.
I suppose that's true. Yeah. Well, Martin, do you have a...
Well, I asked, how they can enforce this if they don't have the powers according to the EU law, because currently...
Okay, I see.
No supervisors at the EU level have the right to enforce the transparency. That was why we have started this work based on the ESMA story.
I have an idea. Let's do the Japanese way. Because basically this code of conduct is voluntary, but obviously if you don't sign up to this code of conduct, something is wrong, because it's about conflict of interest, transparency on the methodology, also that you have a mechanism to talk to companies, which is another big problem. If you endorse that, I don't know exactly who has endorsed that, the supervisor, regulator, legislator, then I'm sure that this will certainly bring up the level of the playing field.
I agree that this is a model that can work really well. We've endorsed the Japanese code of conduct as well.
Okay, great. Well, another question, again, you touched on this in your introduction, Katerina, is the question about ESG scoring and risk analysis in CEE and some of the challenges of that. I know this isn't restricted to CEE. It's also the case in a lot of other regions that are not sort of Western Europe or the US. What part of the problem being limited corporate data, part of the problem perhaps being the size of some of the corporates in the region. Philip, maybe have you got some thoughts on how this can be made a sort of more level playing field across regions?
Can I
Tough
throw
one.
an idea?
Okay, yeah, Elena, go for it.
Maybe I'll just give you a couple of facts to ground the problem. We process data on 14,000 companies, and to do that, it takes 700 analysts to ensure that the data is of a reasonable quality and comparability. So to go deep into emerging markets, simply, it's not an economically viable model. Why does it take so much effort to process, and I talk about fundamental ESG data, I don't talk about other alternative data sets that the industry creates and generates. It's similar to how we process financial. Let's process the basics, the fundamental ESG data that companies actually invest a lot of money to communicate and make it publicly available. The reason why it is such a costly and lengthy exercise is that the data today is voluntary, and there is no agreement on reporting standards. There is no agreement on what is that fundamental global baseline for companies to measure, manage, and report on. And they are bombarded by dozens and dozens of requests for different data sets. And most of the companies operate across jurisdictions, across regions, and they have to comply and meet the needs of all of those different reporting requirements. It's very costly for the companies. It's extremely costly for the data providers. So to me, the part of the solution is mandatory disclosure on agreed base standards and principles. And I think that that's where the work of the Commission with EFRAG, guide support on ISSB, and I know there is a panel later today to talk about ISSB and what that means for the industry, from our perspective, is critical. It's really important to solve for the coverage challenges in smaller emerging regions and markets across the world.
And if I might add, another solution, of course, is you don't build your ESG ratings based on company reporting, right? So basically, you base it on technology and see what type of incidents are going on with companies, what business contact do they have, right? And then you don't have the coverage problem if you leverage this technology and look at information from outside of the companies. So you have the coverage and you have the speed. So these were my answer, and I would limit the company reporting to carbon data and diversity. That's it.
So yeah, actually we haven't really got into that, but yes, obviously that is the for anyone who's not familiar with that, there's basically two types of or two methodologies for ESG ratings, is either using company disclosed data or data external to the company. Some people only do one or the other, and some rating agencies use a combination of both. Again, another differentiation in the methodologies. We have got to wrap up in a second, but Hakan, any thoughts from your side on the CEE question and ESG ratings? The CEE question, as in how you make this a level playing field and the sort of challenges for regions that are not Western Europe, say.
Yeah. No, definitely. I think we come back to the basic problem of having the data for the ESG rating agencies, but also for everyone. And that's why it's so important that we do have the European Sustainability Reporting Standards and the European Single Access Point, where that data becomes available to everyone. So you do have your level playing field, at least for the EU 27, which is already a big step forward. 450 million people on this planet. That's a big step forward. And that enables this comparability going forward. So I'm really looking forward to that. That will be an excellent step.
Fantastic. Well, we're out of time and it's lunchtime, so I won't keep you all any longer. I just want to say thank you very much to the panelists for a really interesting discussion. Thank you to all of you for listening, and thank you again to Linda and Julian for setting up this debate and this excellent conference. Thank you.
Thank you very much. Thank you, Lucy, for moderating as well. And as you already mentioned, we are now slowly proceeding and progressing to the lunch break. So hopefully everyone is hungry. Please, you can move out from the room to get some nice lunch. And thank you for this really interesting, insightful, and again, solutions-oriented discussion, which is exactly what we were hoping for. Thank you so much.
my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby, and twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, but I don't wanna jinx it, baby. Let's not get ahead of my time. Oh, but I don't wanna miss you, baby. So I stand up and speak my mind. Oh. Baby, you give me ice and fire. You're chilling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Baby, you give me ice and fire. You're channeling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, 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 oh,
after lunch. Good. So we are going to start the next block, next part of the first day of the CEE Sustainable Finance Summit, and we will kick off with two keynotes at first, and then we will move on to a very, very interesting discussion we have planned for you. Now, so we will start with the keynote speech by Maxfield Wise, the Executive Director of CDP Europe. So maybe without any further ado, the floor is yours. We already have a short delay, so please, welcome to the stage.
Thanks for having me. Dobry den, Praho. Menu say Maxfield Wise. I'm the Executive Director of CDP Europe, and I hope that you've been enjoying today's conference. And I'd like to thank the CEE Sustainable Finance Summit for the invitation. It's great to be here to discuss the urgent need for finance and business to disclose on their environmental impacts. So, I wanted to start out with the premise before I get to who CDP is and what we do as an organization. But we cannot write off the goal to keep global warming to 1.5 degrees. Science has shown us that if we do not act now, we're going to face irreversible damages to our planet, to our economy. So these impacts are here, and they're happening. And we're going to have to stay ahead of the game to get this across our society and our economy, because it's a material business risk and it's material to investments. So when we look at it, point blank, global warming is going to undermine our food systems, our physical assets, our infrastructure, and natural habitats. And the UN Environment Program has already analyzed how these impacts will affect and lead to an environmental crisis. So if you look at it from the perspective of the MSCI All World Index, they found that more than half of companies' earnings will be at risk for climate change if we do not act. The greatest risk for financial institutions, indeed, it actually lies within our portfolios. And so CDP data, we've analyzed this across the board, and we found that the risk to portfolios is 700 times larger than the direct emissions of a financial institutions. Think about that. If you look at the emissions of a financial institution across the board, but then look at their portfolios, that risk is 700 times larger. And these risks across portfolios, they carry a potential financial impact of over $1 trillion US. So CDP data also shows that financial services companies' climate-related risk outweigh corporates by nearly 4 times. So if we're looking at where we need to drive impact, is it the real economy or is it from the capital markets? So on the other side, I always like to talk about the risks and start us out there. But essentially, the reason why we're doing this is from an opportunities perspective. And there are real opportunities in financing the transition that we need to make. They include sustainability-linked loans. They include green transition bonds, as well as other great assets that CDP data has supported. And financial impact from these assets and the ability to drive this opportunity is worth up to $2.9 trillion, according to CDP data. This can greatly outweigh the cost. So we definitely see that the opportunity is far more profitable than the cost of inaction. So companies that are the head of the game, they're the ones that stand to gain. And I think that's the message that we're trying to get across. We work with stock exchanges to set up indices at CDP, targeting companies with 1.5 degree targets. That's key. With investors to create funds that align their investment portfolios along those companies who are leading that path with 1.5 degree targets, as well as with banks who use CDP scores for their loan rules. So the science, it also shows us that the time to act is now. We need to look at it from a real-term time perspective because the realization of these opportunities are passing us by quickly. And to mitigate the risks and to keep global warming to 1.5 degrees, companies are going to be key to this transition. And financial institutions, you have the power. We see the power in you to arrange and engage with organizations to drive this change, and the potential to adapt your investment decisions along those companies who are leading the impact from a 1.5 degree aligned and nature positive pathway. So much as with financial risks, having this data, having environmental data, is the bedrock to all decision making. It's the first step to managing and then engaging with companies. So at CDP, who are we? We essentially link companies with their customers. That's what our job is, and with the capital markets. And we do this through disclosure, through the simple act of disclosure, with the idea of what gets measured gets managed. That's critical. Impactful data is critical and key to all decision making. It's essentially lighting up the system so decision makers can get spot on companies and cities, states, and regions with the ambitions that they need to drive action. That's what we're trying to do, to essentially accelerate the rate of change of a sustainable economy that works for people and planet. So, a little bit more context about who we are. And I've given a little bit of intro of the problem, the risks we face, the opportunities that are on the horizon. But if you still do not know who CDP is, that's okay. You're in good company, because the Harvard Business Review once called us the most powerful green NGO that you've never heard of. So what do? We run the world's environmental disclosure system. And this is for companies, cities, states, and regions to measure and manage their impact and ensure that they're setting themselves up for action. And we put this information at the heart of capital markets, at decision makers, with policymakers, and of course, global supply chains. We're a non-for-profit, and we're funded by the European Union, and we're working closely to ensure the European Union's Green Deal and a climate-neutral EU. And when you ask, how does CDP drive this impact? Well, I think the key to our success is when CDP asks for this data, it's not us who are requesting this information. We are backed by the capital markets. We have more than almost 750 global financial institutions and investors and banks who have a collective 130 trillion assets under management who are backing the information request of CDP. So when a company is asked for this information, it's the BlackRocks, the Amundis of the world, the Vanguards who are requesting this information, as well as their customers. We work with global supply chains, and more than 300 large-scale corporate clients are requesting this information from their suppliers, like L'Oreal and McDonald's, and they need this information to make financial decisions based on it or purchasing decisions. So this is what investors need, and this is what investors demand of their portfolios, because environmental risks, they are investment risks. And this information is out there, and it's fueling financial institutions to understand if companies have a plan to address and get onto the climate transition. CDP, we support investors, and we do so to help them understand those risks, to use our data to engage. That's very important. We want to see the financial markets engaging to ensure that they're either selecting or deselecting those companies or putting them on an engagement pathway towards 1.5 and nature positivity. And that goal is to then reduce those risks and identify opportunities with that simple premise of CDP, of what gets measured gets managed. But to make this all happen, we need to get that information out into the world and ensure those companies where the real economy is being recognized for the work that they do. We need all companies to be on board, so that information request backing by the capital markets is essential. And here in Central and Eastern Europe, they play a critical role in ensuring that Europe and the rest of the world gets to net zero. So not only because the economy here is growing, which we see and we recognize, because it starts with disclosure. To be able to get to that stage of action, we need to scale that growing economy here in Central and Eastern Europe from that starting point with that simple act of transparency. So last year, we asked 900 companies in Central and Eastern Europe to disclose through their environmental data through CDP. And we did this, of course, on the behalf of financial institutions, many like you. And to give you an overview more broadly, this is essentially what we're doing and where our data goes. CDP is engaging with organizations around the world, and we gather this data, and this is essentially underpinning the capital markets. We have scores that we put out into the marketplace, and this goes into rating agencies, NGOs, stock exchanges, governments. It's fueled throughout Bloomberg terminals, and of course, financial institutions. And then we're harmonizing this data so you can use it, access it within your portfolios to build out a sustainable funds and, of course, net zero pathways. And this is essentially proving that CDP is the foundation of the ESG world. So the result, over the past 20 years, we've really mainstreamed transparency. Disclosure, it currently covers climate change, water, and deforestation issues throughout supply chain. However, we recognize that so too does the global economy need to transform. So does CDP. So we're going through a bit of transformation ourselves. And through our 5-year strategy, we're going to now be expanding across planetary boundaries. So not just water, climate change, and deforestation. Last year, we introduced biodiversity. This year, we'll be introducing plastics into our questionnaire, and we will, of course, be moving to land use, circular economy, ocean impacts, because we need to see climate change and nature as two sides of the same coin. You cannot solve climate change without addressing the nature crisis. And currently, the impacts and the reliance on nature is more than half of global GDP. 44 trillion of our economy relies upon nature. So, what does this mean, and what are we seeing here in Central and Eastern Europe? We're really seeing a positive uptake. We had about a 45% increase in terms of disclosure to CDP in 2022 comparative to 2021. And we're now saturating about half of the Central Eastern European economy in terms of a market capitalization, in terms of driving disclosure and transparency. And we want more CE companies, and that's where we need your help. So looking forward to engaging with you to ensure that we are driving disclosure and transparency at scale in the Central Eastern European economy. We've really seen this positive uptake, and we're happy about it, but we need to see more. We need to stay one step ahead. And as financial institutions, you're going to be a crucial role in engaging with companies that you invest in. Much like you need this financial information, so do we need to get this information out to the markets. And it's encouraging to see this high level of engagement here in Central and Eastern Europe, but there's a lot more room to grow. Part of this change is helping companies. We need to help them on that roadmap, and financial institutions are going to help them get ahead. And if not, we need you to be obliged to do so. And we need you to get them to disclose, because what we're facing here from the perspective of Europe with the EU taxonomy and regulations is going to be key to ensure that we get these companies ahead of the game in terms of regulation. So CDP's work, it's to help not only drive disclosure, but it's also part of our new mission to scale the most impactful standards. We'll be integrating the ISSB framework into our disclosure platform this next year as a global baseline. This year for the disclosure platform, we've integrated aspects of the EU taxonomy, as we did with the TCFD in the past. As should that scaled, we will also be integrating elements of ESRS. The idea here is that the harmonization of the CDP questionnaire across the economy allows standards to scale and grow and ensuring interoperability. So we really need to see this momentum. And from regulation, financial institutions, companies, we need to keep pushing towards this more action. The key is to reaching 1.5 and nature positivity. And this all must be based on science. So the Science Based Target Initiative, it's a global standard for verifying emissions targets. This was founded by the UNGC, WRI, WWF, and CDP. And companies, we need them to make this rapid change in deep emission cuts on a 1.5 degree pathway and reach net zero by 2050, which essentially means about a 90% reduction in terms of the emissions of a company where they are today. Think about what a company looks like today and what a company will look like in 2050 with a 90% reduction. This means a radical transformation of how companies operate and how companies work. And they need to do this now. So they need to set near-term science-based 1.5 aligned targets now and look towards the long term, towards that net zero trajectory, and ensure that we cut emissions in half by 2030 and reach net zero emissions by 2050. This is it. This is what we need to do. This is not a target. This is a limit to keep our planet in balance. So how can companies do this? And particularly, what do they need to do to reach these targets? They need to have these time-bound plans. What we need to see next from companies after they've set a near-term target and a long-term target is they need to put in climate transition plans. A climate transition plan is essentially the roadmap for companies that shows the steps how they're going to get there now into the near term, and they're essentially how a company will transform their business models onto a 1.5 degree and nature positive pathway. And to ensure that they are not sustainable, but what they need to do is demonstrate to their shareholders that their plans work and that their businesses are viable. In many cases, this is going to take a rapid shift in terms of new sourcing practices, in terms of new products, and a new way of thinking and doing business. But financing all this is still going to need backing, and we need to have this for companies that are showing progress. We have nearly 2 trillion in the current loans to European companies, and to those that they are showing clear progress to transfer to 1.5 degrees. It means that banks, you will not be able to fulfill your own net zero goal without these pathways for companies, which have made ensuring that we can get through net zero through the Net Zero Banking Alliance. And financial institutions at the same time must push for change for the sake of their investments as well as their own targets for their portfolios on net zero pathways. And we still need to all be heading in that same direction. That's what is going to be key and critical. So the last chart I'm going to show you today is giving you a cross-section of essentially where we're at and where we are at on this transition across Europe. So there's a lot more that needs to be done, including here in Central Eastern Europe that this chart shows. And we need to pressure a new way of thinking with businesses together. This is going to take collaboration across the real economy, within the capital markets, from a policy perspective and a global supply chain together, this perspective. But we need to come together, and I think that's what CDP's aim is. We need to come together using data as key to underline the economy. We need to come together for our portfolios and our planets, and it's all connected in how we're going to show our part to play to ensure that we get to 1.5 in nature positivity. So there's time to engage companies, position your portfolios, and make the change. And it's going to be based on disclosure, insight, and action. And I always like to close it in the same way that CDP, we're not going to start pushing. We're going to continue to up the game in our questionnaires. We're going to continue to push progress with investors, with the capital markets, as well as with companies. And we're only going to be doing this together because we only can have a viable, livable world into the future if we are committed, if we are credible, and only then can we transform the norm. Thank you so much.
And I thank you very much, Maxfield, for the very energetic presentation as well, especially after lunch, which is often, always really, really welcome. So thank you for that, and thank you for the very powerful call to action as well. And I just realized now how powerful is this the set of keynote speeches, because now to follow as well we have the CEO of GRI. So I'll just pass that on to you, please. And to the stage, we welcome again Elko van der Enden. So please, the stage is yours.
Thank you.
1 second, the presentation is working good.
So, sorry to be here again. So let me also start with some marketing on my organization, GRI. We're here for a while, more than 25 years. Basically, we are originally a US organization that not many people know, founded in Boston by Series in 1997. Some of these data, the companies that report, we have also some non-public, so that figure is a bit low. But two data that I want to especially stress that I think are quite important. Because it's not only about collecting, it's also about reporting. And we will go into detail, and I will explain you our little joint venture with the ISSB and how that correlates with EFRAG and ESRS. And all you guys, regards from Patrick de Cambour, who I just had very long on the phone. More than 1 million downloads last year of our standards. That is a lot. But what's more interesting, I think, is that more than 50% was not in the English language, which shows you we are truly international. So our standards are currently translated in 13 languages, and Korean and Turkish to follow up soon. 78% of the largest 250 companies report under GRI, but what is perhaps, I think, more interesting is that you see some countries of which you do not expect it, that have a tremendous high uptake of the GRI standards. Singapore, 94.2% of all listed companies use GRI. Malaysia, 78%. And we see these amounts growing. And you may ask yourself, why? Now let's go to the why. The landscape of reporting is changing. And it's changing for the good. But there's a lot of misunderstanding, and we will go to that slide in a couple of minutes. But if you look at the so-called alphabet soup, when it comes to actual standards, you wouldn't even call it a soup, because there are not that many standard setters. We have our friends of the ISSB, and they have more or less absorbed, of course, the American SASB. You have EFRAG, our European friends, under the CSRD, publishing the European Sustainability Reporting Standards. And then we have our rather timid American friends when it comes to sustainability reporting, the Securities and Exchange Committee. As we've seen, and we will see that later, the scope of their work is limited to climate and to the financial aspects of climate change on businesses. The other sides are framework developers, rankers, and raters. So alphabet soup, standard setters, the names you must remember when it comes to the actual reporting is ISSB, EFRAG, GRI, and to a lesser extent, Securities and Exchange Committee in the United States. So now let's get practical. The amount of misunderstanding we see in the marketplace on sustainability reporting is huge. So on the Philippines, where the uptake is 71% on GRI, the other 29% use a metric that is completely based on the GRI, set by their local Securities Exchange Committee. But they said, why shall we still advise businesses to report under GRI? Now we also have TCFD. Or why GRI? Now there is ESRS. And here you see that you could tell the same. Why use ISSB? Now you have ESRS. The big challenge we face here, ladies and gentlemen, is alignment. Is alignment and interoperability. The world is not served by more standards, by more incomparable data. Stick to what we have. I think Europe here made a tremendous important step and a tremendous important contribution. Like the IFRS Foundation did with the introduction of the ISSB on creating awareness on this very important topic of sustainability also for capital markets. Because as I said this morning, sustainability is about longer-term risk management. So what do we have? How does this landscape work? Very simple. We have the financial part on sustainability, and we have the impacts part. The SEC and the ISSB take care of the financial part. So what are the effects of climate change and social governmental topics on my bottom line? The examples I mentioned this morning, I need additional energy to cool my products. I need to take care of my workforce to avoid unrest and bad ratings so I can't get new talented staff. We call that the outside-in approach. Then we have poor old GRI. We are of the inside-out approach. So what are the effects a business has whilst pursuing its strategic objectives on the environment and on socio-economic cohesion? And the fun thing is, if you look at that last part, the impacts a bit longer, it will always translate into that bottom line. So you see that ISSB and GRI are basically two sides of the same coin. They are perfectly complementary. Hence our memorandum of understanding that shortly will be expanded and extended. So where does Europe play a role in here? They have the concept of double materiality. So they very wisely said, you need them both. Because if you show them both, if you show the financial as well as the impact effects, you give both society as well as investors a good overview on where business is heading to. Not only past and current financial effects, but also the longer term. And isn't that what investors and society wants to know? What is the role of GRI in this whole spectrum? And if you often hear, it's so difficult, this landscape, no one understands it, can you explain it? This one I honestly stole from my friends at TNFD, and I think it explains it quite well. And then I end in where GRI sits in this whole game. You have the Paris Agreement on climate and the global biodiversity frameworks. And they have been the driving forces behind the TCFD and the TNFD. So here you see that the question of my friend, the regulator in the Philippines, that why advise GRI now there is TCFD, or why should we use ISSB because there is ESRS, is perhaps a bit weird. Because a framework is something different than a standard. A framework sets the metrics and the environment on those topics to report on. It does not tell you what it is, what the format is, how you report on it by itself. So we as GRI have one mission: to enable businesses to provide comparable information on their impacts on behalf of investors and other stakeholders, so they can make, as was said, decisions based on facts and not on perceptions. We do not sit in the chair of boards on CEOs to tell them what they must do. That's their own decision. We want them to report on it. As an enabler to show the wider public and investors what their initiatives are, and also as a part of their accountability. So these frameworks are being used by governments and regulators to assess the topics that should be reported on. And how to report, look, GRI IFRS, the one outside in, the other inside out. Together with the IFRS and GRI, both sides of the same coin, you have the full spectrum what to report. Hence again, our close cooperation. Then, what about the double materiality one and Europe? The good news is that the impact side of double materiality under the ESRS is largely covered by the GRI standards. Our co-creation agreement with Europe has led to a set of standards that, with a big bit of haggle and fight from time to time, is that there is a very, very clear likeliness between the standards. We're currently mapping it out. So if you currently report under GRI, you should not be worried to do too much under the impact side of ESRS. That's what we mean. And then together, with our friends of the IFRS, we are driving what we call the Global Comprehensive Baseline for Sustainability Reporting. Why? Because many regulators and capital markets like to see this information. In the Asian and Latin American, African regions, many users, many reporters use GRI. So why reinvent the wheel? Why not add the ISSB as part of the IFRS Foundation on top of it, and we boldly going to implement them as the baseline for this reporting? We exist 25 years. IFRS Foundation exists 25 years. The 11,000 multinationals that use our standards also use international accounting standards. There is a proof of concept. There is benchmark information, perfectly stored and prepared by CDP. Have a look at it. Could use more GRI, but that's our fault. But we will change and remedy that. So why not? So I am very, very, very positive about the future of corporate reporting. Also because most of the businesses have a serious interest in under pressure of capital markets. But also they know that not taking care of these topics is bad for business. It's the new business. We do not discuss here just a report. We are in fact discussing the transformation of a global economic model, whereby we should take into account the entire supply chain. But that's another conference, starting at small, medium enterprises, that should provide the Scope 3 information. And I can tell you, when you speak to sugarcane planters in Nigeria, or small manufacturing companies in the Asian region, there are 70 million of them, it will be quite a daunting task to absorb that information, make it quality data in order for the proper reporting. But that's another conference. So, to cut a long story short, GRI, together with EFRAG, took care of the impact side of the ESRS of reporting. GRI, in its Memorandum of Understanding with the ISSB, is driving hard for this global comprehensive baseline. And all over the world, we get very positive feedback on this initiative. Even in the United States with the Business Roundtable that is seriously engaged in this. And don't forget one thing, the fact that you have some politicians in the States with some interesting ideas when it comes to sustainability does not mean that US business is not engaging and not interested. Same applies for large US investors. They are, they care, and they know why. Thank you very much.
Alco, thank you so much. And I completely agree with you. I think these topics and maybe actually understanding the positions and relationships, interlinkages between these different reporting standards and different parts of the soup, let's say, it's quite difficult and quite complex. And to be honest, I think this has been one of the best explanations I have ever heard. So thank you so much, both Maxfield and also Elko. Also, thank you, just maybe to take the opportunity, thank you for all the amazing job you do and you've been doing on the sustainability standards, because this is definitely pushing forward the agenda and the discourse. And now we are going to move to a very interesting part of the agenda. We try to, here at the CEE Summit and also at ISFC, try to keep it fresh. And while panel discussions are really exciting and really insightful, we actually try to, and maybe want to maybe try something new here. So now we are going to do a debate. So slightly different format. So I would like to the stage, invite Pierre Schlosser first as the moderator of the panel, Deputy Director of Florence School of Banking and Finance. And I'm not going to give too much away, because I think you can explain what's going to happen. I'm not sure if you want to maybe sit in the middle or what's...
No, I prefer on the side.
On the side. Okay, good. And then I will also like to invite to the stage Margarita Pirovska from the UNPRI, please. Welcome, and Maxfield Wise again from CDP. We have Sean Kidney from Climate Bond Initiative and Janku Daramus from Fulcrum Asset Management. So I will probably just pass on to you, Pierre. So enjoy the debate and good luck to both sides.
Thank you. Thank you. Please take a seat. So Julian, thank you. You did half of my job. I very much enjoyed that. I wanted to say something on topic. So this session is going to be a bit less deep down in details than the previous one, but we'll try and elaborate on it using sort of the ISSB standard as a case study of our discussion. Now, I promise from now on we won't use any acronyms. It's over. I think that you're done for the day. And maybe there are too many in the business, a separate discussion. But let's not go there. I'm very glad to be with you today, the four of you who you've been introduced. In terms of the topic, and then I'll say some words about the format and about your role in that conversation. The topic is a bit more high level than what we see here. And the question is basically the following. Is ESG a paradigm shift or an outdated concept that needs to go? So again, I ask, is ESG a paradigm shift or an outdated concept that needs to go? And then in terms of format, what we're going to do is we're going to have a sort of Oxford Union type debate to discuss this question. There will be two speakers going for one direction, two speakers going for the other direction. So the speakers for the yes side today, for the paradigm shift, are Max and Margarita. And then the speakers for the no side, so ESG is basically an old concept, is Janku and Sean. The way we're going to do this is that we'll have 3 rounds. In the first round we'll have what we call opening salvo statements, 5 minutes, not more. First by Maxfield and then the no side by Janku. And then there will be a second round, the rebuttals, first by Margarita on the yes side and on the no side by Sean. Time is indicated. It's like here too, so you can have a look at the watch in front of you. And then, most importantly, there will be a third round where you can come in. And then speakers can more freely also exchange on the previous commitments and the previous perspectives shared. Now, this is, as you know, Oxford Union is largely inspired by what's the dynamics happening in Westminster and at the UK Parliament. So there are things that you can do to contribute. Today, you're going to be a member of Parliament. And you're going to exchange through ways that you deem most appropriate, but the protocol usually tells you that if you agree with something that is said, an argument shared, you should say, here, here. If you disagree, you can make a different type of sound, but that's okay. And then my privilege is to say if there is too much fuss and too much confusion, is to say order, like in the UK Parliament. So I said order, order, and then silence should prevail. I don't want to be longer than this. Again, this is supposed to be a bit of a different format, and we're really looking forward to have this discussion with you. So with no further ado, I would give, again, the floor to Maxfield for 5 minutes to make a case.
Yeah, happy to make the case, but I would put it this way. In a world of increased scrutiny, standardization and regulation, environmental reporting, it's now a business norm. I think I demonstrated that in my keynote just a second ago. But I would say that, yes, there is a paradigm shift. And I would say that this paradigm shift was actually pioneered by CDP. We've been doing this for 20 years. We've been preparing companies for this very moment. And we've played a foundational role in developing and mainstreaming and standardizing ESG disclosure. So we've seen this happening. We've been doing this. And the markets now demand effective and consistent climate-related information. And the development of the ISSB standard is that global response for that need and is that global response for that demand. And we're enabling to ensure that this information is put out there to investors and to reduce the disclosure burden of companies. You need that global baseline by aligning requirements. So, as I mentioned earlier, in 2024, CDP is going to integrate the ISSB standards, and we're going to do this into our global disclosure platform. So once that happens, ISSB is going to be instantly scaled. This past year, we had 18,700 companies around the world. This is more than half of the listed market cap. Next year, with the integration of ISSB into the CDP disclosure platform, it is going to be globally scaled. And this is going to be rapid adoption of ISSB across the global economy. So as the only global environmental platform, we essentially have a building block approach. The ISSB, it's going to serve as that global baseline. And then on top of that, we'll layer jurisdictional approaches like the EU sustainability reporting standards to put in ambition. Importantly, the ISSB is including Scope 3 emissions into their standard, and this is a very welcome development to ensure that this is also cascaded throughout global supply chains. So CDP, we're standing to support companies to ensure that this paradigm shift continues to happen, that there is a limit to climate-related financial risk, and disclosure is going to be key for that. I would say here that the development of the ISSB standards, it's been welcomed by the G20, it's been welcomed by the G7, by the Financial Sustainability Board, and in some companies, in their jurisdictions, they've already signaled the intention to integrate ISSB, and ISSB will underpin this. So this is happening, it's here, and we need that consistent financial information, and ISSB is that standardization process that has allowed us to transform our global markets and ensure that we have the sustainable economy. So I would say that this is business as usual. There's no pulling back. I wouldn't see that any potential argument against this case, where ESG reporting underpins the capital markets. You need to have consistency of information and consistent quality data. And we're going to continue to support this. We're going to drive it through our disclosure system. We scaled from 12,000 to almost 20,000 companies just last year. Imagine how many more companies will be disclosing next year using the ISSB standards, and will provide that globalization and through our disclosure system to empower this for the capital markets, for investors to make better financial systems. So the paradigm shift has already begun. Welcome to the new era.
Thank you, Max. And I think if I were to summarize your argument, I could dare and say that essentially, according to you, the ISSB, and I said it again, standard is basically consolidating the paradigm. But maybe we can disagree. The floor is yours, Margarita.
Thank you, Pierre. So, hi everyone. My name is Margarita Pirovska. I'm Director of Policy at the PRI, Principles for Responsible Investment. We are an investor initiative with more than 5,000 signatories around the world, pension fund, insurance companies, asset managers. And we have more than 50 signatories in Central and Eastern Europe, and we hope to have many more as we are growing. So this is why I am here today, and I really much thank the organizers for putting me in the yes camp, and I'm sorry for my colleagues.
It's a lot easier, isn't it?
So there is no going back, and the world has dramatically changed. Since 2015, all governments around the world committed to a new overarching goal, which aims to transform all our economies everywhere around the world to be something that they aren't today. We haven't had such overarching goals, net zero by 2050, that will integrate all economic activities in the coming decades since the Great Wars. It is about transforming the way we do business. It's about transforming the way we consume, we interact. It's about transforming the way we invest. And our signatories are very well aware of this. So there is a paradigm shift. And in going there, we need to change the whole spectrum of frameworks, regulations, rules of the game that direct our decisions, professional and personal, on a daily basis. And that includes what information market participants provide to investors and to broader stakeholders on their performance. Until a couple of decades ago, this was mostly about financial and business-related information, and more we see demand for other types of information and data, which some call ESG, others will say it's already priced in, but whatever everybody's opinion is, there is a change of regulations. And Martin Spolch from the DG FISMA this morning talked about it, and ESMA talked about it, and all regulators that we at the PRI are engaging with to support the creation of an enabling environment are engaged in sustainable finance policy reform. And the bedrock that our GRI and you earlier were talking about, this is data. For many years, our signatories have complained that there is no good data, or if there is data, it is not comparable, or it is comparable, how it's not really standardized, so is it trustworthy, etc. So now we have the creation of a global baseline with ISSB. It really matters for interoperability of different regulatory frameworks that are sprouting here and there. It matters for quality of the data, because all of this fantastic work that GRI and CDP and others have been doing all over the years voluntarily, because they know it has to be done, now it will be developed as a standard. It will be a building block. Regulators will be able to bolt on other things, but we have this paradigm shift with the new baseline of common denominator of climate and other ESG data that is being developed. So to conclude, we have no choice. So it's already happening. We need to make it work one way or another. We need to make it work for all of those different disclosure regulatory reforms to be effective, for all of this to be a good use of taxpayers and clients and beneficiaries' money, and for the economic transition to be effective, because we have no time, and whether we like it or not, we live in a changed world, and we need to adapt the rules to be able to navigate this transition. Thank you.
Thank you, Margarita. There is a need for global baseline and a common denominator, and I think that there were more arguments in what you said too. So enough on the yes side. We'll now move to the no side, starting with Janko.
So thank you very much. Thank you for the invitation. I was reminded coming into Prague of Kafka saying, I don't know what the question is, but my answer is no. And I sort of pretend I actually don't know what the question is, because I would like to change the question from is ESG standardization a paradigm shift? I'd say there's no such thing as ESG. There are ESG risks, factors, opportunity, which manifest in many different ways. You can't lump them together, let alone standardize them. So if we just take the sustainability part, just look on that and explore these ideas. I'd like to, well, I'm in sort of an ungrateful position like the Grinch after lunch to say something and try to argue against what to some degree is obviously a good thing. The amount of time I look at companies' reports and it's a bank and they don't disclose what they're financing, but they're telling me about the employee travel. So obviously we all know that there's patchy disclosure. In some sort of sense, standardization is very helpful. And of course, to give unto Caesar what is Caesar's, you know, we at Fulcrum Asset Management, we're an independent asset manager. We invest in many things, including third-party managers and equities. If it's a third-party manager that doesn't report to PRI, for example, that might be a flag. If it's a company that doesn't report to CDP or SASB, it gets a votes against. So clearly the work that is done in standardization helps investors. At the same time, I think we shouldn't be deluded around some of the false promises of standardization. And I mean two things by that. First, I'm sure we'll have all heard people pretending to care. Oh, I'd really invest in this climate if only we had the data. We have enough data to act. I'm very glad to see Mark Campanale from Carbon Tracker in the last row. Carbon Tracker pioneered analysis that was precisely there in groundbreaking because companies didn't report. That wasn't dependent on companies reporting in that particular sense. So to some degree, I think the excuse around imperfect data is occasionally used disingenuously. I'll give you an example within Fulcrum. We've decided, as I said, we invest in many things, but the long-term, long-only equities that we hold are all climate aligned. And by that, I mean companies with a pathway that is considered aligned with the Paris Agreement. Is the data imperfect? Could it be improved? Of course, and we're working on it, but there's enough to make a move to start to align capital today. And I think the imperfections around data aren't that big of a roadblock to allow for action. That's the first point. The second point is, I think, around what it is we're doing when we think we standardize things. So people always complain, the best example, Scope 3 data. You know what I'm talking about, the value chain emissions of a company and its suppliers and its customers. We don't have data, it's imperfect, it's estimated. Okay, if Moses came down from the mountain with the tablets of Scope 3 data that God had given, and it's perfect information, you wouldn't know what to do with it. Because the question is, what is the data, is what's material about the data. For some companies, it's absolutely hugely material, right? An oil company might lose revenues. Scope 3 is a proxy for carbon risk. But you can't assume it's a proxy in the same way, that if only if you had the data that solves the hard challenge. It doesn't. That's where the challenge begins. So if you want to have a bit of a debate, I would maybe perhaps slightly question the 700% number you were showing, or 700 times number. The mere fact that there's more emissions doesn't mean this carbon risk is proportionate. That's the job of the investor, to figure out, to allocate, to decide what the proportionality is. And so building on that, I think the idea that it's for investors to decide. If you think the definition of sustainability within ISSB, sustainability means sustainably managing your relationships and resources. Well, you don't need a degree in logic to see the potential circularity here, and that's the challenge. What things need to remain as they are and what things need to change? How to back that with capital? You might think as an investor, hydrogen trucks are the way to decarbonize transport. I might think it's battery vehicles. Now, I don't think it's for the regulator or the standard setters to say which of us is right. Sure, policymakers can decide what they want, absolutely. But the question of standardization, I think, in a way can outsource or make it seem like you're outsourcing judgments, analysis, and that's really the heavy lifting. So sort of to sum up, I'd say, you know, we should stop focusing as much or think in parallel about the problems with the data and think about the problems that the data is for. And standardization, thank you. And standardization can help us get some of what we want, but it's really ambition and action and judgment that will get us what we need.
Okay.
Thank you.
Thank you. I think you've summarized it very well at the end, so I won't recap the recap. Sean, you're on the no side.
Am I?
Today.
Look, risk is not new. This isn't going to change. This is simply a matter of getting back to business as it should have been done for the last 150 years. In fact, has actually been done for the last 150 years. In the engineering sector, we understand about risk and standards, and we use them, and we have used them to build these buildings and the Charles Bridge and so on for a long time. The problem has been the execution of the standards and disclosures that we already have. In Turkey, all of those buildings had good regulation. They had very bad implementation because there was bribery, there was corruption, and people didn't bother building things to the standards that we actually have. We've known about these kinds of risks for a long time. That's my first point about that. This is not new. This is not going to change the planet. I'm just going to say this is simply getting back to doing things the way they need to be done. It's one thing. I suppose another point is that the problem with the ISSB approach has been this concept of relativity, disclosure and relativity. I mean, first, we have to be wary of promises of global change around disclosure. The biggest own goal around disclosure in history was in 1992, when US activists managed to get Congress to pass legislation so that the executive remuneration of the listed companies on the stock exchange had to be disclosed. And the idea was investors, the PRI members, would do a fantastic job of looking at them and scrutinizing them and pushing down their wages. In fact, the only people who read those disclosures were other CEOs who all said, I'm as good as Jack Welch. I should be paid as much as the CEO of GE, and that's when we saw the massive escalation of CEO salaries. So disclosure isn't necessarily an antidote. It might be useful. It's a little bit uncertain. What we really need, given the challenges we face, given the freight train of climate change coming down the road, are a couple of very simple things. We need to decide what to do by way of building it. We need some bridges here. We need 1,000 wind farms over here. And then we need to execute. In a way, a different model is what the European Investment Bank has done. Lucien, you know what I mean. We simply decided, after a long and hard and painful discussion, that 50% of the investment made by the European Investment Bank would be allocated to climate-related investments, if I might loosely use that term. And the other 50% would make sure we didn't mess up resilience while we were doing it. Very simple. When we want to change the world, it's not about shuffling deck chairs in the Titanic, which is implicit in the relativity of ESG. It's actually about changing the course of the Titanic by changing decisions on planning about what we do. Urban development policy and planning. 80% of us are going to be living in cities in 30 years. Infrastructure policy. The job support that in fact, the role of the public sector is what really delivers sustainable returns over time. There is a terrible risk with the ISSB discussion that somehow it's enough. All it is sensibly, usefully, bringing back what we used to do before Milton Friedman buggered it up by telling us we should only look at short-term financial returns, which was a total misunderstanding of how we deal with risk in societies. In fact, we need to be focusing on how we create the future that we so urgently need to head off catastrophe. We need to be focusing on absolute allocations. The taxonomy is an attempt to do that. It's an example of simply saying, this is a shopping list of what we need to do. Now, would you bloody well go away and just do it? Well, actually, we need to bring government officials and the EIB, etc., to deliver. But it's a very different approach to disclosure, standardization, which I'm going to say is useful, but is part of the solution, a small part of the solution, and dangerously diverting if we don't look at the real agenda. We didn't build our modern economy with disclosure. We didn't build our modern economy with ESG metrics. We built it by deciding we needed the Charles Bridge where it was, that we actually needed the infrastructure, that we needed to invest in industry, economic planning, policy planning. That's what created the world we have. We just failed to think green while we were doing it. So we need to add that extra layer. Simple.
Thank you. I thought you would go somewhere else too, but this is a great way to end. And I think that you've been advocating for reality, for real, and for needs, rather than metrics and means compared to ends. I would like to give a chance to the audience to start thinking about your questions. I'm sure that there will be many. And before we do that, to give you a bit of head start to get prepared, I would like to give briefly the floor back to both Max and Margherita to give a chance just to feed back onto what you heard on the north side. We can invert the order as you prefer.
Doesn't matter. Would you like to start out?
Yeah, sure.
There's a lot of
we already have the data.
Yeah.
How much money do you spend on normalizing that data to make it comparable? And how much would you like that at least some of it was standardized and unquestionable when you make investment decisions? At least, I know you are a PRI signatory, and many other PRI signatories have been complaining a lot about this lack of baseline, so that ESG data providers can build fantastic, solutions made to measure, and then investors can make very specific, informed, bespoke investment decisions based on that. But we need that common ground, and you know it.
Was that a rhetorical question or not?
Yes.
We're going to have feedback.
We have standards, but bad implementation and disclosure not an antidote. I absolutely agree. As in maths, disclosure is one of those things that is necessary but insufficient to get things moving. But you do need to start somewhere, and to make informed investment decisions, you do need data, and then you do need other tools to make sure that you act on the data and you make the right call, and then it goes all the way up to industrial policy that we see sprouting at the moment. One last thing I wanted to add, there are more than 80% of listed companies out there that do report some climate data. And the fact that they're all trying to do their own thing and responding to different questionnaires, etc., and not have at least something that they can rely on, okay, this at least I need to do, and everything else, it's bespoke and, additional. that it's already happening. So having, you know, a clear standard, it's just a natural next step. It's absolutely logical. So I think we all agree that the yes team has won.
Let's see if they agree on the other side. Janku, and then we'll give a chance to Max, and then we'll finish with Sean, and then open up.
I mean, should you ask a barber if you need a haircut? Should you ask organizations involved in reporting how important reporting is? That's one point. The point on how much money is spent, I'm beginning to worry, actually, that there's more money implicitly spent in terms of resources on me reporting various things than on me normalizing the data. In the first case, I'm glad to spend some time because I am asking the question, how do you normalize? A good example, do absolute emissions matter or emissions scaled by something? Revenues, market cap, EVIC. It's not a single answer to these questions, right? Different people can look at them very differently, and that's precisely the point here. I am beginning to worry occasionally. There's one particular form, so we have a climate strategy which is classed as an Article 9 fund. One of the forms I have to fill for it has 666 lines, and I was filling it in on Halloween, so that was doubly appropriate and scary. Occasionally, elements in standardization also create deadweight loss, and I worry about that too. I take the point that you need baselines for certain things, but how much? Particularly when it's expanding. People say, okay, we've decided how long is a piece of green string. Now we move to social utility or other things, which are even harder to decide. Like philosophers have been at it for 2,000 years, and they haven't come to it. So I think they're trade-offs. That is the thing they would like to bring. Not that it's very important, absolutely. No way I'm coming across as slagging the ISSB. They're very, very important. But there can be trade-offs, and sometimes I worry they're less appreciated.
Thank you. Max.
Yeah, you know, you're right. We already do have a lot of data. It's true. But that data is a hot mess, and we need to do something about it, right? And if you look across the board, within your own first commentary, you mentioned how some banks are reporting, when it comes to Scope 3, on travel as opposed to their own portfolios. Didn't you answer the argument right there that we need standardization on how companies are addressing these risks and looking and reporting on that information? And why we have a lot of data. Data's outdated by the next year. The moment you report it, you need new data. So do we keep circling around with bad data, data that's a hot mess, that data that's not being reported in a consistent way? Or do we put some standards in place to make sure the effort that is going to continue, irrespective of your points, is done consistently and can actually drive meaning? Further, I would comment that going through the process of providing data, from the idea of what gets measured, gets managed, is imperative. When we have asked companies through our supply chain program, we have over 300 companies asking thousands and thousands of their suppliers to respond. We found that after going through the questionnaire once and being asked that information, you don't have a sustainability target. But after 3 years going through the process, companies are 10 times more likely to have a sustainability target in place to address their emissions. What gets measured, gets managed. It's imperative that we do it in the right and consistent way. You yourself said that it's just one part of the problem. And you're right. We're not going to solve the entirety of the problem with disclosure. But as my esteemed colleague said, you need to start somewhere. And in and of itself, we have been calling it the global baseline. We need the baseline. And then we can jump off to all the things you said are necessary to get towards action, because that's ultimately what we need. We need a 1.5 degree world that's nature positive, and that's going to start with consistent, comparable, standardized data so the capital markets...
Sorry, it's going to start with consistent... I mean, there's a bloody freight train coming down the rail. You're going to wait till the data is consistent, comparable before you start? I mean, for God's sake,
how it started.
We have a few short years to act. This is like twiddling while the fire burns, you know.
And if you don't have the
deck chairs,
information,
stop picking your way out of a problem. I mean, you've got to be real here.
But if without the information, how are you going to align your portfolio in the right way? Right?
Align your bloody portfolio, for God's sake. What relevance is aligning your portfolio when the Titanic is heading to an iceberg? That's the whole point of this, and that's the challenge of what we face, that unless we act to change the Titanic, we are missing a beat here. We can spend a lot of time fussing around or shuffling our portfolios. And a lot of your PRI members have. I want to get 2 degrees aligned. I will shuffle out my brown stuff and just have green stuff. I mean, for God's sake, that is not the point. A better idea would be the way we're doing it in Japan, which is we have to transition the economy. We will work with everyone. Now, we need to make everyone be a little bit more ambitious in Japan, but we have to shift these companies. And in fact, what we've seen happening in PRI portfolios is the exclusion of high carbon that need to transform to low carbon because of linear pathways. And there's now discussion going on, the Net Zero Asset Owners Alliance, about how we allow SAS oil to be bought in, which is going to blow out everyone's carbon figures in the short term. Because, you know, we need to simply understand what we want to do. It's not going to happen by investors changing their portfolio. It's going to happen by governments avoiding Brexit. Talk about large-scale value destruction, right? Would ISSB have helped investors in the UK when the UK government went on a long suicide mission? No, totally irrelevant. Or on the other side, in the US, the IRA is creating champions out of nothing. We're throwing money at them, which is blowing out all our data stuff. Occidental is my new hero. Occidental, an oil company, because they're building direct air capture in the Texas outlets to bury carbon, take it out of the air purely because of the blunt instrument of subsidy. This is not something as a result of disclosure or data revision, guys. Come on.
No, okay, thank you. So I think that we sparked the curiosity of the audience, and I'd like to reframe my earlier intervention, which is about saying, actually, you're members of parliament, so you're allowed to say whatever you want. You can ask a question, you can react, you can share your views, you can show agreement or disagreement. So why don't we open up now? Anyone who wants to take the floor? Please. There is a microphone going around. And please introduce yourself before interviewing.
I'm a member of parliament. I want to know, the CDP PRI guys, are they actually funded by the oil industry?
Fantastic, thank you. We'll address this one.
We're not, part of our regulations don't allow us to take sponsorships from the oil industry.
The clock is ticking, so let's collect. Second intervention, second question, comment, reaction. Also in the back. Not at this stage. Here we go.
Hi, it's Lucy from Responsible Investor again. So we're talking about what is and is not a fruitful use of time in terms of data collection. Net zero has probably been the biggest data collection exercise instigated in the past, well, for a long time for the financial services sector. Is that a complete waste of time then? Should we have been getting on with addressing emissions rather than collecting data for net zero?
Thank you. Are you addressing the question to someone in particular, or is it for the whole?
No, for anyone on the panel.
Thank you. Okay, so we have those two questions. I think that I would change a bit the order and ask Janko first to intervene on one of the two questions, and then we're going to redistribute.
Okay, I will not expose the oil funding. That is up for you. I would say it's not at all a waste of time. There might be concerns around the amount of time spent modeling various things. That is a question of sort of the proliferation of consultants and various things. That's one side. But once you take very seriously the idea of net zero as a policy signal, and we heard today that that's probably a running message today, right? People keep saying Europe's going back to coal or whatever. It is not. The signal has strengthened. Every country you look at, particularly in Europe, it's lessening its dependency on fossil fuels or planning to. So if you take that seriously, then the exam question becomes who is and isn't aligning. And I don't think you can do that just with rules of thumb. And in that sort of sense, absolutely modeling up needs, because what I think is happening is too much of the current industry in the sustainable finance world is backwards looking. Are you in the wrong sector? Or at best, they even use a bit of data to find out how you compare in your sector. They're not looking at where you're going. And that's in a way back to my point. You can have the same emissions today, but have very different carbon risk. For all of that, you do need, I think, data and modeling. So no, I wouldn't say it's a waste of time. Though bits of it are.
Please. Would you like to react to this?
I'll speak last.
Okay.
I'm good. I think it was so well said.
Well, never lose your chance. But I'm not going to mention data.
So you're elaborating on the
Net
question.
zero is clearly something we need to do. But frankly, not in 2050. It needs to be tomorrow morning, if you talk to a climate scientist. So it's an attempt to develop some targeting to get us going, and it's a useful paradigm shift, okay? I disagree that we want companies or investors to justify their portfolio around a net zero framework. For companies, I simply want them to do what they need to do. And that's why we've developed taxonomies, to guide them. I want a triple glazed windows manufacturer to just do a lot more triple glazed windows. Even if they don't get built in all the homes and we've got a problem, I just need them to manufacture, a wind turbine manufacturer, etc. I need companies to build the right kind of stuff. I need Occidental to abandon its oil because it can make more money out of direct air capture and shift. I don't need them to justify what they're doing in net zero. That's what we do at a macro level to provide guidance for them through things like taxonomies, through IRAs, through credit support, through incentives. For investors, I actually do not want investors to align their portfolios to net zero, because if they do that, they still keep gas in there. I actually want their portfolios to be swamped by green. And the way we do that, investors can help to argue with governments, please create the things that I can invest in for a sustainable future, renewables, etc. So my portfolio will be skewed to green because I'll have so much to invest in that's coming through, that's changing the world and the way we need to change it. That's what I want investors to do, not to tentatively align their portfolios to getting the net zero in 2050. Hey, it's a useful starter, speaking of starters, but it's not actually the ambition. We need to flood the world in green deals. In fact, we need to try and make all deals green from now on. That's how we'll transform our economy.
Here.
I have to respond. No, not
Please.
here at all.
We have 4 minutes left.
Yes, very quickly. I would agree with you if we had time, but we don't have time. And as much as investors are expecting governments to step in further, and they have to, it won't be sufficient. It will be necessary, but insufficient. We're at the moment where we need to use all the wedges of action to move towards net zero, because the door is closing very fast, and we need the net zero alliances, and we need investors to act as true stewards of capital. We need data all around to inform decisions quickly. We need governments to move on. We need multilateral action and financial architecture that is fit for purpose to support this great economic transition that we're facing. We need consumers, beneficiaries, trustees. We need action from all sides. So all of those taken individually, including disclosures, are necessary, but alone insufficient. Government action alone is necessary, but insufficient. So this is why you need this great wave of progression pathways on each side of the economic spectrum towards net zero, because otherwise we're not going to make it. And then the next generation, there will be a lot of Gretas who will be very, very cross at us, and we will have lost the battle that we could win today.
And I'll just say one word: accountability.
That was one word. We have a few really limited minutes left. If there is a burning intervention from a member of parliament left, who is not going to have a cigar at the parliament, fumoir? No, nothing? Okay. I had a question because I think that we're connecting now to the needs of the real economy. One of the forgotten fuels that is actually would help us in net zero is clearly energy efficiency. Would you consider that we have good data, enough good data about this, generally speaking? Are we doing enough to raise the level of attention of, on the one side, the wider public, but also investors on this particular segment? And we have 2 minutes left, so just we'll start with you, Jan.
This is one where weirdly I would argue in favor of standardization in one way. It's very common for people to talk about so-called avoided emissions or displaced things or things which you didn't use, right? The problem is it's completely hypothetical. So building a wind turbine in Europe 5 years ago would have displaced, say, coal. Last year it displaced gas. It's a sort of minefield to allow everyone to sort of just make up their calculations. I would argue that potentially standardizing things and making sure their data is timely and lively and you can't just pick the dirtiest comparator, I think that is actually a very important area.
Okay, Sean?
Clearly, we need an obvious labeling scheme. I want to be able to walk around Prague and look at things and say, oh, that's climate consistent. And this hotel isn't. I'm not going into that hotel. Obviously, I want visibility. That's part of the mixture. But fundamentally, what I want is the kind of regulation that means that a hotel that is not appropriately energy efficient is not allowed to operate. That's where we've got to go. So we've got to be careful what's really going to change things versus what's going to make me feel good or an investor feel good.
Yeah.
Yeah, I mean, one of the things I didn't say earlier about standardization, you kind of touched on it, is greenwashing, right? We need to have standardization across the board here. I mean, if you're looking at the same idea of how one oil company is disclosing its scope 3 or another, so when it comes to ideas of energy efficiency and what is green and what's not, we need to ensure that that exists within the marketplace to ensure that we're rooting out greenwashing at the base, and standardization is going to be key to that. Okay, thank you.
Our colleague from CES who spoke earlier could comment on that, but in Czech Republic and in Central and Eastern Europe more broadly, where there are true energy dilemmas to address, there will be a lot of small solutions to come and help together, and energy efficiency is a quite important one among those solutions. And we are at the stage of the energy revolution where we'll have a complete contrary of the French energy revolution after the Second World War, where one big solution was put out there and the entire country had to bow to nuclear. Nuclear will be part of those solutions depending on the countries, but we'll have nuclear, energy efficiency, renewable energy, geothermal, etc., that all of those together will be all of them needed to achieve net zero. So, of course, energy efficiency, but also so many other solutions. It is not impossible. 1.7 is good, but 1.5 is better. And there will always be a new technology coming down the road. This is why R&D is so important to get to 1.5, and we can make it.
Thank you. I think, ladies and gentlemen, we found an agreement. Thank you, everyone. Thank you for the room and for the wonderful speakers. This was partly, of course, a role play, but I think that you did great. Thank you.
Well done. Thank you very much. Well done to both camps. I hope you enjoyed this as much as I have, and now we'll have a short break. The only thing I'm really sorry Pierre didn't have any chance to say order. Maybe next time we'll be louder. But thank you very much. And now we'll have a 30-minute coffee break. So please have some coffee and some refreshments. Thank you. Okay, good, ladies and gentlemen. We can come in closer here. So let's start the second to last block of discussion and of keynote speeches today. And we're actually going to talk about a very interesting, very close topic to my heart as well. We will be talking about S and ESG and the social aspects now. And we will kick off this block with two elevator speeches, as we call them, but it's essentially as a keynote as well, or maybe a shorter, punchy, energetic speech, no pressure for the speakers here. And we will start with András Puskás, Deputy CEO and CSO from the Magyar Bank Holding. So András, the floor is yours.
Thank you very much. Where is the wedding? So we're just waiting for that. So Dobry den, Praha. Good afternoon, ladies and gentlemen. My name is András Puskás, Deputy CEO and CSO of Hungary's MBH Bank. My role is to provide strategic guidance on ESG matters, helping the financial group to align its operations with international sustainability standards and leading efforts to promote green finance. Thank you for the opportunity to share our views and efforts, as these are extremely exciting times for us. We just finalized the greatest bank merger in Hungary, and in the Hungarian history 2 weeks ago, a triple merger that created the second largest banking group in Hungary. As most of you are aware, banks measure emissions under Scope 1, 2, and 3, where Scope 3 emissions include bank lending exposure as well. Financed emissions are typically the most difficult to calculate, but they are considered part of the financial institution's carbon footprint. When we talk about why this sector is critical to achieving a net zero carbon future, let's have a look at Bloomberg's estimate from 2021, which says that banks produce 700 times more emissions from loans than offices, as Max mentioned earlier as well. But we can find other calculations which are worse than the previous one. So we can agree on the fact that it's important for us to reduce both our own and indirect impact. There is a saying that goes, strength in numbers. Well, the responsibility that comes with this new position in the marketplace is very much felt, and it gives us added motivation and determination to think big and make a real difference. As I mentioned earlier, we just finalized the greatest bank merger in Hungarian history 2 weeks ago, a triple merger that created the second largest banking group of Hungary. MBH Bank is a market leader in several areas, including corporate lending, lending to SMEs, the leasing market, the agricultural and food business, the engaged in a wide range of money, capital market and investment activities. Our aim as a modern universal bank is to serve its retail, corporate and institutional clients with modern financial services and continuously expanding product range that are accessible to all. We firmly believe that we have a responsibility towards sustainability, firstly as a financial institution in our lending and investment practices, and secondly in our operations. We also believe that ESG needs to be integrated into business transformation, and we have taken this opportunity during our own transformation over the past 2 years, landing up to the completion of our triple merger. As part of our ESG journey, we ticked some important boxes last year. We set up an ESG and sustainability department to manage sustainability-related projects and processes in an integrated and cross-functional way. We have formulated our ESG strategy, integrating our existing operational initiatives from our rich heritage into a strategic framework. We have rapidly implemented several projects, including an updated risk strategy and fully embedding climate considerations into our risk management frameworks. We finished in the last month a project where we added ESG elements to the retail, SME, and the large corporate credit risk management process to help manage MBH's portfolio from the ESG perspective. We believe it's necessary to quantify the various aspects of sustainability and to rate loan purposes and clients on this basis as soon as possible. During the project, the bank not only learned about the ESG readiness of its clients, but also developed the data to assess their ESG performance. This will help to expand lending for more responsible products and services. At the end of last year, we strengthened our ESG commitment by becoming a signatory to the UN Principles for Responsible Banking, which is very inspiring, and as it opens up new horizons and perspectives to help us see the bigger picture. Earlier this year, we launched our own net zero project to calculate our footprint, and as a next step, we plan to work hand in hand with the internationally recognized environmental organization to make the most innovative and environmentally accurate decision to reduce our footprint and to be a carbon neutral bank. I'm often asked what I think is most challenging on that path. At this point in time, it's probably the management on the immense amount of the data that is necessary for all the disclosures we have on our hands. That is why one of our key projects, which we have just launched, is to create a company-wide data pool that will enable us to meet these obligations for easily and at the same time provide our own top management with even better quality data for our decision making. We find that the social elements of the ESG are becoming more important after they played a secondary role to environmental factors for quite some time. Of course, we also place great emphasis on the E aspect, going paperless and as energy efficient as possible to reduce our ecological footprint and looking for smart ways to offset the remaining emissions using the SBTIs. We are significantly reducing our paper consumption year on year and implementing digital innovations at the same time to cut back even further. We are increasing the share of our environmentally friendly car fleet, installing hundreds of square meters of solar panels on our office buildings. This March, we planted the first 10,000 tree seedlings of our very own MBH forest. The next 10,000 trees planned for next spring, all with the joint efforts of around hundreds of our colleagues and ESG ambassadors. Social ESG topics may not be as easy to measure as environmental impact, but navigating how to move from simply net zero to net impact is an effort worth making. Society has always demanded that companies serve a social purpose and contribute to making the world a better place. Our strategy states that as a leading bank in Hungary, we are committed to the economic and social development of the country. Social factors are deeply seated in decision-making across all functions and processes of a company. How a company manages its relationships with its workforce, the societies in which it operates. They run across multiple areas of the business, from HR to finance and product design. It is crucial for the social considerations to be embedded in how business strategy is formulated. For example, the entire journey that comes with joining the Principles for Responsible Banking is extremely useful in that it forces us to take an impact-based approach to our business portfolio, to look at our activities through a magnifying lens and commit to achievable targets in the areas of most significant impact. We are at the beginning of this journey, but after the first few milestones, I'm confident that we will have new tools to improve our existing practices. But back to what we currently do, our bank's corporate social responsibility program covers a broad spectrum. Just a quick mention, our priority cases are support for the social disadvantaged by means of integration programs and direct assistance, education and development of financial awareness and digital literacy, and supporting Hungarian art and culture. MBH Bank has set itself the goal as establishing transparent external and internal operations supporting sustainability. It is essential for us to incorporate sustainability-related policies and rules into our corporate governance processes. We also believe that companies that are more focused on social purpose and corporate responsibility are more resilient through change. Therefore, in-house, we developed transparent career pathways to help employees achieve personal growth objectives. We have meaningful policies and programs in place that support diversity, equity, and inclusion. Externally, we develop products and services that will empower customers to adopt more sustainable consumption patterns. We rely on value-added partnerships and alliances that help us achieve our goals. Last but not least, we create and enforce transparent accountability mechanism. I'm across this quote from Alan Kay, which says the best way to predict the future is to create it. And I think it fits well in this context. In this spring, to create the future we aspire to, we will continue to invest in our people, in their skills, training, and development in our customers through product and service development and innovation, and of course in nature and our planet, for example, through our own biodiversity initiative, which is taking shape and will soon be launched. Let's all continue to invest in the future. Thank you very much.
Thank you very much, András, for the very informative presentation. And now we can move on to the next elevator speech, or a lift speech. Elevator speech. Good. Eric, please. So we have Eric Fronczak from Heavy Finance. And Eric, the floor is yours, please.
Thank you for the possibility to give this elevator/lift speech in front of such a noble audience. I would like to begin my story with a little bit of a personal background. I have joined about 4 years ago the world of venture capital and private equity with one major motivation. I wanted to deploy capital in places where it can truly make a difference. During my tenure in one of the leading venture capital and growth equity funds in Poland, I saw exactly this. We invested in companies that with zero revenue throughout 1 year after our investment would achieve even 100,000 euros in monthly recurring revenue. Heavy Finance was exactly such a case. As an exemplary example, this marketplace connecting fintech, this marketplace connecting investors with farmers proved that the sector of agriculture requires innovation. About 6 months ago, I decided to join the company for the very same reason. I wanted to deploy capital where it can truly make a difference. Only this time, I didn't only want to generate returns to our investors, but also, and most importantly, to make a true difference for our environment. As I'm sure that everyone on this floor is aware, global emissions are unfortunately on the rise. I like to look at things in a granular way. It is quite surprising, I think, at least for me, that agriculture, a sector that is responsible for putting food on our table, contributes 1/5 of total emissions generated globally. It is the harsh reality that the sector that actually feeds us all, unfortunately, also significantly contributes to global warming. When we look at things in a more granular way, we see that apart from livestock, old equipment, overuse of fertilizers, and soil mismanagement are the key causes of the issue. Old equipment, as we can all imagine, unfortunately uses way too much fuel. Overuse of fertilizers that is not absorbed by the soil emits carbon dioxide, which approximately emits over 800 million tons of greenhouse gases. When it comes to soil mismanagement, practices such as tilling approximately generate over 1.5 billion tons when it comes to carbon emissions. But there is a way, there is a solution for this issue. Old equipment can be replaced by new one, more efficient. Artificial fertilizer can be replaced by the use of organic one. And mismanagement when it comes to soil can be changed to more responsible soil management. And it's important to note that all of those practices not only are environmentally friendly, but also provide real quantifiable benefits for farmers themselves. Lower consumption of fuel means lower prices, lower bill when it comes to your gas bill. The lower use of fertilizers also contributes in significantly lower operational costs. And responsible soil management, for example, no-till farming, actually produces more healthier crops, which affects in healthier food for us all. Soil itself is actually a very interesting subject. The soil is yet untapped carbon sink pool. If we think about the European Union itself, the arable land can remove on a yearly basis more than 200 million tons of CO2. There is, however, one issue, a big one. This is the financial gap. European studies show that the financial gap within agricultural space is valued at least 18 billion euros. This is the gap that significantly hinders the development of the sector that is agriculture. So we created a solution. Heavy Finance, a borderless lending platform for farmers and investors. So far, since our inception, we have helped over 1,300 farmers, processing loans of total value exceeding 36 million euros. We are currently present in 5 markets: Lithuania, Latvia, Poland, Bulgaria, and Portugal. We have created products that create real financial incentives for farmers to adopt more sustainable practices, where farmers are benefited and rewarded for each ton of sequestered carbon. It is important to note that we have truly built a product that helps farmers, but also that delivers return to our investors. Heavy Finance platform currently have over 8,000 retail investors, over 150 organizations and small financial institutions, including family offices. On average, we have earned for our investors 13% in average interest. When you look at the timeline of our company, you can see few important milestones. First loan financed, first 10 million euro in finance loans, first institutional investor onboarded, introduction of green loans and carbon farming that supports adopting sustainable practices. But we are unsatisfied. We want more. And what we have realized is that in order to attract truly institutional capital, we need to adopt our product so that institutional capital, we need to adopt our product that is more familiar to institutional capital. And this is why I'm happy to announce Heavy Finance Article 9 Fund, a 50 million euro fund focused on sustainable agricultural loans, backed by a leading European institutional investor. Do you want to know more about it? Here is an exemplary case. Meet farmer Maciej, a young farmer, most importantly, a young entrepreneur, consistently increasing his revenue, increasing his arable land throughout the years. Farmer Maciej currently seeks a 60,000 euro loan that is supposed to help him to purchase a 20 hectare land, but also it's supposed to finance his no-till cultivator. Do you want to know the metrics? 60,000 euro loan, 13% interest, 36 months when it comes to payback periods, 63% loan-to-value ratio with collateral assets including heavy equipment and land. But most importantly, almost 2,000 tons of CO2 sequestered throughout 10 years. Thanks to farmers like this, thanks to Mr. Maciej, our funds will generate to our investors approximately 9.5% in IRR, but most importantly, will sequester or avoid at least 400,000 of greenhouse gases. We are a team of professionals with very mixed backgrounds, entrepreneurs, financial professionals with experience of managing over 1 billion euros in debt capital, soil scientists, data scientists. I'm here together with my colleague Rytis. I'm happy to speak with any individual, organization, or financial institution that is willing to learn more about our platform. Thank you very much, and I invite you to join our journey.
Thank you very much, Eric. Really interesting, actually, on two fronts, to be honest, because one, very interesting, innovative way of investing, but also I'm really glad that you touched on agriculture. I feel like agriculture is not being discussed. We often talk about heavy industry and many other sectors, but actually agriculture and the potential of agriculture is amazing. It's really cool to see something innovative and innovative approach like that to it. So well done, and thank you so much for the elevator speeches. We will now move to the next panel discussion. If I can very kindly ask the speakers and the moderator to the stage. So we have the moderator, please. So Giulia Corinaldi, Director of Inclusive Economies at Thomson Reuters Foundation. Please, 1 second. And then we have Barbara Koton, Country Sustainability Manager at IKEA, Czech Republic, Hungary, and Slovakia. Marek Blaha, CEO of Affordable Housing at Česká spořitelňa. And Kestutis Kupšic, member of European Economic and Social Committee. So without any ado, I'll just give you the word, Giulia, and you can take it away. So enjoy the discussion.
Thank you, Julian. Thank you for having us here. And hello, everyone. I think we're heading to the end of the day, so we'll try to bring some energy to the room and also to bring back the S in the conversation. And I haven't been on a panel for actually 3-4 years in person. I've been hiding in the bushes a bit in the last year, trying to figure out what to do with my life. But then Linda called, and I feel like probably we are all in the same situation. You don't say no to Linda. You don't. There's not an option. But also I couldn't say no to Linda because my whole journey with the S has started with Linda and ICFC. We had this idea, coughing just before COVID in a bar, thinking we need to put the S back at the center of the conversation, and we need to bring together practitioners from lawyers to data providers to business and investors and NGOs. And so we started a working group with the PRI, Robert Kennedy Institute of Human Rights, White Kincaid's Refinitiv, and then we had a bigger group of partners, and today a lot of them were here, PRI, GRI, Rep Risk, that brought us into the journey. And really the mission was to debunk the myth that the S is too difficult to do, and so the paralysis that creates. And also an excuse. I think if in the panel before someone was saying, it's just an excuse not to get started. And that's a bit the feeling we had with the panel. And so today the question was, is the S a critical element for resilience? And I think with the panel we decided that altogether we can tell you, yes, it is. And that's it. But what we're going to discuss today is how, because that's where it gets complicated. And we know that. And we wanted to give you a bit of examples on how each of them are doing it from very different perspectives, and you'll see, which have been fascinating to listen to before. From my perspective, on the S, I think, and bringing people to the center of the transformation, the industrial transformation we're trying to achieve. There are 3 big reasons why I think it makes it critical. One, I think, is the opportunity. So in the sense that in order to deliver some of the E metrics, take into account death that will deliver better E metrics. So the World Benchmarking Alliance just showcased a report where board where there's more gender balance deliver better on all climate targets. So it's a positive for the climate as well. And the second reason is a mix of risk and opportunity. I think is we have the opportunity to get it right. The industrial transformation, someone might call it a radical transformation, which we're all hoping for. But we have also the risk to getting it really wrong. And we should be learning from history on how leaving people behind has created fragility and instability in economic, like the UK, who transformed its economy during Thatcher and then had left a huge chunk of the population behind, who created a lot of instability now with Brexit, etc. And then the last is it will hit the bottom line of a lot of the companies trying to invest in the green economy, and it's already hitting the bottom line, not looking at the S. So looking at what's happening with the Uyghur region and solar panel, we know that 50% of polysilicon is coming from that region. And now with the very right ban on forced labor from the Uyghur region in the US, and it's coming in the EU, a lot of the material that we need in order to grow that those industry is blocked at the US port. So it's fundamental. And I'll stop talking, sorry, I think I took it too long. Okay. But I wanted to give a bit of energy on why we're here. And I'm going to move it to Marek. We were discussing, and you come from a very practical, today we talked a lot about indicator reporting, where you were very practical perspective. Can you let us know why housing is such a pressing user in Europe, and how do you integrate social aspect to what you're doing on housing?
Sure. I was, for the last 5 years, I have been leading our retail business of the largest bank in Czech Republic, and obviously mortgages, it's massive. I mean, it's the whole market in Czech Republic is 1.7 trillion Czech crowns, which is roughly 70 billion euro. And this is, if you look on the, you are from the finance business, most of you, so if you look on the total household debts, that's around 60% of the portfolio. And when in 2021 we start modeling what will happen today, and we saw the prices of the real estate and the new limits of the National Bank and the growing rate of the interest rate, then we modeled and found out that 80% people will not be able to get a mortgage. And this is something how we were financing the affordability of housing. And for us, it's numbers, it's clients, it's the mortgages, but then you come to the social issue. What happens if 80% of the nation cannot afford to buy their own apartment, and there is no other way how they can solve their housing needs? And we say, okay, we need to talk to the government, because obviously this is a really painful social issue, and they should do something about it. And they say, you can get in the line, because if you talk to the government, there is already 1,000 people ahead of you, the agriculture people, the teachers, the doctors, everyone is telling do something. So we say, okay, maybe it's coming back to our roots, and we look into our history, and there is actually, it's a funny thing, 1925, the city saving bank, which is Česká spořitelna 100 years ago, decided to build their own quarter of the city. It's called spořitelna, and it's still working. It's on the east side of the Prague, and it's a fantastic district. So we found out actually that 100 years ago the bank has built a whole city district because they wanted to keep the social coherence. And we say, okay, let's start doing the same thing. So we approach municipalities, we approach developers, and told them we would like to start buying our own apartments and to provide it by a rent that is affordable. That means, according to OECD, maximum 40% of the income of the household should be spent on the rent, and the rents at least should be 20% under the market to give it some value. And currently, this morning we signed a contract for another 150 units. So it's a special day for me, because that's a demanded 1 year of work. And currently we have 400 units under development. that will be offered to hospitals and to teachers in Prague to maintain the sustainable development of Prague. Because we found out if the people are paid same in the public sphere in Prague and in the outskirts of the country, then obviously they will move out of the big cities, because for the same salary they get much better life standard. So if you want to keep the big cities working, you really have to do something. So we started to build our own portfolio, and when we approached the hospitals, they said this is the most fantastic thing they have heard in months. So they were very happy about it, and they supported it. And then we, as a Czech Banking Association, we started to talk to the government, but saying, look, we try to do something, but even if we buy 2,000-3,000 apartments and we provide it, that is not solving the whole issue. Like you need to create some policy to scale the solution, and we will be very happy a part of that. So this is our journey so far, and obviously I have to thank Erste Group because it's a fantastic investor and shareholder. I think the affordable housing is in the DNA of the Austrian nation, and they really have understanding for that. So I think on one side we feel part of the responsibility in the country. On the other side, I think you have to have an enlightened investor that really understand that if you want to keep the long-term shareholder value growth, then it's not possible in a country that is falling apart.
Okay, so an investor that accompanies you in your journey and believes in the mission. It's fundamental. And Kęstutis, I'm coming back to you. And what are your thoughts on what Marek just shared? And what are the main issues Europe should focus on the S?
Well, it fits into two very short words, and that is fighting poverty. And fighting poverty is exactly S, because fighting poverty is so much in it. There is so much in it in those two short words. That,
and even better, fighting inequality, or just poverty.
Well, look, inequality is potentially one of the big contributors to.
Okay.
Okay, so let's think about those, let's say, 30% population of those 1 in 3 people who are essentially lacking decent income, decent life. And then you have the collection of all the S parameters. And thinking about what you just said, the housing, the housing issue, it is also maybe a symptom of the whole problem. Because look what you just said, 150, you are so proud of it. And I think you are doing great work. But that's like having scope 1 emissions and scope 3 emissions, if I can use this parallel. So you may have 150 houses, 2,000 houses, whatever.
Exactly.
And at the same time, across the country, there are millions of, let's say, unaffordable houses waiting for their occupants. And there is this huge divide between people who have the capital to build houses for sale, for speculative rent, and so on, and those who cannot afford it. And I think there is no way we can speak about S without touching the political economy at its root. How this economic system is constructed, how it works, for whom it works, who gets the best piece of the pie, and how it's then distributed. Of course, then taxation, jurisdictions with certain features for hiding money, briberies, corruption, those things come to mind. And as it was nicely said today, it's not disclosed. There is no way we can expect that some company will write in its sustainability report that we did this or that, and these things only come later when it becomes a major scandal. So let's say, in my vision, I think that we have to select what's our course to change the whole system, not to just think about, okay, look, we have dirty world around us, dirty economic system which is full of exploitation and injustice. And then we suddenly plant some plans like these little gated societies of happy people who suddenly, for some reason, are sustainably financed and sustainably living, but in the end it will come back to all of them, to all of us, yeah? Because there is no escape. There is only one Earth, there is only one society, and there is no way to escape. While I'm told that rich always escape. They have this tendency to flee. When something happens, they board a private jet and they go to New Zealand. Huh? But where do normal Czech people, let's say ordinary Czech people
yes,
go?
And I think you come back to the point that when we say the only scaling of the solution is together with the government. There is no other way how the finance sector, we say we are ready to finance the Czech I have to admit that the discussions are very productive. I have to say that it's one of the 5 pillars of the government, and they found they found 10 billion Czech crowns, which is let's say 400 million euro from the resilience and recovery facility, to start building the projects with municipalities. But then you say, okay, if you scale it, we want to build as a government, and that's where we have the discussion, you need to build 100,000 apartments. And if an average apartment costs 200,000 euro, yeah, then you multiply it and say, well, you can never find this money in the state budget. And then we come as a finance sector, as we sit here, and we say, we help you to find where the money are. And that are in the European Investment Bank, they are in the Czech banking sector, they are in the pension funds, and they are in the reserves of the insurance companies. And we have enough money to finance the policy and the projects you will prepare, if it's prepared together, hand in hand. And I think this is coming to the point that we believe that the scaling of the social solution and the issues is possible hand in hand with the government and the finance sector, looking on a 20-year horizon. Yeah?
Yes, and also it's about changing a bit the practices. So it's, as you said, you're creating new housing that is great, affordable housing that will have an impact to a lot of people, but then there's a big gap on the market on all the other housing. And so I wanted to bring in Barbara, because IKEA is looking at your practices globally, right? And your supply chains. And so tell us a bit about how you're integrating DS across your supply chain. Your sustainability practices, sorry.
So yes, you are right. We have like some global approach and some global KPIs, but what's even more important to be always locally relevant when speaking about the S. So how we always tackle the issue is that we map what are our vulnerable groups in the markets, and based on some data, based on cooperation with governments, but also with other NGOs and with universities, we try to understand what are the vulnerable groups that need our help. And our help, I mean the help of a home furnishing company, because I think it's very important to realize that any company, whether it's a bank or it can be a FMCG company, they should always try to look for what's material for their business so they can integrate us in a relevant way. And for us, it's home furnishing, because we are obviously providing household appliances and furniture. And then it all comes to housing as well, but to equipping the homes. But from the S point of view, what's material for us and for our customers, but also for our employees, it's that a home should be also safe, not only nicely furnished with IKEA furniture, but it should be a safe place. And also, currently, we've identified a very vulnerable group, which is refugees. Because obviously our country has welcomed more than 500,000 people from Ukraine. And with this specific vulnerable group, we need to look for the access to homes. So we need to solve the first step. And then how we are tackling the issues as such is that firstly, you always need to understand what's your own homework and what internal policies you can do for your own company, for your own employees. Then you can start digging around what's the material immediate help that I can provide. Is this finances, or is it just some furniture? And then we always try to go to the midterm approach and midterm strategy. And I couldn't agree more with you, Marek, that we always go to government as well, and there are like hundreds of different companies who ask them for something. But I must say that the topic of S is a popular topic, even for the discussion with municipalities and governments, because then we can have a really nice dialogue, okay, what the private sector can do to contribute also to your goals. So we are always trying to find a long-term and mid-term solution, which I can give you a concrete example in terms of the refugee crisis, for example. So we first provided a lot of material help, we equipped some of the refugee centers and shelters and long-term housing, but now we are looking into the integration topic. So how we can provide language courses for refugees, how we can provide upskilling courses, how we can scale up capacities in daycare centers through our furnishing, and how we can also raise a debate. So it all comes to the S and how we implement it in our industry.
Thank you. And which kind of indicator, just to bring back to some of the conversation, do you have specific indicator and data that you look at?
Yes, but it is hard to collect data because it always comes, even in business and even in finance sector, what's like the return on investment, right? Or what's the business case? And you can't tell with social because it's like, it's so hard to measure. So we follow GRI standard reporting, so that's something that we can refer to also in measuring our impact. But then we developed our internal tool. It's called Social Impact, and it has like, it's a pyramid of 3 layers how we connect to people. The bottom of the pyramid, it's like some material support. So, okay, maybe we provided 200 people with some beds and mattresses. But then we go a bit up and we go to the improved situation, meaning that we've equipped the whole crisis apartment. So we really improved a living situation for a family that's, for example, fleeing a violent relationship. And then we go to the tip of the pyramid and it's transformation of someone's life. And it could be an example of our program Skills for Employment. This is upskilling program for refugees coming to our country. We provide language courses, upskilling courses, and it's really something that can transform someone's life. So we are trying to look at these figures and always have the dialogue with the NGOs, understanding how many people we can impact. But it is hard to follow, and we are also still at the beginning. But I would say that start collecting the data as soon as possible. It's what can be very beneficial in the long run.
And when you're doing your sustainability program and transformation, are you looking also at the S and the people that are part of the transformation? Like, so embedding social indicator while you're looking at more sustainable product, more sustainable?
Yes, as well. Then it comes to the supply chain. But obviously we can, for example, I don't know, if we want to stop selling one product and replace it with another, right? So it's always important to look into, okay, so are these people going to lose their jobs? Can we upskill them somehow? How we can enable that the transformation is just and for everyone.
Thank you so much. And actually, I'm going back to Marek because there's a couple of questions for you. So we'll just make it as interactive with the audience. Since have you talked to your members about launching an EU renovation loan together with central bank and recovery funds? And then the second is the return on capital for the bank when it comes to financing affordable housing lower than other projects? And if yes, who financed the gap?
It's always, with the bankers, you always start with the second question, and this is the finance.
Perfect.
Obviously, if you, there are 3 points why we can realize this project. The first one is if you buy in scale, so you save money. The second is efficiency of the building because you own hundreds or over thousands of apartments. And the third one is we have a definitely much lower margin on the rent. What is our targeted ROE? It's definitely not what we make on banking. This is our ESG strategy. It's lower, it's defined by our shareholder, and it's a long-term business. You know, maybe the biggest challenge is that you have the controlling and finance people in the bank looking on the next quarter results, next year results. But if you do affordable housing, then you have to look on the return indicators. Yeah? And then you come back to the shareholder understanding if you don't help to solve the biggest social issues of the country and the country falls apart and you leave 35% people behind, that's what Kestutis said. And we see it on the accounts, you know. You don't have to persuade that it's 35% because we see that 35% of people have zero on their account every month. We are the bank, right? They cannot cheat us. We are better than statistical office. Then you understand if you don't start helping, then obviously these people will start voting for the extreme left or extreme right. And I think this situation is far worse than what we are imagining. So obviously, if you talk to the finance people, it's not what they imagine the next quarter to hit. But if you look on the long-term value of the shareholder, I think this is the only way how to keep the environment in a way that the bank is prospering and the shareholder interests are growing in time. And that's why I'm coming back to the point, you need an enlightened investor that is with here for, that has the target in decades. And I think Erste is in the region for 200 years already. And you cannot really do it with some private equity fund looking to sell the bank in 3 years. So it's lower than our standard business. And the first question, please.
The question was about creating a renovation loan together with the central bank and recovery fund.
This is another discussion, because when we talk to the government and we say, if you want to build 100,000 apartments and that should be the target to help to solve the issue, you need a policy, right? Maybe you want to comment on that. And you know, there are 3 parties involved, and the government it's a very complex system. So, but I think in the autumn I'm quite optimistic there will be some first good news. And we talk with them. Okay, this is the new housing. If you don't get the supply, obviously we don't change too much. We need to build new houses. But in the meanwhile, you have people in your own in the existing houses that are old, and even if you give them the subsidies from EU to lower the energy costs, yeah, you still need, let's say, around 15,000 euro of your own equity, and 85% just don't have that. So now we are talking with the government that they will provide money from the modernization fund, which is under the Enviro Resort ministry. They have around 14 billion Czech euros, so 300 billion Czech crowns, to lower the energy cost. And maybe, and that was announced on Thursday, we can give this money to the banks and to the Sparkassen, which is savings banks, as a deposit. So with a limited profit, we can distribute it to people to repair the existing homes and to lower the energy levels. And I think this will be a fantastic thing to do.
Yes, Marek, I believe you really need many public policies, but there is one problem with that.
Yeah.
Because there are so many things which are deeply embedded in the economic system itself, that there are no policies which can change it. And I'm talking about the profit orientation. And when there is profit orientation, then the pie is distributed in a quite distorted way. And if I may comment on Barbara's example, Barbara, your company will never advertise buy less. You will create a company which is optimized both financially and both S-wide, yeah, as criteria, optimum way, in your own bubble. And then you have so many other companies destined to grow, to build more factories, more stores, and so on, to grow, because that's the inherent quality of the capitalist system. So with this, you have optimized structures, which together, they are optimal in their own capacity, but together, they damage the earth. And as people in trade unions say, there are no jobs on a dead planet. There is this understanding already. And the problem is that we are split. We think that planet is something else than us humans. So it is very deep in so many different topics, mostly now framed under the notion of degrowth that only the brave dare to talk about.
No, in fact, Katsoutsis, I wanted to ask you, this morning there was an interesting comment about not wanting to regulate and create over-regulate, and so not to create a social taxonomy, which seems to me, and I understand there were some good points made, that we need to leave for innovation and not over-regulate, but at the same time they feel there's a missing part, there's a missing pillar without a social clear taxonomy. What are your thoughts on that? And what more can the European Commission and the committee do in regards to this?
I would say I regret so much that now the the public debate is split into two parts. The platform created by the Commission is now separate from the other group of people who work from the NGO side, who work on these things, and we know the issue with that. We know that was a split caused by the Gas and Nuclear Delegated Act. So I think that the Commission is doing right now what is politically possible, because we are political animals. Yeah, we know that there is an election next year. The Commission is not keen to go into too many battles. There are different problems already related to that election, and they are doing what is politically possible. But at the same time, we all know that we should not care too much about politics, because in the end, the result will not be about what is the EPP versus socialists. Is it victorious or not? No, we all lose because there is no real reform done in the, let's say, social economic complex of the European Union. So I really regret that there is no move to bring back these people. That's one thing. And I truly cannot say how disappointed I am that in the new platform, there is no more group on social taxonomy, as if the case is closed. Huh? It's incredible that after the great report published in February 2022, and also I want to advertise a little bit here. This is another great paper produced by this finance center, by the organizers of this conference, and that's a great read. If you ever wondered what you should start from, I think you should start from this paper, Busting 5 Myths. So there is enough theoretical material to build strong policy around it, but because of these political cycles and because of the incapability of the committee of the Commission, we are now stuck in nowhere, unfortunately. Do you think we cannot create proper metrics how to measure social progress? I think there are already good examples. So there are so many initiatives, there are so many NGOs working on that, and there are so many also business initiatives. So all these things that we don't have data, we don't have enough whatever, all these things are just excuses, I think, for as long as the music plays, let's do business as usual. And we sometimes only have several brave people who go beyond that business as usual point and engage in real impact investment.
Thank you. And I fundamentally agree that there is a need on the social, and I'm quite disappointed on the social taxonomy, but I do think there are some practical tools that we can refer people to where you can get started on. The paper is a good one. We worked with ICFC on it and gives a really practical place where you can go to look at data from NGO to rep risk to Refinitiv, GRI, SASB, what are the right indicators that you can integrate? Which brings me to the core of what the social issues are, and we shouldn't leave the conversation without discussing this, is supply chain. And Barbara, we were talking about the work you're doing with your suppliers. That is very important that, just tell us a bit more how you're doing, and then I'll ask a bit. In the meantime, please ask some questions so we can continue the conversation. Thank you.
Thank you for the question. I would actually just very briefly like to react to Kestutis' comment to correct a bit the idea of big companies, because we do regularly encourage our customers to consume less and not to buy new furniture, because the idea of degrowth is essential for our future and for many companies to understand whether we become relevant and whether we really want to be committed to our claims that we want to reach some of the goals. We need to take this into account. So it's a bit untapping the potential of reusing services and so on. So just maybe we can discuss afterwards. But we are more into the E right now with the resources of the planet. But obviously then it would also, the degrowth would also impact our suppliers, right? Because our suppliers are very much often dependent on us being an exclusive partner, so it's all still hard to understand what will be the best way. Nevertheless, the supplier chain, it's an important part of our business, and since early 2000, we have our own code of conduct called IWAY that we make mandatory for all suppliers that want to work with IKEA. The code of conduct is undergoing constant development, so just last year we relaunched like 6th version that is in line with the SDG goals. And we require our suppliers to fulfill some must requirements that are requirements that has to be by no means always confirmed by the beginning of the cooperation. But then we work with the suppliers, and I think it's quite important part of the development that they have 1 year to fulfill the basic requirements that are also mandatory, but then we have the whole department of sustainability developers who are working with the suppliers in the long run and trying to make them advanced and excellent and really becoming amazing suppliers that are zero waste, that are taking care of the biodiversity, and also a lot about the social issues. So that's how we work with the suppliers, and what's also crucial is to share the best practice, because obviously we give them money in exchange for their products, but we are not their mother company, for example. So we can't really require you have to take care of victims of domestic abuse because we do it. But then it's about bringing the topic and making it material to them. So creating the business case for them. Okay, maybe we care about victims of domestic abuse, so maybe you can do the same because it will improve your productivity of the women who can be victims of domestic abuse, and so on. And we also share the best practices and all the toolkits that we've developed on our own. So it's about really being transparent, being there, and trying to improve what they are doing.
Yes, and we were discussing before how, there's a great report that's been shared, published by Shift, which I think is a bit the center of excellence on the S, and if you want, where it's really saying how to embed the UN Guiding Principle in your due diligence processes. And we're discussing of the importance of shared responsibility, right? Because if in the end, the company, the reporting, it becomes a policing state where big company just asks for data and police their supplier. We're not going to shift the shift we need in order to really look at inequality. And you were sharing some of the challenges and the opportunity and best practices that you're doing it with your suppliers in that.
Yeah, no, thank you for mentioning it, because we totally agree, and we believe that the key success factor to even develop our suppliers in really setting a transparent and trustworthy relationship and having a constant dialogue. Because what we know in manufacturing, and it's no different for furnishing business as well, sometimes obviously the partners pushing for deadlines and quantities, and then the suppliers, they contact some sub-suppliers who are not maybe willing to fulfill the requirements, or they don't even know them properly, and then what can happen is the violation of human rights, for example, which also obviously happens also across our value chain. But how we are trying to avoid that is to having the conversation with our suppliers and really building the trust that, okay, if you are not able to meet the deadlines, just share it with us, and it's about the shared responsibility you said. Then we know about it and we can tackle it together. But the solution is not that, for example, once the supplier has some issue, then we cut the cooperation, because we wouldn't solve anything. He would go to a different company that doesn't have any requirements. So it's better to work with these suppliers and actually teach them and educate them what you can do, how you can overcome the challenges, and how you can improve for a better future.
Yes, which is a principle also in the financial sector. So there's a big debate on engagement and disengagement, responsible disengagement. So I agree that fundamentally it's working with supplier, ensuring also the costs are not bared by the suppliers in the long run, because that's the big risk. Mara, can I come back to you? Yeah. And what do you think are some of the lessons learned that you've learned in terms of integrating the S in your story, and what more the banking sector can do to really embed the S?
I'm really thinking still about Kestutis' question about when is the right time to systematically change something. And there are so many problems every day in the government that I think it's only time in a big crisis. That is my conclusion, and we are in a big crisis, at least in the affordability of housing in Czech Republic. You need 15 times yearly multiple of household income to buy an average 65 square meter apartment. This is the worst. And I think when the government saw 100,000 people protesting on the main square, they understood, I mean, this is not good. We have to do something. And this is the time when you get aligned around some common purpose. But then everyone starts asking, so what should we do? What should we do?
Yeah, but you
you
never question the basic assumption that you have, that every family has to buy a house. Because that's good for IKEA's business, that's good for mortgage providers.
What we came to the government with was that we believe that the municipalities should start building their own housing stock, and this is the problem. But how do you learn how to be a partner with the government? I think you learn by showing by example, and that's what we are doing. Like we have contacted 140 municipalities. We went to talk to 57 of the mayors, really deep dive, and we asked them, why are you not building your own apartments? And they told us these are the three main reasons.
Housing cooperatives. Huh?
Exactly. And then we came back to the government and say, this is what we believe you should do, because we talked to the municipalities.
But then if you let people organize themselves without your participation, are you not out of business? So, I mean,
no, banking has been here for 500 years, no worries.
Yeah, in fact, actually, Marek, one of the questions from the public is, do you think more banks should focus on these issues? And what about the developers?
I think you come to the point that first you say, you should reform something, like let's make a reform of affordability of housing, and we try to add their value by doing the things that the politicians don't like, and that is going into the field, find out what is really there, like what is the real problem and what are internationally the solutions, and then you come back to their nice offices and tell them this is what is happening out there. And then the second you say, okay, how we can make it happen, because you all fight against each other and don't want to make a common purpose, so let's go for a beer, that's the Czech way. And then they ask the third question is, and who will pay for that? And they say, okay, let's talk. We are the finance business. We can find where are the long-term money, and actually they are in pension funds, they are in insurance companies, they are in the EIB. So if you make a cooperative, EIB will finance it. But will you make a cooperative, or will you keep fighting against each other? And I think this is something that is here, not to start fighting against each other, but how to find a common purpose, the finance sector, the government, the municipalities, and to align around the common purpose. I think that's what we are trying to do right now.
Yeah, and Marek, can I ask you, when you're doing, which I think you bring up very good points, and it's when you're doing it, when you're looking at, are you integrating social issue within that? So within the suppliers you're going to pick, how the workers are going to be paid and all of that, or is just mission focus on affordable housing?
So far that's my responsibility, but there are some colleagues that has much broader one, and maybe they will answer the question better.
Okay, perfect.
I'm more focused on the affordability issue.
And Ketsis, I do agree that government should do better, and the Europeans should do better. So what is your advice? I see what you're saying, that is a cycle, there's no political momentum, but on the S, on the taxonomy, on the due diligence, what can you or the committee do more to achieve, or maybe there's some topic we should focus on to make it less burdensome?
Well, I think that we are already on the good path, so to say, but we are very slow. And all the initiatives you mentioned, and also those that are probably still somewhere on the drawing board, this will help us to transition. But at the same time, the weight of business as usual is so high, so large, that it will drag us down. And I know I was a bit provocative today with both colleagues, but it's allow me to finish, like to not to damage our relationship, okay? In this way, that indeed, like there is this this saying about plan is nothing, but planning is everything. Huh? So even if you start to think about those three big target groups, like workers and users / consumers and communities, society. So if you have people who are serious about that in your big organizations, then it means we start implementation, at least from some small beginnings, but it will grow. Yeah? So even if you probably will not achieve a lot, with your limited efforts, the planning, the being in it, will have its effect. But I'm really worried that what is good on a small scale, when there is no, let's say, political will for a real reform, drop out that GDP metrics. Yeah, forget it. Just simply, yeah, like go on the degrowth path. Do the real reforms.
Yeah.
Then we can move. Yeah, some reality in sustaining our real, comparatively prosperous future. Otherwise, Europe will be simply washed away by mass migration, which will be based on climate issues. Yeah, and that's not so far away. It's already happening.
Yes, and I fully agree with it, and I'm a big supporter of the paradigm, the shift that needs to happen. But bottom line, practitioner needs something practical to start with. And we have a tendency of talking about it. That's why some people that's why a lot of financial markets and company get scared about the S, because as soon as you talk about the S, you need to talk about microsystems. But there are some practices as responsible engagement with suppliers, paying a fair living wage, because you were mentioning about living wage. So I don't know if you want, because those are practices, they're small, but they can be scaled, right? In terms of paying living wages. So. Were you talking about that, or am I?
Yeah,
okay.
about the IWA.
Okay.
It's about our requirements that the must requirement for our suppliers is always to provide the minimum legal wage, but then for the basic, which is like within the course of 12 months, the supplier needs to cover the other expenses to cover the living wage. So it's like how you balance between, if that's what you were asking for.
Yeah. So. Yes, so it's trying to provide. Yeah. Don't know if did you request the suppliers to pay the living wage, or yeah, okay.
Yes.
Okay.
Through the basic evaluation of the IWA. So we have like the different levels. So we always start with the minimum legal wage, but then we build up.
Perfect. And sorry, I have this question that I don't know if it's completely relevant to you, so they say it's for you, but it's like, what tools does IKEA use to map Scope 3 emissions?
Mm-hmm. It's not connected to S.
Exactly, but you can maybe get the S into the conversation.
We have internal developed tools, and we do the aggregated data collection. So based on the Scope 3 emissions, we look always at the value chain. So we look obviously into the supply chain, but then also we look into the customers, how, for example, they are wasting our products, and about all the commuting patterns and so on. So far, we always benchmark the data based on the customers, about the sold product, about the products produced, and then we aggregate it based on the global warming potential per different materials, for example, or per different waste treatments in the country. I don't know if I should go really into depth because it's a bit off topic, but I'm happy to talk about it after the session.
Thank you, Barbara. And we got a few very interesting questions about your degrowth comment. So what is the EU doing about preparing for degrowth? And isn't the European Green Deal going totally against degrowth philosophy?
Well, we have a degrowth conference today in the European Parliament.
I saw.
That's a great beginning. Yeah? And last week I was in Brussels for Brussels Economic Forum, and there was a storming group of activists, which in the middle of debate, with Vice President of the Commission, Valdis Dombrovskis, present, they got their message. Stop talking about growth, degrowth, and so on. So it was a mess, of course, for a few minutes. But in the end, it was so difficult to go back to the usual debate. Yeah? Everybody was visibly shaken, except Valdis Dombrovskis, who is always very focused. And I think time will come, yeah? If we have more talk about that, and if we have supportive group of members of the European Parliament, then probably it will come to some conclusion, at least not only to focus on GDP as the main metrics, but to employ other metrics as well. And then that's how we come back to the S, yeah? Because that metrics is essentially about people. It's not about amount of goods we produce, right? Measured in financial means.
Maybe from my side, I have a different point of view, but this is democracy, so we can talk about it.
Yeah, please, make it spicy.
When we analyze in the history how people reach higher prosperity, yeah, that was always that you have clear rules, you have freedom, and you have free markets. So people with great ideas were trying to grow productivity. They went for the allocation of the capital, and they were building prosperity. That's why we live such a nice life in Europe.
Marek, that was 1980s.
Then you come to the point that in a long term, because of the taxation, some people got super rich and some people got left behind. And this is the S we are now talking about, how not to leave so many people behind. And I think this is what we are trying to do, but it's a discussion that the banking sector has to go hand in hand with the government to see how we can create programs that basically we protect capitalism in a way that all the people feel benefits. And I understand your frustration, because we see that 1/3 of people believe that capitalism is not bringing them better life, and they're looking for some extreme solutions. And I think this is something that is the S, that we should find the solution together with the government, how the people will have prosperity also in the lower third of the nation. And the banks cannot say we are not a part of the discussion. We are definitely part of the financial system. We are the beating heart of capitalism, and we take responsibility for the growth. And we should discuss with the government about how the distribution should lift all the communities out of the property. But once we are talking that we should change the system, that's a tough discussion, at least for us bankers.
Your arguments would hold firm if there would be 4 Earths or 5 Earths. We are on a finite planet, so that talk was good for 1980s.
Okay,
but not now.
We had our history of trying experiments, in some extreme way.
I know, I come from the same background.
In this part of the region, so we know none of the extremes are good, and I'm looking for a really balanced way.
Can I just bring another point so that we are not only European focused? There is another bridge, there's another gap in the thing, is that unintended consequences, and there's a question to the developed markets, no? So there are economies that are going to be affected by the regulation imposed by the EU. And one of the people in the audience is asking, and this I ask to all of you, but is it possible to build a bridge between all these requirements from the EU and supporting other regions? And I have the expertise, we do a lot of events around the globe, and there is a lot of turmoil in SMEs and markets like such India, Colombia, Thailand, Malaysia, where these requirements will be very difficult to implement, and the burden will go on the suppliers in those markets and in those economies. So I don't know if there's any answer that I don't know if there's an answer to this from your perspective.
No, I don't honestly. I've been struggling with that a lot in my previous job, because I was working in the fashion industry, and you have many countries in the developing world that are dependent solely on manufacturing fashion products. And then you are facing the pressure from the consumers, like, I want local designers and I want everything to be made in the Czech Republic and in Europe. But then obviously you have the price, which is also set in a bad manner and causing the issues in the developing world. But then you have to acknowledge that this is usually the only stream of income for these people. So is it really the right solution to localize everything, or is it rather better to outsource the production in the developing countries, but rather educate the developing countries and setting the standards, for the example of the living wage and for better practices that are more environmentally friendly? So obviously we deal with that also within IKEA supply chain. We are coming with some requirements for the certification of our forests. It's something that I discussed in one of the breaks. And we are losing suppliers in the Czech Republic because we don't have sufficient amount of forests being certified with the certification that we require. So it's a very complex issue. I don't have the right answer to it.
No, but I think that's what I wanted people to be aware, that this is a very important component, that we are not imposing some colonial approach to human rights again, and making sure that the Global South is involved and has a voice in the legislation we are developing and the standards we are developing across the board to ensure there's not unintended consequences on their economy, etc. And I think you mentioned there's a duty to educate. I think there's a duty also, again, I go back to share responsibility and share of prices and paying correctly for the goods that we're buying. But I know there's only 3 minutes left. I don't know if you wanted to add anything to these questions that Barbara responded quite well to. But
I think you will like it. This is nothing about the ESG, that's the global economy.
Yeah, well,
but I'll give you 30 seconds and then I wrap it.
I can have the finance view. I'm sure my colleague will have the political view. From the finance point of view, you know, we are in US, we are running huge deficits. Nearly 1/3 of the budget is not covered by income. And, you know, they're hitting this financing wall, and if you look on Europe, so some financial markets will have to buy the bonds the government issue, and the question is, what will be the interest rate? And we have seen it in UK, that this is one of the major global challenges of if financial markets will believe they will one day get their money back. And in London, we have seen what can happen in the Western world. And the second is this polarization of the world, and you see this one block of China and Russia challenging Europe and UK, and I think this will leave us, I think much more it will push us to let's not fight within the Europe. I mean, we really not need to start cooperating, and I feel I have a very good relation. I like the discussion, but I think I still feel that we should keep on fighting somehow. And my belief is, if we don't start working together, we cannot overcome this huge challenge that is ahead of us. And I think China, Brazil, Russia, and India are going to challenge us in a way that we have to start looking how to cooperate to solve the issues.
It's not for the sake of fighting or not fighting, but just harsh reality, what we have. If we do not stop exploiting these people, simply, then think of the future when 100 million of Eastern Asia climate refugees come to European. So it's time to act now to make common, I don't know, in the context of the loss and damage, in the context of all the other climate financing, to make common effort to avoid the most disastrous scenarios when 100 million people or 200 million people are simply displaced because of our CO2 emissions, right? So at this point, our talk about what's globally going to happen is in our own interest. And then probably you can have your financial markets also prospering.
So one last, and then we have to go. So we promised some practical. So how do we end this on the S? If the audience want to get started, who would you refer them to? Which tools or any big tip that you like? Your biggest lesson learned from integrating the S. Barbara, do you want to start?
Yes, and I would suggest stakeholder engagement, at least from the business perspective. It's always, because even within the sustainability team or within the management team, you'll never find an expert who would be really like good at the social issues, right? So it's always good to rely on the NGOs, on the municipalities, engage the stakeholders, understand what's material for your area of expertise, where you can help, and then just do it. I would also suggest focus on the internal practices, because it's crucial. It's very hard to do something externally, but not do the first job internally and provide the right policies. And then follow up, try to drive a systematic change, because it's also possible from the private sector, and collect data, because it's important.
Sorry. Right, go ahead. I'm so sorry.
I think our lesson was first find what's really, where you have the experts for the look on what are the biggest social issues of the country and where your experts in the bank are. The second, start showcasing, because without the real example, you don't have the experience, you don't even have the rights to talk about what should be the solution. And third, start scaling with the government in a partner discussion, because all the infrastructure project needs financing, and that's the role of the finance sector. So align with EIB and the banking sector, the pension funds, and try to in a partner way to find a solution for the social issue.
Thank you.
And
practical.
Practical.
Yes.
If you can, start today by transforming your financial gains-oriented financial institution into impact investment institution. Then you will probably have something to tell your children.
Yes, and it's, I think on that is a good ending note. I would say it's also like more than also impact investing, because impact investing I think creates confusion. I just want to say, find what is material, what you can really make change on, and for the people, and don't create an initiative that is a sidekick of the work you're doing. You're doing work on your emission and scope 1, scope 2, scope 3 for climate. Embed the social in what you're doing across all the work you're doing. And I think that's the best. And even if it's a minimal denominator, or paying all the workers in a certain way, or ensuring there's good practice on their work environment, that would really make an impact and avoid polarization and the growth of inequality. That's my, I don't know, I came in as a moderator, but that's fine. And thank you so much, thanks. Everyone.
Thank you.
Thank you very much for the discussion. Okay, I can hear myself now. Thank you, Julia, and all the speakers for the passionate and very practical discussion as well, with some practical solutions. So that's good to hear. And I think this was a beautiful. It just completed the picture, the full picture of today's discussions. I think really nicely, because we are touching on, ESG and carbon a lot in the morning, and reporting standards and different topics. And I think S definitely was one of the main puzzles, or one of the main pillars of this discussion. So I think it's a really nice closure for the main panels today. But don't go home yet, because two things. First one, there's one more short session on sustainability in geopolitics, which I think is actually quite interesting. And the second thing, there's drinks after, which it's a nice combination of the two things. So
shall we
yes,
go?
to get to the drinks, you need to also listen to the session, I've been told, which is a very fair rule. So thank you to the speakers, and we'll take a half an hour break now, and we'll see each other in 30 minutes. Thank you.
Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby.
Welcome back, everybody. And we have the very final short session of the day, which I actually think is the most accessible, most interesting session, because this will put this whole debate we've had today into the bigger context. Because guess what? Everything's about politics and everything's about geopolitics. And today we have Tom Nuttall from The Economist, who's going to moderate a very short conversation with Sean Kidney, the CEO of Climate Bonds Initiative, and Piotr Arak, the director of Polish Economic Institute. So please, welcome our speakers to the stage, and we will want to hear all you've got to say about the future of sustainability and geopolitics. Thank you.
Where would you like me, Tom?
Yeah. I don't know. Why don't you go over there? Great. Thank you, Linda. Thanks, everyone. And thanks for inviting me to moderate this discussion on a fascinating topic for which we have very, very little time, and we are going to have to stop on time because Mr. Arak has a flight to catch. It strikes me...
Everybody here has a drink to catch.
Right, there you go. It strikes me that a year ago, things were looking up for the transatlantic relationship. NATO, of course, had been reinvigorated amid the war in Ukraine. You'd had cooperation on getting a minimum corporate tax rate. And then came the Inflation Reduction Act, which seemed to take the Europeans rather by surprise. Apparently, there was very little lobbying effort on Capitol Hill for American lawmakers to think about European interests when they were putting this law together. And then you had sort of an interesting development. So first, the Europeans were spooked. Then they seemed to be angry. And then, depending on which way you look at it, They either got themselves together and came up with their own answer to some of these laws, their own subsidies, their relaxation of state aid rules, certain presidents of certain countries talking about made in Europe provisions and so on. Or if you look at it the other way around, they were undermining everything that the European Union had always stood for. And that sort of seems to be where we are right now. So in the context of sustainability and the discussions that you've had today, I thought I might start by asking our panelists, if we are getting into a world of subsidy races, with a risk of corporations playing the Europeans and the Americans off against one another to build their factories, secure their supply chains and so on, is this really the best way to allocate capital? Or are we at risk of simply misallocating it and going down a much less efficient route towards decarbonization than we might otherwise do? And Piotr, why don't you start?
Well, the obvious answer that, for example, the International Monetary Fund gives is that these kinds of measures decrease actually economic output. So if you're going to have more subsidies, we didn't have them for many years, whether it is the European Union or the United States, is going to decrease the possible of flows of trade across the Atlantic, and it of course is going to decrease the economic output of the two biggest economies, meaning the European Union and the United States. So yeah, this is an issue. Then I would say why the US is doing something like that. So the reason for that, this is actually the first piece of legislation pushed by the House and a sitting US president in terms of climate policy ever. We might remember the Obama times as somehow a moment of reforms, a lot of things happening in the US, but it was all based on executive order. So it was basically changed and destroyed in legal terms when a Republican president came to power. He came to power. So this is actually the first time that the US is doing something like that. So basically, if you're rooting for change in terms of climate policy, decreasing emissions, having a more greener and better future, you should be actually rooting for the US because they're doing something good.
Exactly.
This is the first time that they are actually doing anything in terms of such policies. And this is also the first time that the US has an industrial policy similar to the European one in most probably 30, 50 years. So before Ronald Reagan became a president. So it's also tells you a lot where we are in terms of industrial policy, when the pendulum of Karl Polanyi came, so in the terms of interventionism versus less interventionism or liberalism in terms of economic policy. So we're more in the interventionist kind of phase of the world. And this is what the US is doing. And I wouldn't say that they should, hear the European voice of business, because this is the voice of business in the US and also European business in the US that actually wanted to have more possibilities to prosper. And the maybe side note, which is quite frankly funny, it's the Republican states which are going to benefit the most of the policies implemented by a Democratic White House in terms of increasing FDIs, increasing investment rates, increasing jobs created, because in the first 8 months of the Inflation Reduction Act, approximately 40 new projects been started. They cost, not up till this moment, but they're going to cost about $44 billion US, and they are set to create 32,000 jobs. We don't know how many of these investments would actually be prepared by the companies. Those investments would happen without IRA. This is something you cannot do a counterfactual. Probably some of these investments would happen either way in the US. So I don't see that this is a problem. The issue is more or less, in this case, with the European Union, and we're used to be the leader in green policy, in being green. We have bikes, the US has trucks, we are green, we have vegetarian food or whatever. And we do see ourselves as being a leader in a policy element. And even in industrial policy, we weren't actually a leader, because up to this moment, without IRA, the United States actually had more green green inventions, green projects that have been certified in the patent offices than the European Union per capita. So they actually been a leader without any subsidies up to this moment in terms of developing new technologies in the field that we feel we're a leader in, which is something quite interesting. And the other thing that we get wrong, the IRA is not against European interests or European business, it's against China. If you go to a room to talk about trade in the United States, the half of the room you're going to see military people. This is the moment of debate in the United States where you're going to have a general, economist at the same panel talking about trade policy of the United States, and then it's all going to be also about climate. And you're going to have somebody more green friendly than a green wearing military man. And this is the main difference between us and the United States. We don't treat trade as an element of security, they do. And they think that they have, there is a threat to the economic complex of the United States caused by China, which then is also connected with the dependencies in terms of PVs and everything that we also see, but they are actually doing quite a lot to decrease this dependency. For example, building stuff that could be done cheaper, easier on the other side of the Atlantic, but then it's going to be built in the US, for security reasons, not for reasons of cost, not for the reasons of decreasing the emissions, for example, actually of the US economy. So this is the one element that we get wrong, and we cannot easily adapt. And
I'm just going to ask you very briefly, there's lots to chew on there, but just a brief follow-up question. You say that the Europeans are getting it wrong, this is about China and not Europe. I mean, fine, although lots of Europeans will point to made in America provisions, not in China. But if we wanted to think about the most efficient way to decarbonize, if we think about the manufacture of PV cells, for example, if we look at the subsidies and the tax breaks that are being poured into this space by the Americans, from a European perspective, can we not argue, well, rather than seeking to emulate this and ensure that companies don't decamp and go to America, why don't we simply take advantage of those subsidies and buy in all of that stuff from America, take advantage of the subsidies that they're pouring into their space? Wouldn't it be better to do that rather than seeking to emulate their own subsidies?
Well, yeah, the threat is that lots of the industrial people who are not in this room from Germany and France are, basically always rent-seeking in their own government. So you have two biggest economies in the EU, and also two countries which have the highest levels of state aid after 2020 provided to their businesses, and before 2020, so before the pandemic, actually also the highest level of subsidies which were illegal in terms of the regulations, of competitive regulations of the European Union, and also legal state aid, so assistance for research and development and stuff like that. So state assistance for companies operating in Europe, it's nothing new. It's an old story. We do that. So businesses get a lot of assistance actually in the European Union. It's that in the US they didn't. That's the main difference. And they, of course, the businesses want to have and they're going to use this talking point that this is easier. The US is doing something which is a race to the bottom, which is basically easier in terms of what you want to do. You're going to get money if you're going to pursue something. As if the European Union is not a federal state. It doesn't have an EU-wide tax system. You cannot impose some changes which are typical for a federal government. We cannot do that. We don't even call the green taxes taxes. They're not taxes. They're kinds of some, mechanisms like the carbon border adjustment mechanisms, which is a tariff. It's a tax, because then this is the nation state's authority. So this is how we have to maneuver, and it's going to be more complex. So the companies and corporations in the EU can easily use the example of the US because it has a different system as doing something simpler and easier because they don't have all this, this history and all these regulations of cooperation between countries, not as a federal system.
Sean, what are your thoughts on this new world of industrial policy that we're entering?
Eisenhower in the 1950s managed to get a national highway system built. And he built it under the guise of moving tanks across the US fast if the Russians invaded.
Yeah.
You can use security issues for all sorts of things, as we are currently doing in Europe, cheap change. He didn't really believe that the Russians are going to invade. But it worked in terms of selling it and so on. So, there's lots of things. I want to say we haven't got a shortage of capital. The efficient allocation of capital might be nice from an economic perspective, but the world does not always allocate capital efficiently. Rather the reverse. It often makes stupid decisions, like the UK government did 12 years ago, 15 years ago, when it decided to build offshore wind. When the Conservative Party, its own voters, didn't like onshore wind, changed the hills. They hadn't arranged for, like the Danes did, for revenue to go to small towns and local people. And so there was a push against it. So they paid 50% more to park it out of sight offshore. Now, we all benefited, despite it being an utterly stupid, irrational decision.
We did the same,
We did the same here. And it drove down the cost of offshore wind. And now Japan's building offshore wind at a cheaper price because the UK blew money. We do that all the time. Sometimes it's fantastic what we do. The reason why we have lower renewable energy prices globally now is because the German government in 2001 instituted a feed-in tariff. And then the Chinese picked it up in 2006 with the world's biggest commissioning of solar every year since then. Last year, it was an even larger commissioning of renewable energy than ever before. And they've driven down the price by providing production volume. And their manufacturers have then exported globally. And I was speaking to a German government official weeks ago, was moaning about how the Chinese had stolen the energy. And say, well, if you'd managed to engineer European-wide offtake agreements, you would be still in the game. But you blew it because you got caught up in Indonesian national policy within Europe. We need to start thinking like a large economy. Otherwise, we're toast. And that is a challenge for Europe because it is not quite there yet. It's a bit like the US states in 1788 haven't quite gelled into a country yet. But if we're going to actually see the change that we need to have, we're going to have to operate. Now we operate across Europe as a global economy, as a globally significant economy. Of course, on the energy system, we're kind of forced to deal with this now, right? Yeah. Thanks to the war and gas, we have to build those interconnectors. We've been sitting on wind energy approvals in countries around Europe for the last 15 years. I mean, Katarina will tell you how many in Poland are stacked up that haven't been put through the system. Now thanks to having to get off Russian gas, we're forced to tackle both interconnectors and local energy generation. This is part of growing up as an economy. But I want to stress there's no shortage of capital. We have capital pouring out of our ears on this planet. In fact, this capital doesn't have enough places to go to at the moment. Even these high interest rate environments, people are nervous. Creating investments to soak up capital is in fact a high priority for us macroeconomically. And getting it out of German bunds, by the way, it's a negative interest rate still in German bunds, and putting it into places a bit of return is really what we've got to try and do. Look, what's happening? We are entering global storms. These are not going to abate, they are going to increase in intensity. Climate change, in every period in history we've seen it, has been associated with three things. It's been associated with war, famine, and pandemic. The IPCC has been predicting pandemics being a regular feature of the 21st century since 1988. War, we had one, and we're going to get more. Famines, well, I heard a speech from an FAO official a couple of days ago saying that the world has never been as vulnerable to famine as it is right now. They've never seen it like this. I was shocked at a conference I was in Paris the other day, because all around the world there are water crises, there are heat crises going on. It's not just the Ukrainian export problem. There are other things going on. Water crises are everywhere. So we can expect to see more likelihood of famine in many different places. That'll be good for Polish farmers, of course, but not so good for the rest of the world. And war, well, we do have if I remember correctly, a petrostate kleptocrat just invaded a neighbor using fossil fuel revenue from Europe to do it. Oh, it's not entirely different to the wars that might be associated with the transition we have to go through, but most of the wars are going to be around the conflict as people try and move. You know, in a survey in Pakistan recently, 85% of young people surveyed said they wanted to leave the country because of the crisis that Pakistan's facing now. A lot of those are going to try and leave. They're starting to turn up on European shores, etc. Unless we resolve these issues, we're going to get much more difficult geopolitical, macro-political issues going forward, much more difficult. We have seen nothing in the Syrian crisis of a few years ago, which, by the way, was rooted in climate change. The collapse of agriculture in Syria in 2008, forcing 3 million people off the land into the cities, and then the collapse of agriculture in Russia in 2010, thanks to climate changes, which quadrupled the price of wheat in Syria and led to riots. So we've already seen climate change wars, folks. Think of these as becoming the new norm. How we operate in a world where these start becoming the norm is now a particularly serious issue. I'm going to say, in terms of national policy, the IRA is fantastic. It's forced us in Europe to try and get our act together. But the good news is, in Europe, we have a lot of subsidies already. The IRA is a blunt instrument. There is no doubt that there are all sorts of companies. You know, we had a session at Sarah Week in Houston a few weeks ago, where the Houston finance sector is now saying it's going to be the energy transition sector for the US because there is so much tax credit money coming through. Yeah. Fantastic, that's what I want. I want Exxon to decide to get involved in direct air capture and to bury it underground because it's going to make a lot of money out of it. I'm not expecting us to be able to make the change fast enough otherwise. In Europe, we actually have a lot of subsidies. We don't package them. There's two things we do badly in Europe at the moment. We don't sell what it is we're doing in a way that the industry can understand, including certainty, and we caught ourselves up in paperwork and complexity. Look at the taxonomy that I'm involved in. Oh, it's not exactly simple, is it? It should be simple. We have a brief at the EU Platform on Sustainable Finance this year to simplify the taxonomy for everyone, make it easier for everyone. This is essential. In every area of green especially, we've got to make things move faster, and that includes, by the way, planning permitting for wind energy in Poland or the energy vendor in Germany. All of these things are things we can do without too much difficulty. I'm going to say IRA is fantastic because of the way it's galvanized money, galvanized energy. After it came in, I was in a conference in Indonesia. I sat down to this guy. What are you doing? Oh, I'm building the world's largest green energy plant, green hydrogen plant in Kansas. I thought that was Sinopec in Inner Mongolia. No, out of the blue, they've managed to generate this huge plant which will make money before it ships a kilo of hydrogen because the tax credits. I don't care. I just wanted to build it because I know we can make the demand work. Anything that gets it going. And right now, things are so serious, so dire going forward. Looking at, if you ask any climate scientists and get them to tell you what they think is going to happen, it's a very grim story that we need these kind of blunt instruments all over the place. And we're getting them from the US. In China, in Europe, I want our instruments to look blunt soon, look simple, look easy. And in China, there's a wrestle going on, there's a fight going on between the center that has deployed some blunt instruments and the provinces that are saying, hang on, we understand fossil fuels. So we've got work to do. But just think, if we could get the three economies, the three big economies of the planet, treating Europe as an economy, the US and China vying with blunt instruments to see how could they transform their economies fast, we'd have a chance.
But let's just take the IRA, let's sort of take your premises, accept your premises, and then look at the way that the IRA functions. It's, you know, the lawmaking machine is a Bismarck sausage-making machine. You peer inside, and it's not very pretty. And everybody was able to see how that piece of signature legislation emerged, and the role that certain pivotal senators were able to play, and so on. Do we trust a system like that? And then the bureaucrats who are trying to identify those sectors that are going to be most helpful in advancing decarbonization to do their job properly. Are they able to predict the future course of technology? Are they able to think about those sectors which public money ought to be pouring into? Because we seem rather to have moved away. Very often in this discussion, we forget that the EU built some time ago the world's, what I think remains the world's largest carbon market. And you before were saying that in Obama's time, he had to resort to executive actions because he couldn't get anything through Congress. The signature example, presumably being the attempt to create a cap and trade market in the US. Those discussions appear to have disappeared, as far as I can see. Is that something we ought to worry about?
I mean, in a way you refer to the taxonomy. That's not what the taxonomy does. The taxonomy says broad guidelines, what you've got to do, which are absolutely technology agnostic. There's enormous room for innovation. But we need to have clarity about what we've got to do. I mean, for example, do you have any idea what a reasonable amount of energy efficiency improvement in your house should be to make sure it's future fit? I'll bet you've got no damned idea. Frankly, I don't either. Peter Sweetman does in the front row. We need those kinds of rules socialized across Europe, for example, as part of guidance, and then linked to incentives. So if I do get a retrofit in my house to get to a certain level, hey, I might get a 1% cheaper home loan. That would be good, Peter, wouldn't it? These are the sort of things that we can do with the kind of guidance we're bringing in around taxonomies. There's nothing in the taxonomy that says only triple glazed windows count. It's much more broader than that. So in fact, I think what we've been doing at a bureaucratic level on the guidance, at its principle, is good. We've just shrouded it in more complexity. We've got to strip away the complexity around it so we can get back to the heart of it. But the essence of it is right. It's not about picking a manufacturer in France, the old-fashioned French way of doing it, which I appreciate you're raising as a problem. And that's what the US is doing. Under the IRA, it's effectively saying certain kinds of areas of work, like something that drastically reduces carbon, direct air capture, is in. If you're going to do that, here are some rules, but if you can find a more efficient way, go for it. And that's technology agnostic to that extent.
Well, the importance of what IRA has is the flexibility of the regulator. So first off, it's when do you actually spend the money, and when do you have to do the reporting to the government. So it actually is about 10 years. So you know that companies are going to probably work with the American government in order to have a longer period of time of reporting the data of what they actually did, and then actually receiving breaks or money as state assistance. So this is one of the important elements. But you know, any macroeconomist is going to say you that you know, picking and choosing winners is basically the idea of any centrally planned economy, which doesn't work. So it didn't work. It doesn't work on paper. It always decreases the economic output that could be created. So the potential output. What works is the smart diversification. So we have in Europe the smart specializations kind of idea. But what actually works is if you have a more diverse base of production, energy source, anything else, it's better. It's thinking it that way. So I don't see this big threat actually in the taxonomy or in the energy mixes or policies implemented by the member states. Maybe the clarity about some of them. This is the problematic matter that we could see. But I don't see, and if European Union or the European Commission tries to choose basically a technology which is better, then they're going to find a lobby that actually thinks otherwise, and they're going to have to fight them on that matter. I think Brussels is, the lobbying structure is quite strong on that.
Let's turn back to China, which you mentioned in your remarks. On a sort of superficial level, the rhetoric that you hear coming from the EU and the US appears to be converging. The buzzword in town in Brussels is de-risking rather than decoupling. And the Eurocrats will tell you with joy that this is a word that you now hear emanating from the lips of Jake Sullivan as well. But the question is, do the Europeans and the Americans mean the same thing by de-risking?
Well, of course, no. If you're going to see a plane full of German business people flying in with Chancellor Scholz to Beijing, or the same stuff happening with a royal visit of Emmanuel Macron, of course, it's not the same. So of course, for Germany being the biggest export economy in the world, de-risking or decoupling from the Chinese economy is a non-option. It basically means destruction of a big chunk of the economy. It's not like with the commodities coming from Russia, which are somehow easier to substitute. There you have a market that actually needs to, who buys the products that you are producing. So without the Russian market, we can do without in terms of purchasing power or the cars that they've been buying or not buying actually in the last couple of years due to the shortage of microchips. So I would say that this is a whole different issue, and talking with experts from the United States, both from Homeland and from the other parts of the American government, you get a feeling that the basic scenario is what's going to happen if you're going to have a maritime blockade of mainland China because of some military threat to Taiwan. And yeah, we don't talk about competitiveness and policies in terms of trade the same way. We don't see it as a risk. We don't treat a war or an invasion of Taiwan as a viable option that China is going to pursue, and the repercussions of that to international trade. One of the most interesting parts of analysis conducted by security analysts in Germany and in Paris is the element of secondary sanctions. So we don't act in a situation like that because we don't have to. So the US blockades China. There is difficulties in terms of produce that we have on our market, but then we still operate as a business in China, investing, doing whatever, as some companies wanted or did pursue the same policy in Russia, so being still present in Russia. And what we see as a problem in that circumstance is the secondary sanctions. So what then if the US does with China the same as they did with Iran? So basically banning all businesses in operating in the United States of America if they do business in China. I don't want to know what this would mean to international trade, but given the circumstance that we're here in Prague, you have refugees from war-torn Ukraine. You have authoritarian power it has never seen before in Chinese leadership since Mao. You need to think about the possible consequences, not to be wishfully thinking that, okay, it's not going to happen because I'm not preparing for that, as you did with the Russian example. And energy policy of some member states of the European Union. We need to prepare. We need to think as a viable scenario in Europe as well, and whatever the repercussions for the US is going to be, and then for us as well. And the US, with its international trade, can force us to comply. Still, they have enough power to do that.
Yeah, and there will be many voices saying that after everything that they've done to help Europe during this war, they might expect a little bit of reciprocity when it comes to China and Taiwan. Sean, can I ask you a sort of tangentially related question, which is, in this sort of triptych that is supposed to govern Europe's policy towards China, a partner in some areas, a competitor in others, and then a systemic rival in other ways, the area in which we're most often told that we need China as a strategic partner is in climate. To the extent that the sort of geopolitical tussle between the Americans and the Chinese is warming up and the Europeans get caught in the crossfire, will it become increasingly difficult to to maintain that sort of relationship with the Chinese to work with them on climate? And if it does, how much does it matter?
Well, John Kerry's found it difficult over the last year when at one stage, he had a summit booked in Beijing with his counterpart, and he turned up at the airport and it was all cancelled. So clearly, it's challenging. But I still think that keeping green cooperation going between the three major economies, with a question mark about how we do it with India, given the India-China tensions as well, is a viable option. And I know in China, they're willing to talk about that, especially with Europe, because Europe is seen as not quite as hostile as the US. Then at the moment, because the geopolitical hostility between the US and China has clearly got extremes. I find it a bit frightening in China, the extent to which what I call forces of nationalism are allowed, but equally I find it terrifying in the US. Hey,
he's got to catch a flight.
I didn't mean to upset you like that, sorry.
You scared him off.
So it is challenging. You know, in the US at the moment, there is a terribly febrile atmosphere around China. You know, I heard a speech by Nikki Haley, presidential candidate, recently, as on the soft side of the Republicans, in Singapore of all places, where it didn't really go down very well, which can only call beating the drums of war. So as much as we might worry about China invading Taiwan, which I do worry about it, and I thought if Putin had been successful in Ukraine, that was likely to be a next step. Thank God the Ukrainians have fought back so savagely and bravely. But at the same time, the increased warlikeness of the European stance just increases the risk of a mistake, as we all know from past years. You know, we came within a hair's breadth of nuclear war in the Cuban Missile Crisis because both sides were just so jittery about it. So these are clearly substantial risks for us. In Europe, we don't want a war. We've been forced to a war. We need to ensure we can survive war going forward. There's a different security agenda going forward in Europe, but equally we have a bit of an understanding of how to try and broker peace between warring nation states. We've done a bit of that in the last 20 years, and we need to take that story global to try and dampen these hostilities. And I'm acutely aware that in a febrile atmosphere, complaints become magnified, especially by the Tucker Carlsons of the world and the Global Times in Beijing. And things get polarized, and we've seen how difficult polarization within the US can make any kind of sensible polity. And now we're seeing this geopolitically. So I think it's really worrying. You know, I think from a European perspective, there's actually a lot that we're including, by the way, on the news side. You know, in a global world where people are consuming a lot of European news, we've got a responsibility to make sure that there's information out there in those economies that is vaguely rational, rather than the crazy environment, the Fox on one side, the Global Times on the other. There's a bunch of things we can do in Europe to try and create an enabling environment for geopolitical coexistence.
Let me just, our time's about to run out, but if I can just ask you the question that Piotr kind of left dangling, which is, what is the plan B for Europe? Or maybe more specifically, is there a hedging strategy if things really do start to get very nasty between the US and the China? If we start talking about secondary sanctions and so on, what is the European plan B? We've already seen the Dutch agree to block exports of semiconductors, going along with the American strategy. If that's the world that we're entering, are we in Europe thinking hard enough about what our strategy is going to be?
We're very intertwined with the Chinese economy, particularly in Germany.
Yep.
Extraction and separation is not a viable proposition in my lifetime. So we are, in a way, thank goodness, dependent on peace. We've got a visceral need to ensure that peace is retained. The US is probably in that position too, except that it has much more in the way of lunatic elements. Think of it as Marine Le Pen in power, which makes things a bit scarier in terms of how they might jump. You know, if Donald Trump were to get elected, it all gets a bit scary there. Are we thinking creatively about what to do from a European perspective? No, we're not thinking creatively enough. We've been very inward-looking for a long time. Yeah. European foreign policy can only be called nascent. DG INPA is not exactly a behemoth on the planet. you know, and there's constantly a fight between the French, the Germans, and Brussels in terms of who's got. Look at what happened to Ursula von der Leyen in China recently. Yeah. We do need to get our act together, and I'd hoped that the Russian-Ukrainian invasion might force us there, but as you can see, it's going slowly, right? So we're going to need to get countries that have a particularly urgent view about the need to get our act together as Europe, such as Czechia, such as Poland, to push this envelope, push this story within Europe. We do luckily have a way of getting new forces to play to drive it. Over the next few years, it's critically important that we grow a European presence in a number of ways. One is that we have a closer integration between our regional foreign policy and our trade policy. The CBAM is a sort of step in that direction, which is why we've got a beautiful element, which is the Commission is saying to other countries, you collect the carbon tax, we don't care about collecting the carbon tax as long as it's collected. So they now have 3 countries they're negotiating with to set up carbon tax collection regimes, which will be money for those treasuries. Oh, it's beautiful. But instituting global carbon tax. These are things we can do from our experience of managing 27 countries, so on. So I do think we've got to have a better foreign policy. We do need to have a defence policy that's forced upon us now. We do need to have a trade policy. We're sort of getting there. And we need to have an engagement policy. We've had a stuttering approach to countering the Belt and Road and so on in the last few years. But the truth is we have a lot of companies that are actually often more trusted in many countries. Look at the decision in Ethiopia to award railway contracts to European contractors rather than Chinese contractors on the basis they thought they would do a better job and charge less interest going forward. We have some soft power we can deploy. And we need to deploy it in Africa and in ASEAN, that is caught betwixt the powers, and in South Asia, which is the rising economy. You know, clearly India will be the equal of China and the US and Europe over the next 30 years. Let's make those relationships work now and build them. And you know, we kind of understand how bad war can be. It's a long time ago, but we've got a lot of monuments to remind us, a lot of histories, and that above all is what we have to work towards, because the risk of that is increased enormously.
Well, thank you. We're out of time. We moved a bit away from sustainability, but I think one of the things that this...
That's sustainability.
Well, I think one of the things that this conversation demonstrated is that it's, these things are rather difficult to disentangle from one another once you start thinking about them. So thank you very much, Sean. Thank you very much, in absentia, Piotr, who hopefully will catch his flight on time. And thanks very much to the audience.
Thank you very much. That was absolutely excellent. So now we have drinks just outside, and I think maybe you can try and meet, again, somebody you maybe haven't met yet. We have Peter Sweetman, who has just landed from Madrid as well. So he's in the room, so try and figure out who's he. And yeah, thank you. So, and do discuss what happened today. What was the most interesting things that you heard? And also, what were the most interesting people you met? And we'll meet again tomorrow at 9 a.m. Thank you.